Good morning. Be right there in a few moments. Can you hear that better?
Take a look at some Dow laggards. We mentioned the weakness in software, and Salesforce and Microsoft, IBM will all lead you lower at the open. Interesting chart out of Bespoke that the year-to-date performance gap of the S&P to the Dow is one of the widest in record, and we know why that's happening this morning. Meantime, don't forget you can catch us anytime, anywhere. Just listen to and follow the Squawk on the Street Opening Bell podcast.
According to a poll, US home prices are to rise 5% this year,
The customer
3.3% next year, and
so there's no question about that.
4%
Prolonged inflation,
2026.
Interest rates that affects everything from your house payment to your student loan payment. Less savings, right? So that's all true, but people tend to have discretionary categories that they care about. So if you care about sneakers, our job is to offer up the best in the best way.
All right, that was Foot Locker CEO Mary Dillon, a guest on Squawk Box, and that is a good place for us to start on your Mad Dash.
That's a good executive. Mary Dillon did not create false expectations. She said, listen, we're on plan. The plan's going to take a long time. They did positive comps in actual Foot Locker. Champs is bad. But that's what you do. When you're an executive and you see your plan coming to fruition, you don't come on and say, listen, we're way ahead plan. It's just a good situation, better than people thought. I've been waiting for Mary to get a real handle on it. I think she's got it. That doesn't mean her 2-year recovery is pulled ahead. But she had, I felt, the hand of a winning, finally has a winning hand. But it's going to take a while to play out. But I just think she was very strong this morning.
Signs of life, that's for sure, right? Not the same at Kohl's, as we said earlier, which is going to be down sharply. It's been a very mixed bag recently in retail overall.
Yes, American Eagle versus an A&F.
But Dick's very strong.
Dick's, right, Dick's was good, but at the same time, you look at the mall and you say to yourself, why is everyone going to Abercrombie and Hollister, not the other stores? Macy's was good, but that was because of Bloomies. And the 50 Macy's that they picked that were good. Anyway, I was surprised that Kohl's was this bad, and that was the company coming forward and saying that. But I do think that Mary Dillon has a lot of stores, Total Pro, Turnaround Ulta, which could use her again, by the way. Ulta's struggling. But wow, it's great to see an executive know what the heck she's doing.
Let's get the opening bell here in the CNBC Real-Time Exchange. At the big board, it's Logistic Properties of the Americas celebrating a listing via SPAC. At the NASDAQ, it is apparel and footwear online retailer Lands.
So looking out to the market on open imbalance across the indices here. So the S&P 500, 22 million to the buy side, NASDAQ 100, 16 million sell side, Dow 30s 13 to the buy side, and the Mag 7, 12 million to the sell side.
Yeah, I mean, these are amazing. We are seeing some companies that are just missing the mark like you can't believe. I don't know. I mean, then we see this is a have-not like I haven't seen. I mean, I know that the sense is that there are 4 companies now that are moving things up. That's not true. There are companies in industries, anything connected with electricity, anything. As every one of these people, whether it's Zuckerberg or the people at Google, they know that you have to have more data centers. That business, anything connected with electricity is so great that I just cannot stand to hear that this market's about a couple of stocks. Because the electric grid involves so many companies.
Well, Goldman yesterday, Mag 7 exposure, net exposure, now 21% of the prime book. That's the highest on record. That surpasses last summer. Well, and their point is that as long as that continues to trend, the index is going to be fine.
Yes, that's true. The overall index is going to be good. It masks a lot of things. I mean, David, you know that we do not have enough electricity in this country. And you know that the grid is in sad shape, and it's finally got plus 5% growth year after year after year. There are companies that do nuclear that are doing well. I don't regard this concentration as all that bad because you know why? These companies are spending tens of billions of dollars on the grid and on chips. And that's why they are the engine of the economy right now. Now that the government is kind of just doing some infrastructure, paying a lot of debt.
Microsoft alone spending $50 billion, Alphabet going to spend $40 billion. I mean, the numbers are enormous.
And
we all pointed them out during their earnings when they came up with those numbers, which we've never seen the likes of in terms of CapEx.
Never.
And to your point, a lot of it is going towards building data centers and putting in the infrastructure. They're not building the power plants per se.
No, but they're begging the power companies to come to, please be solar. Now it's
right. Well, they want renewables to power the data centers whenever possible. Although to your point, it may not be fully possible.
It's not right.
And then there's simply the larger question of whether the grid is going to have enough capacity to power all this AI to begin with.
Although I remember back in the dot-com boom, we were all worried that the internet was going to destroy the grid.
Oh my God. David, 2 words for you. Dark fiber.
Yes, dark fiber.
Now, who needed to light that fiber the most? Bernie?
Quest.
Quest!
Joe Naccio.
Oh, Joe Naccio, he was fun.
They had a lot of dark fire.
Those were the halcyon days.
Quest was created by, they put it next to the rail lines that Anschutz owned, right?
I think that was Jack Rubin introduced that concept.
That's why Denver is a city of success.
There you
All
go.
those old rail lines made it easy to lay fiber.
Sure did.
Yeah. See, you never know where you're going to go on this show. You're going to always learn a little something about history. So, dark fiber to today. So maybe this will all be overstated. Maybe we'll be able to meet these needs. But I will tell you, Carl, there are plenty of executives, not just in the power industry, who are at least somewhat concerned about it.
Yeah, well, look, we're getting over and over again that some guy, like Meta's concerned because they have expansion plans that require much more electricity. They're the biggest buyer other than Amazon of Blackwell chips.
Yeah, you buy the chips, you got to have somewhere to put them, and then you got to have power to actually make it work.
Remember, you can't buy the chips without putting them to use because Jensen won't sell them to you. You can't stockpile the chips. You know you can't do that. You can't play that game.
I didn't know that. You can't stockpile.
No.
There's no stockpiling?
No.
So he monitors your actual usage?
Yep, he does.
Really?
He's not giving them to people who just say, listen, I'll get to it. Okay. And Michael Dell will tell you that, too. You know what? For whom the bell tolls, it tolls for Enrique Lores.
You know, you mentioned the Nestle CEO who was a guest on CNBC Europe. CNBC.
Yeah, fabulous interview.
Talking a bit about GLP-1s. You know, we've had two major trends here, obviously, over the last year and a half. One, of course, we talk about every moment, which is AI. The other is GLP-1s and what they've meant.
Yes.
We've watched Novo Nordisk shares and Eli Lilly shares soar on the success of their drugs to treat obesity, obviously diabetes initially, but obesity, and potential for so many other indications as well. Jim's pointed this out many times. Could it be helpful for alcoholism? Could it be helpful for a number of other...
High blood pressure is NYU lingo. High blood pressure.
It goes on from there, and so I would note a note from Goldman Sachs in which they raised their overall forecast for worldwide sales of the next generation of primarily GLP-1 receptors to 130 billion a year by 2030. They had been at 100 billion, so they raised it by 30% in terms of it. Why? Well, they just think more people are going to be using them. Not the total addressable market necessarily going up as much as the number of adults who will be treated regularly with them for chronic weight management, and a number of other potential diseases, Jim. As for Nestle's CEO, he said, listen, they seem to, you know, when you're on them, you have different nutritional needs, and therefore you may need more protein to retain muscle mass.
He's got something for that.
And so he did seem to indicate that their product portfolio will reflect those needs.
But he was the first CEO came out and said, yes, there's major impact. And I was listening to him. I said, oh, my God. What, didn't he get the memo that says you're supposed to be in total denial about GLP-1s? But I guess when you're the largest confectionery company in the world, you've got to say, you know what, we got to pivot. Now, his pivot is being reflected in the, well, not yet. No. Okay, but he is admitting, Carl, that everybody's going to have to address it. And there's not enough protein, so elderly people get frail. They have to put more protein, I guess, in chocolate bars.
Well, we did talk about...
TSLA makes for GLP-1.
We did talk about their new food line called Vital Pursuit last week, which is for GLP-1 users.
Yep.
And Gottlieb's theory that there'll be a whole industry of consumer products for people who are on those medicines.
Yes, Abbott Labs has the drink right now, the protein drink. Now, Abbott Labs has a couple lawsuits that are actually, Reckitt Benckiser lost a lawsuit about formula that is suppressing the whole group. But Goldman Sachs came out this morning with the most bullish app report I've seen. No one's going to buy this thing until, this is what I'm telling club members, that until you see a couple of lawsuit wins, which they haven't even come to trial, but they have a lawsuit in Missouri, Missouri's the most pro-plaintiff state in the union. So if you bring a case there, people just presume you're going to lose. But their counsel's pretty confident.
Speaking of this space, Jim, McDonald's, the U.S. chief with this memo about what he would argue is pricing misinformation. You talked to Chipotle last night. I don't know if you've seen McDonald's versus the S&P so far this year. It's remarkable.
It is remarkable. And I got the note last night, and I felt terrible about it because, look, McDonald's, this is from Joe Erlinger,
Yep.
who's a terrific guy, and he says that the reports of the Big Mac is really $4.39 in 2019. It's going to $5.29. That's an increase of 21%, not 100%. There was a report of an $18 Big Mac meal being sold. Even if there's one location, 13,700 are not doing that. So I read this note and I said, you know, McDonald's is not being reported on correctly. So I felt like when I got this, I would certainly come forward and say that this is a significant change from what a lot of people are saying.
Right. It's a reminder that franchisees set the prices.
Yes.
Unless it's a corporate-owned store. But this is, I don't know if it's reflective of inflation or employment trends or GLP-1s or something else.
I have to tell you, I had Brian Nickel on last night from Chipotle, and they've got the most expensive so-called fast food, and they've seen amazing numbers. Amazing numbers. It's incredible. I mean, they have the Chicken Al Pastor, which I really recommend to you right now. It's a limited time only. I asked him if he was going to do the same thing that Red Lobster did with the shrimp, and he said no.
That's a smart move.
Yeah, because he said it doesn't want to bankrupt the enterprise. But what he is saying is that they've had no degradation in sales. And so maybe, David, the question is, if you make the food fresh and terrific, maybe the people will buy
People
it.
keep coming.
Yes.
Yes.
But I happen to like McDonald's, and I never. But you know what? I read this. I said, "Oh God, all right. I make a lot of money, so maybe it doesn't. I don't see it." And that's not the way America is, because only 6% of the people in this country make more than $100,000. Because we are in a have-not society. Lenin.
Yes, that is very much the case.
Yeah.
But that's for another day and another show, I think. Right here, we're
Trotsky?
just all about capitalism and markets. I don't know if you got the memo there.
I was going Marx and Engels. He thinks it's Marty Engels.
Yeah, no, I'm not. I'm going, I don't know where I'm going.
What
How about I go to...
Remember, I said the people are like the sack of potatoes.
Who said that?
Actually, it was Engels about the peasantry.
Like a sack of potatoes.
Yeah.
We should, really quick, the wage gap has actually closed, not broadened.
That's true.
And lower cohorts are actually...
I know. I mean, it's like lumpen proletariat. It's now lumpen crab meat.
Yeah, but it's still pretty significant, isn't it, compared to
Yes, it
the
is.
1970s?
Or the 80s with
Or
Reagan.
the 80s. We talked about compensation for CEOs versus the average worker.
We're so far afield here. Could you bring us back to reality?
Sure. You want to talk about the NBA and Warner Brothers Discovery?
It's about time you killed Warner Brothers Discovery.
I'm not going to kill them. David Zaslav, the company's CEO, is at a Bernstein conference talking about what we've reported on, namely this continued conversation with the NBA about whether Warner Brothers Discovery will come up with something here. He said we continue to talk to the NBA. I'm hearing same, of course. They continue to talk. Their focus, as I've reported previously, on that potential package that Amazon has, that so-called streaming package that the NBA has, not on the package that our parent company Comcast seems to have more or less sewn up, and not on the Disney package with ESPN, but on the Amazon package. But it's unclear whether they will figure something out there. You can, is there going to be a dispute about not just meeting on the economics, but on what the NBA wants in terms of a streaming partner and whether that could be represented by Max? Because that doesn't make necessarily economic sense for Warner Brothers Discovery just to sign up to stream on Max and not have it on TNT. You've got to have it on TNT. So will there be some sort of a dispute around that if, in fact, they are even willing to meet the economics of the deal itself? These match rights were written 10 years ago, before sort of streaming was, certainly streaming for sports was really a thing. So we'll see how that goes. They're still talking. But Zaslav went on to say, as he often does, we got a lot of other stuff. We got NASCAR. We've added a lot of college football, including a lot of college football playoffs. We got hockey. When you put it together with March Madness and baseball and soccer, it has a very robust offering for consumers, and that's our job. So that's what he's saying.
That's pretty bullish.
I don't know.
There's also his quote, there'll be some players that want to get out of the business. They'll look to consolidate their streaming businesses with others, and so we will look to be opportunistic during that time.
Yeah, well, that's a hope that he's still hoping somehow there's a shot at getting at Paramount.
Oh, you mean
not that they would buy Paramount, not that they would, even though I think there's enormous potential synergies there, but that there'll be some opportunity to either pick Paramount Plus up or do something if, in fact, well, who knows? We'll get.
Do you have a Peacock bit of knowledge?
What would you like to know about Peacock?
Just trying to see how quickly you're groomed from the. No, Peacock has got sports.
And there's Paramount.
No, Peacock has sports, and I have to tell you that the NFL, how they determine the schedule for Peacock, because I was out there in Kansas City, and the people want NFL at any price.
NFL is the key product. It's the key product. We talk
Olympics,
about it.
less than 100 days away.
Here it comes. Olympics. And that's only available on the Peacock, so to speak.
Look, I know
broadly speaking,
you're a
NBC.
baby boomer or something.
Right
but
here.
The Gen Z is addicted to Olympics.
To what?
The Olympics.
The Olympics.
No, I'm not kidding.
Olympics are great.
They are great.
They're great. And we're not just paid to say that. They really are. They're great.
No, you were paid to say that. I, on the other hand, having tried out for the Olympics and failed.
Yes. Well, the rowing team was their loss.
I had I ran a 48-quarter mile. That's not so bad.
No, you were very fast.
I was in Penn Relays.
Before you just everything collapsed on you.
While we're in the media circle, how about Peltz?
Yeah, Nelson is out.
Nelson's out of Disney.
Good prices.
Did he? How much money did he actually make? Ike Perlmutter's stock remains.
Yeah, that's my understanding.
Right. So Perlmutter's stake was most of the overall stake at play here in terms of the proxy fight. But Trian's stake has been sold.
Stake, he made a lot of money. He made a lot of money on it. Really good basis. And
he made a lot of money on it?
Real go out. Real good basis, real good go out.
Really?
Yes. Actually, he did quite
well. They only own like 7 million shares, right? Of the 31 million or something like that.
Well, how much? Look, if you buy something in the 180s and you sell it at 220, that's a nice win.
Yeah, but it's 100 now. Where did they sell? I don't know where they bought it.
No, they sold it 20, like $19-20 above this.
Right, and they bought it maybe in the 80s?
Yeah, they bought it continually on the way down.
Yeah.
Because they thought it was a good buy, and it was.
But
Ike, on the other hand, is, obviously just a very frustrated shareholder. I mean, Ike is
he's been the longest-term shareholder. I mean, he's been there for a very long period of time. That's where most of the stake was, as we made the point many times.
He's focused on the political regime.
Yeah. Peltz is.
No,
Ike is. Well, Peltz is too.
Well, it's just that Ike.
I mean, you saw the Journal reporting. I think Maggie Haberman, also the Times, reporting about Peltz having the meeting in Palm Beach. Musk attended Trump.
Well, and
bringing them together. It would have been interesting if he was on that Disney board, given that Schwartzman's come out. Yes.
Waiting for a verdict there, I guess, right?
Yeah, potentially.
Guys,
we showed Paramount. I might as well just give a very quick update. Very quick, because I may have more later in the week. But the Ellis and Redbird camp, they continue to do their work. Remember, exclusivity expired on them some time ago on Paramount, but that's where the focus is. Who knows? Will they get something? Will they get to the finish line in the next couple of weeks? Certainly, they've been working at this for so long. One would expect that they're running out of time. I'm hearing from all sides that they would love to at least have something either done or know that they're not going to get there within, let's call it, early June.
And
but
who's running Paramount right now?
3 different gentlemen. Three different gentlemen.
The three-headed company.
Yes, it's not a recipe for success to have three non-CEOs.
The Pep Boys.
Yeah, the Pep Boys. It's like the Pep Boys. By the way, Sony and Apollo, I mean, they signed an NDA, it took 2 weeks, and nothing. Crickets. So that's what you got. I'll have more, hopefully, if and when they're trying to narrow the gap between the special committee and what they want to deliver for the B shareholders, for everybody. They're trying to narrow that gap every day. We'll see if they can.
You kind of a DNR there. Did a DNR.
A DNR?
Yeah. Do not resuscitate.
Well, it's a tough business, man. What will happen at Paramount if they don't get a deal done? They got 3 guys running this thing. I mean, none of whom are the CEO, and they what?
But what are they being paid? Because they are in the media business.
I don't. Got to pay me each $30 million.
You guys mentioned Musk. Jim, there's a ton of news in the auto business. There's this report that they're seeking to register FSD in China and will sell it as a monthly subscription. You've got BYD with this 1,300-mile range hybrid.
That's unbelievable.
You got Jeep saying they're going to roll out a $25,000 EV, quote, very soon.
Look, I think Tesla is in league with NVIDIA to create autonomous machines that are going to do far more than be cars. And that has to be the savior. But I do think it can happen. I think an autonomous machine that we just try to figure out what all the great things it can do.
Yeah.
I think the autonomous machine is going to say, go to Wingstop, get me some wings, and bring it back. That's
will
what's
that be the Optimus robot? Will it just run down there for you and hand them to you? Or
we do have Amazon getting FAA clearance to operate drones outside of the line of sight.
Yeah.
I think that, look, Amazon, we haven't talked about Amazon nearly enough lately other than that about the NBA rights.
Yeah.
They're spending a huge amount of money to do so many different things in AI. Now, I don't like Claude right now nearly as much as Chat, because Claude
and that's
doesn't have
they're
anything.
funding Anthropic, which is Claude.
Because Claude is no good from like 20. In the last 6 months, Claude has nothing. I mean, it's sad.
Claude's not trained on current.
Well,
on the most current.
if you Google about how NVIDIA is going to do, it says it's like unlikely to do well.
I see.
Unlikely to pass. By, it just doesn't. It's no good. That's what I'm saying.
Yeah.
For anything.
Tesla shares are up another 2%. Don't forget, they're in the midst of that important shareholder vote, not just on his compensation, but also on reincorporation in Texas, where there are two separate votes. The Texas one, they need people to vote because they need to get 50.1% to vote in favor of the outstanding shares.
Wouldn't you want that tour of the plant if you vote?
Well, you get a Gigafactory tour if you vote, or you're put in a
I had a tour of the Lamborghini factory.
A lottery to get a tour.
I was going to buy a share. I'm not allowed to buy a share just to be able to see it.
I got a tour last year when I interviewed Musk. It was cool, really cool, amazing. It's worth it.
Is your name what, Montoya?
My name is not Montoya.
One of the greatest movies ever, Princess Bride. And come on, let's give it.
Princess Bride?
One of the greatest.
Rob Reiner? Great.
If you have one takeaway from the show.
Quick reminder, don't miss the next Investing Club monthly meeting happening at noon today, as Jim has been talking about. You can join the club for members-only access to Jim's next big moves in his portfolio. Meantime, watching bonds back below 4.6 on the 10-year. We got pending homes in a few minutes, and claims did run a little hot, 219K, a little above expectations. Stay with us.
At 10 a.m. Eastern Time, we get US pending home sales change month over month, forecast minus 1% on the prior 3.4%. We also get US pending homes index, prior 78.2.
now.
Take a look at some S&P laggards. We talked about Salesforce. Hormel is in there as well with a beat, sales miss. They raised the EPS guide, but they keep the sales guide intact. We've talked a lot about how CPG companies under pressure from private label.
I've
Jim,
got them tonight.
you do.
I've got to know what's going on because they're a protein company, and that's very good for GLP-1. So, David, I'll bring you some pumpkin spam. You can have some tomorrow. You'll just drink it.
I remember when you ate that on set.
Darn good, frankly. It's darn good.
That was a moment.
Meantime, S&P holding 52.52. Don't go anywhere.
At 10 a.m. Eastern Time, we get US pending home sales change month over month, forecast -1% on the prior 3.4%, and US pending homes index prior 78.2.
%50 off.
Jim, you've got your monthly investing club meeting today.
Very exciting. We're going to spend a lot of time on Best Buy because I think that is the one that has the most opportunity of the companies that we follow. I'm going to obviously address Salesforce. Foot Locker, I think, is on target. But we have a new name that we're going to be discussing, which is Dover. And Dover is at the heart, again, of the data center. You have to have data center in your portfolio in some way, shape, or form, even if it's solar.
There's a few different ways to get there.
Yes, there is. Solar's important. Wind, not yet as much. But I've got to tell you, natural gas, too, and no one wants to talk about that.
No, but that's going to have to be used. And then nuclear, we talk, of course, it takes forever to build these
can
things.
make this comeback. They'll open 3 Mile Island again. That'd be something, right? I'd love to run that tour.
Jim, we can look forward to it. We'll see you at midday, and then again later tonight with Hormel on Mad. Meantime, S&P down about 15. The Dow is taking the brunt of the beating today. Don't go anywhere.
1 minute remaining. I'll lead with US pending home sales change month over month. -10 seconds. -7.7%, -7.7% lower than forecast, -1%. And pending home sales, -0.8%, -0.8% higher than forecast, -2%. Seeing pending home sales month over month, prior revised 3.6%.
Good Thursday morning. Welcome to another hour of Squawk on the Street. I'm Sarah Eisen with Carl Quintanilla and David Faber, live as always from Post 9 of the New York Stock Exchange. Stocks have a mini sell-off here going on. The S&P is down 1/3%. There's strength under the hood in places like real estate, which is surging more than 1%. Industrials, materials, staples, consumer discretionary, energy, utilities, and financials. All those groups are green right now, but it's technology that's weighing on the major averages. Salesforce is a big part of that story. I know you guys have been talking about that. It's down now 19.6%. ServiceNow, Intuit, Adobe, Oracle, all at the bottom of the list in sympathy. Take a look at treasuries after we did get some data this morning. And there's a bid. There was a bid before the GDP report, and that extended. We're seeing yields a little bit lower today, 4.56% on the 10-year. So still elevated, but two-year yield stays
Stocks
under 5%.
extend full. Dow Jones down 1%.
Here are three big movers we're watching. Got to start with Salesforce because shares are plunging after its first sales miss since 2006. The company's forecast also falling short. We're going to break down the numbers with one of the street's top tech analysts later this hour. Find out whether it's a buying opportunity. A lot of big retail movers this morning, including Foot Locker, which is surging almost 30% now, posting better than expected comp store sales as the company's turnaround plan begins to kick in. More on the retail trade ahead on the show as well. And then keep an eye on shares of Disney. Nelson Peltz selling his entire Disney stake weeks after losing the proxy battle. Stock up a little more than 0.5%.
Busy morning in data between claims and GDP and now pending homes. Let's get to Diana Olick. Morning, Diana.
Good morning, Carl. Pending home sales dropped 7.7% in April compared with March. The street was looking for basically flat. Sales down 7.4% year over year. Now, this count is based on contracts signed during the month, so at that month's mortgage rates. And that's your culprit. The average rate on the 30-year fixed ended March at around 6.9% and then just took off, hitting 7.5% by the end of April. With prices still climbing and supply very low, leading to increased competition, that jump in rates was a huge factor. Sales were down in every region of the country, but they fell the hardest in the Midwest and West, which is interesting because the Midwest has some of the most affordable markets and the West the most expensive. So you do the math. Anyway, mortgage rates eased up a little bit in May, but are rising again now. Another report out from Redfin this morning said the share of sellers doing price cuts hit 6.4%. That's the highest level since 2022. The median asking price also dropped for the first time in 6 months. So, guys, interesting dynamics going on with rates.
Yeah, I mean, are the lack of activity, the negative sales that we're seeing, Diana, is it going to have an impact on prices, or this inventory issue is still forcing prices higher?
You know, you would think so. That's how it usually works, right, historically, but it hasn't been in the last year. And that, again, as you said, is because of the supply issue. Supply is leanest on the lower end of the market where demand is strongest. We are seeing a lot more supply on the high end of the market and more activity on the high end of the market. So you might see prices easing up there just because sellers don't have quite as much activity as on the lower end. But again, if you still have this lack of supply and lots of demand, it's going to keep a floor under prices. And with mortgage rates high, too, that just, keeps sales low. That's what we see.
Yeah, the predicament for the Fed. Diana, thank you very much. Diana Olick. Got a lot of new information today. First of all, GDP. So it was the second look at the first quarter, and it was revised lower. I remembered, Carl, what you mentioned about David Rosenberg and some of the bears saying all the revisions are coming in lower. Well, GDP was down, so now it's up 1.3% instead of the first look was that it was going to be 1.6%. And if you go beneath the hood, consumer spending did get revised lower. So 2% growth in personal consumption. It was 2.5% prior, 2.2% consensus. So that is something to pay attention to as we wonder whether the consumer is really slowing. Now remember,
proves us right a little bit.
Proves us right, and
we
also
spent a lot
the
of time
companies.
talking about that. And certainly, you mentioned so much of from the calls and the like from so many of these companies in terms of what they were saying.
It's natural that after years of inflation, the highest interest rates in more than 20 years, that you would start to get some weakness in the consumer. The thing is, the job market has been on fire, and there are signs that that's cooling as well. We're going to need to see more evidence of that. But I just wanted to mention, so you see that smaller GDP number, and it was the smallest since, what, 2022? Remember,
Q2 22, yeah.
I mean, economists aren't that worried that it's recessionary or anything because it was skewed by some big shifts in business inventories and trade. I wanted to remind everyone of that because it's not like growth is falling apart. The Q2, which is the current quarter we're in, the tracking number from the Atlanta Fed is 3.5%. So things are going okay on the growth front, but we pay attention to the weaker consumer numbers. And then the only other number I'd pull out of this, because it was also very bond friendly, is the price deflator, moving lower to 3% versus the 3.1%, which was what is initially forecast and also initially reported. So, David, always good to get an inflation number that comes in worse than expected, but it's still not at the 2% where the Fed needs it to be.
Right.
And that's the thing.
Yeah. So, what does it all mean, Sarah?
Patience. They're going to have to wait a little more. It means that they're going to have to wait to see more evidence. I just showed jobless claims. They were a little elevated. Look, I'm really looking forward to a conversation today with John Williams, who's the New York Fed president at the Economic Club of New York. We're going to be speaking around noon. Market's going to be paying attention. He's always a big voice at the table, and always gets a vote.
U.S. Treasury yields
Also,
extend fall
really
after U.S. housing data. 10-year yield last down 6.2 basis points at 4.561%.
So I'm interested to hear if he echoes more of the Kashgari. We need months of data to show that inflation is really coming down before we cut rates, or a less hawkish view of we're getting there on inflation and we could be looking at cutting.
Eisen to speak with New York Fed President Williams.
Yes, very exciting.
I prefer Sarah than Eisen, but I like that.
Okay, well, it's Faber report.
It's true. It's true. Well, that's it's been around longer than you've been alive at this point. So.
Look, we're also getting commentary from the companies. I did a special for Carl because the Beige Book I love, and in New York, they really went a little bit deep on the Broadway situation that I needed to get Carl's take on.
Ooh.
So tourism is good in New York. Broadway show attendance continued to improve. While tickets for some shows were in very high demand, less successful productions have seen low attendance, and 5 Broadway theaters remain out of use. Did you know this?
Well, there's been a high level of inventory of Broadway shows this year, Brandon. Am I right? Yes. So there's not that many people ready to go to the theater. So they're duking it out.
We've had an enormous number of openings.
Yeah, exactly.
Right?
That's my point.
Yeah.
And some of them, I guess, better than others in terms of the show. Overall, the Beige Book message was moderate expansion, moderate growth. Look, if you're worried about recession or inflation and you look at all the anecdotes in the Beige Book, you didn't see much. It was like moderate price increases. Companies are having more trouble passing on higher prices, moderate employment growth. I mean, it jibes with the soft landing that I think the Fed and the bond market really want to see. And so today is a good day for all that.
Yeah, I mean, look at John Waldron of Goldman today presenting. Soft landing remains the base case. Blackstone's COO yesterday. The Fed is having some success here, getting some more activity in CMBS, CRE spreads tightening. There's a lot of constructive commentary, the equity market this week notwithstanding.
I think and it comes down to the consumer. And on the consumer, I think what the read is, based on today's data, just going through some of the commentary, it's that the consumer's not cracking. Cruise not crack is what Goldman Sachs said. So still going strong, but a little bit of a moderation. And you see that from some of the commentary. I mean, we've got a lot of retail earnings to go through, and some are winners or some are losers. Here's the CFO of American Eagle, for instance.
Continued momentum similar to what we've been seeing, pretty commensurate with the first quarter trend. So we're very pleased with that coming into the second quarter. Very pleased with the start of the year. A lot of business ahead of us.
And then Best Buy, on the other hand, not as hot. If you look at what the Best Buy CEO said, they've been in a tough category of electronic spending post-COVID, coming out of COVID, but they say consumers continue to make tough choices with their budgets, trading down in some areas while still prioritizing spend in others like services and experiences like travel. This in combination with the pull forward of tech purchases that we did see in COVID continues to be a give back here for the likes of Best Buy, has weighed on demand into the early parts of the year, and the pandemic and lower levels of material innovation has led to continued lower demand for high-ticket consumer electronics and a focus on value and deals. So we're really starting to see winners and losers, as we have been,
all
by
along,
category.
There's been a bifurcation as you've been doing this commentary, which I think is great and very informative throughout earnings season. But it's part of it you wonder is it just execution? Although, frankly, Best Buy actually executing fairly well despite what are somewhat negative comments in terms of the consumer.
No, but a good example of that is Capri, which owns Michael Kors, which had a weak quarter, versus a Tapestry, which had a strong quarter, and they're trying to buy them because of that weak execution. And here's what Capri says. Performance in the fourth quarter continued to be impacted by softening demand globally for fashion luxury goods. Didn't hear that at Ralph Lauren. Right. Didn't hear that at Tapestry. So you're right. It's not like if you're in one category necessarily, you're a winner.
Meantime, markets are under pressure. Once again, Dow's down 358. We've kind of talked about why. NASDAQ's coming off the worst day since the end of April, and the S&P is on pace to break a 5-week win streak. NASDAQ still up 8% for the month. S&P up more than 4%. Just 4 tech stocks have added more market value than the rest of the S&P put together. NVIDIA, Microsoft, Apple, and Alphabet have added $1.4 trillion this month, more than the other 296 stocks that rose put together. Half of the gain was NVIDIA. Let's talk more about where the market goes from here this morning. Charles Schwab, Chief Investment Strategist Lizanne Saunders is with us. Lizanne, good to see you.
Hi, Carl. Nice to see you, too.
You know, there was some chatter when we crossed the 100th trading day of the year that when you get to that level and you're up 10% year to date, the year ends up historically being pretty good. Is that a reliable thing to count on?
I think none of those anecdotes are reliable on an every year basis. We also have to remember that you can look at those trends at the index level, but what's really noticeable this year is what's going on under the surface. You know, in the case of the S&P 500, it's not as extreme, but you've had no more than, I think, a 7% drawdown at the index level, but the average member has had a drawdown of 14%. That average member drawdown goes up to negative 35% in the case of the NASDAQ. So I think the real story of what's going on is not necessarily being told at the index level because of that bias up the cap spectrum, the Fab 4 contribution, as you said. There's so much churn and rotation going on under the surface. I think that is telling the more accurate story of the relationship between the market and all of these macro uncertainties.
Right. Now, the question for a lot of desks this week is whether or not these drawdowns are calling into question the fundamental case of at or above trend GDP growth, positive EPS growth, and a paused Fed. Are you seeing those things getting called into question?
I think the sort of parlor game that's going on still with regard to the Fed and when will the first cut be, how many cuts this year, and that changes, of course, with every data point. But I think more important to the equity market broadly, but also specific to, factor leadership, whether it's small caps getting a lift or getting hurt disproportionately, is yields. I think the bond market is really in the driver's seat for the equity market right now. Now, of course, there's a relationship between moves in yields and prospects for Fed policy. Those are connected, but it's that real direct inverse relationship between bond yields and equities, with the inverse relationship being much stronger as you go down the cap spectrum, because obviously there's greater interest rate sensitivity when you get into the smaller companies. And that's, I think, really where the leadership has been defined is based on what's happening in the bond market. And for the equity market, it's very specifically the 10-year yield.
Yeah, bonds and AI, that's the other biggie. We were just looking at some of the year-to-date winners for the S&P, super micro, NVIDIA, giant gains,
utilities,
more than 100%. Utilities. So do you buy the AI theme as a leadership for the market and a way to reevaluate how you think about earnings and productivity in companies?
Yeah, and I think it comes into play in what we think of as the growth trio of sectors, which house the Magnificent Seven. So technology, communication services, and consumer discretionary. But interestingly, although tech and communication services are still doing well, you've had that negative divergence in consumer discretionary, in part because that's not really the AI play necessarily, especially a stock like Tesla, which has been such a weak performer. I think AI is incredibly compelling as a driver of the economy, as a driver of productivity. I'm not sure you can quite quantify it yet in terms of things like productivity statistics, but certainly has represented a lot of power from an earnings perspective. And in the case of utilities, there's been a lot of chatter and stuff written about, is that an odd thing happening in a market that at the index level anyway is doing fairly well, that you've got this classically defensive area in this leadership position. But to your point, Sarah, I think the leadership of utilities has more to do with the sort of power story component of which is AI, more so than this traditional area of defense that investors are moving toward.
Yeah, the rewriting of utilities as a playbook is really interesting. One of the more interesting stories of the year. Lizanne, talk again soon. Thanks so much. Lizanne Saunders.
Good to see you.
Communication services, technology, and utilities, 3 best performers year to date. As we head to break, here's our roadmap for the rest of the hour. Salesforce shares are slumping, down double digits on its first sales miss in almost 2 decades. We're going to discuss what's ahead for the stock with one analyst who is sticking with his buy call.
Plus, retail roller coaster, a number of earnings movers rallying double digits today, others plunging double digits. We'll talk about the names to watch.
And fueling the AI boom, Duke Energy's CEO is going to join us to discuss new power deals with Amazon, Google, and Microsoft. We've got a big show ahead for you. Don't go anywhere.
In America.
You can see the incredible growth this quarter is amazing. I mean, these are cash flow numbers that we've just never seen before, up 39% year over year to $6.247 billion in cash flow. Incredible.
That was Salesforce Chairman and CEO Mark Benioff. He was a guest last night on Mad Money. Of course, sounding very bullish despite shares that are plunging down some 20% on what it was weak profit guidance. Obviously not cash flow, which was quite strong. It was the company's first revenue miss since 2006. Jefferies tech sector leader Brent Thill has a buy rating, $360 price target on the stock, and joins us now. So what happened here?
David, it's a mixture of Q1 on macro in Europe and the US. And then I think there's an element of AI investigation. Companies only have so much money to spend in technology. Everyone is being guided to this pit stop called AI, and they're getting distracted trying to figure out what they're doing. So I think there's a lot of no decisions that are being made. We saw this with Workday. We hosted the CEO Workday at our software conference here in Southern California yesterday. Continued to cite everything that Mark is saying. So we have a consistent pattern. The back office and HR financials is soft. The front office and sales service and marketing is soft. Europe in parts of the US. And then I think you have this AI investigation going on that is causing some pockets of weakness as companies are trying to figure out where they go in this AI journey.
Yeah, we made that very point at the top of our 9 o'clock hour, Jim, Carl, and I talking about that. I like the way you say AI investigation. Do we have a sense, Brent, is that where they're going to end up? Is the good decision going to be made? We need to be spending more money over here and hence less with the Salesforce or perhaps other enterprise software companies?
I think that's what's happening. I think ultimately what's happened since the pandemic, you had all these CEOs that were like, this is the new normal. We pulled together a digital transformation, and we're in a giant hangover still. We're digesting all this software. The analogy I have is like when you back up your Suburban and go to Costco, you don't go back to Costco the next day. You got to digest everything you brought into your house. And so we're in this digestion phase in software where we're still digesting these applications, and we're trying to extract the next value out of these systems. So I think that ultimately there's still demand. There's a good market. Maybe the market's not growing quite as fast as everyone's predicting. We've talked about this with Adobe. They talk about a 13% plus growth market. They're growing 10. Salesforce growing underneath their forecast. Workday under their forecast. There's a consistent pattern across the entire software industry. And then there's an exciting show going on, which is everything in AI infrastructure, NVIDIA, cooling, power, data center. I mean, those stocks are all up 80 to 100% because there's an S curve. There's no S curve in software right now.
Yeah, well, it seems to be a pretty important theme that, again, we have to continue to sort of keep an eye on. As for Salesforce itself, Brent, I mean, wasn't that long ago, of course, you had a lot of activists pressuring the company. Mark was talking about the very strong cash flow. Have they met sort of, on the margin front? I'm just curious to get a report card in terms of what they've been able to accomplish, because obviously this is more of a demand side of the equation as opposed to, I would assume, the margin side.
Yeah, they've done a really nice job on the margin. They still have a long way to go. We've said this, they're the most out-of-shape large cap software name that we cover. And when you have margins in the low 30s and all your peers are high 30s and 40s, I mean, Adobe, Oracle, all these companies are in the 40s. So if you think about 30 to 40 plus, they're still not at cruise altitude. They've started to level off. And one of the bear theses on Salesforce is that as the environment opens, Mark likes to spend. He's always been that way. He's been a growth CEO, not a margin CEO. And does that change his appetite to do more M&A? Does it change his view on the margin trajectory? And I think, the Bears obviously are winning today on that thesis.
Yeah, well, they're winning overall. All right, AI investigation. We're going to continue to investigate that as well, Brent. Thank you.
Thank you.
By the way, the Dow is down almost 400 points, but Salesforce is shaving 346 points off the Dow.
That's such a great index, really. Works so well.
The statistically irrelevant Dow, according to David, is lower, but so is the S&P 500 right now, and so is the NASDAQ. It's down 0.4% because tech is lagging, and it's not just Salesforce. You've got weakness in ServiceNow, Adobe, Oracle, Microsoft as well. Also, there is one winner, though. HP, top of the market today, and that's in the tech space, up 12.5% off earnings. We're going to talk more about what the signals are from earnings, from the market, and this software story when we come right back.
Dow falling nearly 400 points this morning. The Nasdaq, S&P under some pressure. Mike Santoli's here at Post 9. We were just grousing about price-weighted indexes.
Yeah, I mean, the Dow is very distorted today, as you guys were saying, by the Salesforce move. It's a high-priced stock down a lot. That said, enterprise software in general is weighing on the S&P as well. Microsoft in particular is a little conspicuous here, down a couple of percent, actually ran right into a barrier at the old highs from March. That said, if you look elsewhere, it's the strongest day of the week in the market because yields have relaxed lower after that somewhat softer than expected GDP revision and some of the read-through on the price indexes. And what that has done is allowed breadth to re-expand. And that's exactly the dynamic we've been in for a while. Yields up, narrows out the market. You kind of retreat to the higher ground of those companies you have the highest conviction in that can grow through whatever. And that's been an NVIDIA story. NVIDIA, again, this intraday move, there's this stampede of call option buying every single day. The dollar volume in the stock is just phenomenally above anything else in the market, and it almost just wags the dog on a given day. But again, today is better breadth. At least as a reprieve for what has been a pretty atrociously poor breadth market in the last several days. And, again, we're kind of clenching up ahead of the PCE inflation number, and that's been the dynamic for a little while right now.
I know GDP is backward-looking,
sure.
but most of the revision was a decline in goods spending.
For sure.
Particularly durable goods.
Yeah. I mean, this is a quarter that ended 2 months ago, and so you can almost take heart in the fact that, yeah, I guess maybe the companies were seeing what the broad economy was telling us, that there was a cooling off. I don't think it's alarming levels. To me, it's much more about earnings are holding up. That's the support. That's not the catalyst to go higher from here. You're 21 times earnings again at the highs. You haven't spent a lot of time above 21 times forward earnings in the S&P 500, except for the pandemic and the tech bubble. So you have to have an excuse to try to pay more than that. Now, the average stock is a lot cheaper than that. People keep saying that. It is true. But I do think that's why you have this churn at these levels and trying to figure out what can work. And yes, lower bond yields would refresh the buying.
Yeah, I mean, there's also the AI,
yeah.
what do we call it, investigation, like Microsoft, Adobe, Amazon, Oracle, some of these names, Salesforce.
Yeah.
Sometimes they get credit for being AI stories, and sometimes they get hurt for being software stories, which is a story today.
What the market has been telling you for a while is what it really sees clearly is the infrastructure build out in terms of AI capacity and even in industrial capacity, production. It's not interested in the consumption side. It's not interested in the old favorite, which was annual subscriptions, and the software model is so sticky and you have to pay a high multiple for that. Disruption creates disrupted companies, and that's, I think, what the market's trying to reckon with.
Yeah, and Mike, I'm just curious, do we have any statistics on how many days have been NVIDIA is the market days versus actual market days?
It's certainly been several this month, I would argue, and it's sometimes NVIDIA along with the fellow travelers of maybe it's Broadcom and Dell or Supermicro on a given day. But, as Carl was mentioning earlier, there's massive divergence between the S&P and Dow. A lot of it has to do with NVIDIA. NVIDIA is responsible for more than a third of the market cap that's been gained by the S&P this year, and NVIDIA is not in the Dow, as we all know.
Stat.
And so that seems to be, yeah, exactly. Yeah, not yet until the 10-for-1 split takes effect, and they just panic, basically, and feel like they have to have it. It's also, by the way, the second weighting in the S&P ahead of Apple right now because of the float adjustment to Apple.
Right.
Yeah, that was a great tidbit this morning.
It's also the end of the month tomorrow, right?
It is the end of the month tomorrow, and I don't know exactly how that plays, except, one thing, the S&P has been flirting with this 5250 level. That was the March high, as I was saying earlier, and also last week's low. So it seems like below that, the mechanics of the market start to get a little more, maybe a little more volatile or twitchy.
Mike, thanks.
Okay.
Mike Santoli. 15 retail names have reported in the last 24 hours. We're going to get you some of the key headlines along with some top picks from one analyst who says to bet on names like Ulta and DKS when we return.
a trial.
Welcome back. I'm Seema Modi with your CNBC News update. The jury is back for their second day of deliberations this morning in Donald Trump's hush money trial. The judge is reading a large part of his instructions once again this morning as they deliberate on the 34 counts Trump faces for falsifying business records. Meanwhile, the jury asked the judge today for headphones to use with the evidence laptop. Papua New Guinea ruled out finding survivors under the rubble of a massive landslide. The exact number of people killed is unknown, with a wide range of estimates from 670 to 2,000. Part of a mountain collapsed last Friday, burying people under almost 2 stories of debris and mud. And one of John Lennon's guitars from his time with the Beatles just sold for $2.9 million at auction. That makes it one of the most valuable pieces of Beatles memorabilia. The 12-string acoustic guitar, known as the Hootenanny, was believed to be lost for over 50 years until it was discovered in someone's attic in England. It was used in the recording of the albums Help and Rubber Soul. David?
Seema, thank you. Well, retail has been a key today, of course. We've gotten earnings from Best Buy, Birkenstock, Burlington, Foot Locker, Kohl's. That's just to name a few. Let's go over to Dom Chu, and he's got some of the key movers here this morning. Dom.
All right, so David, we're going to try to rapid fire through all of this because, like you said, it's a lot. We're going to start with Foot Locker, which is soaring after the company reported better than expected earnings. The sportswear and athletic footwear giant also reaffirmed its full-year guidance, citing progress on its turnaround plan in the upcoming summer and back-to-school shopping seasons. Those shares up 27%. Birkenstock also trading higher to start the day. The German sandal maker topped expectations and raised its annual revenue forecast as it sees strong demand from consumers and wholesale partners as well. Birkenstock shares up 9.5%. One outlier to the downside is Kohl's. The department store operator delivered a surprise quarterly loss due to weaker consumer demand for apparel and footwear. Kohl's is also lowering its annual forecast, so those shares are down 25%. Burlington Stores is next. That stock is higher after handily beating earnings estimates alongside slightly better than expected same-store sales numbers. Those shares up nearly 19%. And then Dollar General has been moving between gains and losses as investors digest a mixed result. The retailer gave disappointing earnings guidance for its current quarter, though it follows a solid beat last quarter. The company also reaffirmed its full-year guidance. On balance, those shares down about 4%. And we'll end on Best Buy, which is now higher by about nearly 10% following an earnings beat and upbeat guidance. That's outweighing a slight miss on revenues for the electronics retailer, which also said macro factors created a challenging sales environment. That's a lot. Guys, I'll send things, Sarah, back over to you.
And some huge swings in those stocks. Dom, thank you very much. Our next guest has a buy rating on Best Buy, $90 price target. Joining us now is Michael Baker, D.A. Davidson Senior Research Analyst. Before we get there, Michael, what a picture. So Kohl's is down 25%. Foot Locker is up 28%. What are we gleaning about the consumer right now?
Well, two things I'd say. One, to us, the consumer sales and spending is slowing. Best Buy, the stock is up, but as Dom said, they did miss sales, and just some of the monthly retail sales numbers we get. We are seeing a slowdown. Year-over-year growth in retail sales has been about 3% or so year to date. That's below the pre-pandemic average, which is usually in the low 4s. A lot of moving parts between the late tax refunds, the early Easter, the leap day, et cetera, weather. But generally speaking, we are seeing a slowdown in consumer spending. What it tells you about the stocks is it's a stock picker's market. I mean, those moves are pretty variable and a lot up, a lot down. Even this morning, as I look at my list here, we had 4 companies miss on sales, 3 companies beat on sales. It's really sort of all over the place.
And Dave and I were talking about execution. I mean, it really comes down to who is understanding their consumer right now. We saw that with Abercrombie, for instance, in a big way. So how do you pick the winners?
Yeah, it's a great point, and a lot of it is execution. Best Buy, perfect example today. Again, missed on sales, but they beat on margins. Gross margin, much better. That's execution. They're starting to advertise and promote a little bit more. That's leading to a better sales trend in May versus where they ended the quarter. Even with that increased promotional activity, they were able to say that they're going to be at the high end of their profit guidance for the year. So that's all about execution. So in a lot of ways, you're betting on the management teams, as you said, who can figure out how to manage through this environment. Another name yesterday, Dick's Sporting Goods, really strong execution, been one of our top ideas. And we're seeing them just navigate this tricky environment by taking market share and growing margins.
There's going to be more. Costco, Lulu, Ulta after the bell. Where's the opportunity given some of the size of these moves? Which one would you bet on?
Yeah, a name we like is Ulta, actually. We see it as a best-in-class retailer. We have a term that we use here at D.A. Davidson called best-in-breed bison. It's really our top long-term ideas. We would put Ulta there. And the stock has underperformed year-to-date, as you see there. It is now the cheapest name in our space on a PE basis, except for Best Buy, which always trades at a discount. So the multiple is really compressed. We think that's an opportunity. We get that they've lost a little bit of market share this year to Sephora, but we think that's well known in the valuation. And in fact, we think that Sephora headwind sort of levels off now. Sephora built a lot of stores in Kohl's over the past year. You're now starting to cycle against that. We think those market share losses sort of even out. And you're left with the name trading at 14 times, far below its historical averages. And so we think that's an opportunity.
Okay, we'll check in with you then after the report, pounding the table on Ulta there. Michael, thank you. Michael Baker from D.A. Davidson. We'll stay with the consumer theme. When it comes to autos, are you spending more on your car payments? You are not alone. Phil LeBeau is here with some new surprising numbers, and you've been tracking this, Phil. It's getting worse?
It actually has slightly, I mean, when I say slightly, like $2 better in terms of monthly payment improved, but it's not getting any better, substantially better. But the numbers from Experian, I love these numbers because this is what we are seeing when people are going out and they're financing a new auto loan. Experian says in the first quarter, generally speaking, the average amount, just over $40,000 was financed, just over 67 months in terms of how long you would take to pay back the loan. And your average monthly payment, when I say, Sarah, better, it was $738 a year ago. So, okay, $3 less per month. But we are seeing the pace of sales. We're going to be at the best year since 2019. That's good news. Having said that, look at the average number of people who are paying more than $1,000 a month for an auto loan. 16.1%. That is stunning, in my opinion, 16.3%, a little bit better than last year. But this is a reflection not only of pricing on vehicles, which has slightly come back a little bit, but it's the cost of financing. I mean, even with a new car loan rate, and the average, I think, was 7.3%. That's the average. I mean, it's just, this is what you pay now if you are buying a new vehicle. Hasn't hurt the auto dealers. I mean, look at these stocks over the last, since the beginning of 2019.
Pretty strong.
That's been the business to be in.
Pretty strong numbers given that incredible increase in monthly payments. Not to mention, by the way, all the other costs that we talk about so often, including, of course, auto insurance.
Yeah. You put that all together, what you are paying every month for your vehicle it's well over $1,200, $1,300. I don't know what the exact average is, but you bring up a great point. Auto insurance is through the roof, especially on a newer model. And if you're paying over $1,000 a month on your loan, you're buying a high-end, very expensive vehicle. Your rate is going to be even higher for insurance. I mean, it is a reflection of the times we're in.
Then why are we seeing headlines like car makers dangle big discounts as inventory swells?
Because what you're seeing right now is that they have built so many on the higher end that increasingly where people really want vehicles right now is that lower end mass price, 45 and under. And the automakers, they're getting there because of the greater supply of chips, but they're not moving fast enough, in the opinion of many people. And when I talk with dealers, they say the same thing over and over again, which is the days of people coming in and saying, okay, I'll take the higher trim level, that's gone. I think people increasingly are saying, I want this vehicle, can I get the mid-trim? Not too many people buy base models, but they want that lower priced trim.
I was just thinking about the Texan thing the other day. You mentioned, David, with Elliott, right? And car makers and getting those analogs into lower price models.
Yeah. Well, what was the inventory glut now is no longer the case, but yeah.
And it's certain brands, certain models. Jeep. I mean, the Journal had a great article about the dealers complaining about the inventory of Jeep models that are on the lot right now. And this ebbs and flows. Some brands, they keep pumping out, and they're not going to bring down the discounts until they're forced to.
Phil, thank you.
Good to be here.
Always good to see you here.
Mm-hmm.
Good to be here.
Yeah, it's great. All right, let's switch gears for a moment, although we'll kind of stay in Autoland really a little bit. Tesla CEO Elon Musk has agreed to testify in the ongoing SEC probe over disclosures related to his $44 billion takeover of Twitter. Now, Musk had refused to attend an interview in September, and he said the SEC then was trying to harass him, but apparently he has now agreed. Of course, he did end up buying it after a long back and forth that I very much enjoyed reporting on during that period of time.
What are they looking into here? What is the concern? Do we know?
Not really sure exactly what their problem is at this point. I mean, you can go back, of course, to when he said he was going to buy it and then didn't. But I mean, this goes way back from when he, remember, the originally when he said he was going to take it private many, many years ago, that got him into trouble with the SEC.
Take Tesla private.
Yes, that was Tesla at 420. Thank you. But as for Twitter, yeah, I don't even know. I don't even know, Sarah. I've ignored
that he paid a really high price.
The focus for me has been on Morgan Stanley and the $14 or so billion, along with other banks that they lent to him to help finance that transaction, which they have been unable to really move, certainly at any level they'd like to move it at.
Meantime, after the break, fueling the AI boom, Amazon, Google, Microsoft striking a new deal with Duke Energy to supply their rapidly growing data centers with some clean power. Duke's CEO is going to join us to discuss what that means for her company and investors in a moment.
NBC. Welcome back to Squawk on the Street. Utilities, the best performing sector over the last 3 months. We've been talking a lot about this on the show. Goldman Sachs out with a new bullish call this morning saying the gains can continue, arguing utilities offer AI and defensive exposure at, quote, undemanding valuations, and that in the long term, AI-related power demand could lead to big EPS growth for the sector. Canaccord also out with a new note saying, quote, we are set to hit energy bottlenecks as it relates to AI deployment. either data center buildouts and GPU consumption have to slow, or the deployment of energy resources that will power them has to accelerate in a big way. It's been a big theme. Utilities, all of a sudden, the new sexy story in town. Who would have thought?
Utes.
Utes, as they say.
These new notes come as Duke Energy announces some deals with Amazon, Google, and Microsoft to supply clean energy in response to growing demand for data centers. Duke Energy Chair and CEO Lynn Good joins us this morning to discuss. Lynn, it's great to have you. I don't need to tell you, the street's obsessed with this this notion of securing long-term energy security, and I guess in this set of memorandums of understanding, a lower rate structure. Can you talk about the construction and what it means?
Sure. You know, this is a period of growth, and the comments that you had leading into this, we're seeing growth everywhere. Artificial intelligence data centers being part of it. But frankly, at Duke, we have a more diversified growth story with chip manufacturers, battery manufacturers, pharma companies. It's a moment when the industry is really growing, and you're beginning to reflect that in the story about the utility industry. So as we face this growth and have an opportunity to work with customers like Amazon and Microsoft, Google, Nucor, an existing customer, all of them existing customers of Duke, we've begun talking about partnership. How can we not only power this growth, but also help these companies achieve their clean energy transition in a way that is affordable and competitive? Can we work together to bring emerging technologies to the table and lower cost? So I think it's an extraordinary opportunity where innovation and growth are meeting, and we're excited to have an opportunity to find ways to accomplish their objectives and, frankly, Duke's objectives to continue building clean energy.
Can you give viewers a sense of how much of the load is data center and where that number is going to end up in 5 years?
So today, the load is about 2% of what Duke Energy supplies. And we see it doubling by 2028 and probably doubling again by 2030. As I look at the growth that we see between now and 2028, it represents 25% of our growth. Those other items, chip makers, battery manufacturers, the onshoring of U.S. manufacturing is also contributing to our growth. So it's important, it's growing, it's beyond what we've seen in decades, Carl, but it represents a piece of what is already a growing list of industrial and, frankly, population growth. It's also spurring growth at Duke.
How much are these tech companies investing to develop this power? Because it reminds me of the deal we saw from Microsoft, which is investing $10 billion with Brookfield to develop renewable alternatives for powering data centers. So do you have a sense of just how much money we're talking about?
Sarah, I think we're early in the process. You should think of this as a framework for customized solutions for those customers coming to our area, and it can take a variety of forms. It could be direct investment. It could be innovative financing opportunities. So the specifics will be ironed out in the weeks and months.
Check one, two, check one.
I think what this demonstrates, though, is the willingness of partnership between Duke Energy and these customers to find a way to fuel the growth, but also lower the cost of clean energy technologies over time.
So, Lynn, it's David. So, I mean, you say you're working together. I assume you have plans then to meet, because obviously this is just an exploration. You've made that clear. It doesn't necessarily mean you're going to get to some sort of conclusion of some big answer.
David, we've been working for a long period of time. And as I said a moment ago, existing customers of Duke, we've had a relationship for a period of time. So our hope is that this accelerates with some specifics that we can put a framework around in 2024 and then begin moving more quickly to get infrastructure built, assets on the ground, so that these customers continue the growth that they're keen to achieve.
Well, Lynn, back to the bigger question. I mean, how worried are you? I'd cite a recent report, I think, from the Electrical Reliability Council of Texas, ERCOT, which said, over the next several years, mostly due to the potential demands of data centers, they think there could be a looming grid disaster in Texas. So I'm curious what you think in terms of the regions you serve.
Our job is to keep reliable, affordable power flowing, not only to these new customers, but our existing customers. And David, we have a very disciplined approach in all the markets in which Duke operates, where we are putting resource plans, working with stakeholders to find a way to keep the growth powered in a way that our customers expect. So that is an everyday job, and frankly, accelerating everyday job because of the scale of the growth that we're seeing at this point. So you should think of it as something that's a high priority, not only at Duke among our customers, but also, frankly, in our states.
And the country as a whole. No one wants to be behind the 8 ball on this one, Lynn. We hope you'll come back often and give us some progress reports. Thanks so much.
Thank you. A pleasure to be here.
Well, we have a massive run for Dell shares this year as investors get bullish on the company's AI exposure. But that said, some are calling it an AI faker. Let's get over to Christine Partsinevelos. She has more on what that exactly means. Christina.
It's a good catchline, AI faker, AI poser, but can you really believe that Dell's share price has just soared, even past NVIDIA over the last year, so 12 months, and the stock has really jumped over $200 just since last week on optimism around its potential to capitalize on the AI boom through its server business, which had a near doubling of backlog orders just last quarter. But as you alluded to, David, is Dell a much less levered story to AI, as Bernstein writes, or an AI faker, as one Mizuho analyst calls Dell? I want to start with the recent stock drivers, why we saw it go up just recently. You can see that little spike in May. Call it the Midas touch of NVIDIA, pixie dust, whatever you want to call it. The stock jumped after NVIDIA CEO lauded the strength in their server relationship on stage last week. NVIDIA chips need to plug into servers, which could boost Dell.
Hang tight, guys. I got to make one more phone call.
That relationship. Secondly, Microsoft AI PC announcement last Monday with Qualcomm helped the PC refresh cycle sound more convincing as an earnings boost, because so many companies are pushing that, like the AI PCs are going to be the next big thing. But Dell's core business of roughly 60% remains heavily reliant on PC and monitors, which means that AI boom may not be as beneficial as thought. And if we look at NVIDIA's gross margins, they hit 78% just last quarter, or just a week ago. That means it's costly for Dell and could be more dilutive to Dell's gross margins. There's also caution going into the earnings. You can see the sell-off in today's stock price down 7.5%. But for our retail investors or anyone listening right now, you want to look for a backlog on orders right now and an increase to its full-year guidance for this stock to continue rising on that AI optimism. Guys?
Doesn't it end up always being about NVIDIA? It certainly feels like it. Although it is down 1% today, Christina.
Exactly. So let's blame NVIDIA for any losses in the market and nothing to do with inflation or anything like that. But just one point. If we're going to talk about AI PCs, HP Inc. is a good example. Their stock is up today. You had, for the first time, an increase in PC sales in the last 2 years. So that's pretty strong. And the CEO did say AI PCs would be about 10% of sales in the second half of this year. So that's still not a major boost, but they do see more of that coming in 2025, 2026. So something to keep in mind for Dell's earnings tonight.
Yeah, looking forward to those earnings, of course, as you point out, PCs and the all-important servers. Christina, thank you.
Thanks.
Don't miss, by the way, the CEO of Novartis is going to be here with us tomorrow. Want to check in with Oz Narasimhan as well. As for our broader market right now, we've got the S&P down 0.5%. We've talked about the losses in the Dow, which should be largely ignored. Obviously, they are due almost solely to shares of Salesforce, which, as you might expect, the next hour will cover very closely, and, of course, the broader market as well after this.
now.
Tool of power. Yes, ringtone. Still don't know why. Set as silent. Allow notifications. I don't know what set as silent means. Silent notifications will not be shown on the lock screen or in status bar, and you'll not be alerted by them. You can view them only in the notification drawer. I don't know what the fuck that means. Forum notifications. Vibrate. Oh, set as silent, maybe? I don't know what I'm doing. I suck. Or just, I think it's just too many options now. Incoming calls real time from Discord. Nope. wait a minute. That might have worked. Okay. Live caption. Text, speech, in your voice, and automatic generates captions. Allow notifications when do not disturb is on. Ringtone app default. All right, what is it? I don't hear any ringtone though. Oh. Oh yeah. Too many fucking options. Break messages. What's my default ringtone? All right, I don't know what the fuck I'm doing. I just need to get a goddamn iPhone. Fucking Android, man. Oh, just come into the fold. I should just join the sheep.
Made affordable.
Search at any time. We'll do the math and prorate it. Server boost $4.99 each. One or two. Well, so what I was doing was I was subscribed to Nitro and whatever the other thing was. There's two of them, right? There's like I was subscribed to two of them, and then I was doing it wrong, so I deleted them all. And then I thought I sent you an email, or I sent you some kind of a question about the boost in the other one that I was on. And like, if you do like the way I was doing it was costing like double. Like the subscriptions that I had for the server, I had two different subscriptions for the server, and I did it wrong, or I did them independently, and so it was costing like a couple $100 a month. Okay. Okay, so I'm gonna go subscribe to Nitro. All right, so yeah, I've got Nitro, server boost, subscriptions, gift inventory, billing. Nitro says join Bork on Nitro. Nitro Basic $2.99 a month. Nitro Regular for $10 a month. Which one? Okay, subscribe. Yearly $99. I think that's cheaper, right? Yeah, I think it saves money or something. So it's a. Let me make sure I got this in the right card. What's that? I got 2 free months, bro. Hold on a second. All right. Okay, I got nitro, best nitro for the year. Activated. Sweet. Done. Oh, yeah. Let's server boost. Level 1 is my current. Level 2 is... Oh, no, 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 no. Oh, no. Hold on here. Oh, no, no, no. Sorry, guys. Hold on a second here. Hold on one second here. Break time, be right back, you old man. Sorry about, I really apologize for that out there. I've got like, so, the, so, yeah, I don't know what to say. So like kind of good at Discord, and then I'm kind of suck at Discord. But you know how you have like everything's a garden, right? Like everything's a fucking garden today. Like to use anything, it's like, oh, you got to do this and you got to do that and you got to do this and you got to do that, and then they don't all work together. So Bork is like my right hand man, right? Basically, he's my right hand man, hands down. And we have like conversations going on everywhere. We have like a conversation with other admins, then we have a conversation with like Joe and I, and then we've got conversation with Kaiser Soze, Bork and I, and then we've got like an admin channel with a conversation. And then I've got a phone that's an Android, and the Android is like, lets you do whatever you want, right? Android's like, unlike Apple, Android's like, well, you can mute it here, and you can mute that there, and you can mute this over here. And Discord's got little quirks about it. Like if I have Discord open on a laptop somewhere, like in my house somewhere else, I won't get pinged on my phone, and then I've got it muted on my phone on like a different level. It's not muted on one level, but it's muted on a different level. So this past week, Bork went on vacation, and I went on vacation this weekend, and Joe got to me and was like, hey, man, people feel like you're ignoring them in the Discord, and specifically Bork, because, you know, Bork, like, funnels things to me. And I'm like, I'm not getting anything from you, man. Like, I'm like, so I'm talking to Bork, and I'm like, I'm not seeing any mentions in my notifications, and then I'm like, I'm checking our DM conversations, and there's nothing in there. We haven't chatted since like May 16th. And like meanwhile, Bork's like running around the Discord being like, hey, at CaptainJimJames, at CaptainJimJames, and I'm not getting any of it. None of it. So you know, you don't want to be intentionally or even perceived as intentionally ignoring people. Anyway, at any rate, so when everything was unmuted, like it's just constant. It's like 24 hours a day. Ping, 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 ping. Like people ping me all over the place, and I'm a member of other Discords too. So I get like pings from other Discords, and then I get I get DMs all day long on Twitter, and it's just like, if I had all of my stuff unmuted, it would just be when I used to have it unmuted, I'd get like just from people, I'd get 200 maybe between like text messages, phone calls, Twitter alerts from 3 different accounts, Discord pings from like 10 different Discords. So and then I was on stream, and it was just like constantly pinging all day long. And so I started hammering the mute button in the wrong places. And then now, of course, I'm not getting the pings that I actually want to get and need to get. And then on top of all of that, like 2 weeks or 3 weeks ago, I was looking at all of my Discord servers that I have, and I've like signed up for a couple different subscriptions, and compounding them and then not using them on other servers, it was costing me like $600 a month or something stupid like that. It was pure insanity. I'm like, this is way too much money to be spending on servers I don't use. And the way the configuration of those subscriptions were. So what I did was I blanket deleted it all and said, oh, I'll get back to it. So then I talked to Bork like a week or two ago about it. And then like the conversation drifted away. And so the Discord hasn't had a Nitro subscription for like 2 weeks. So we just fixed it just now. So it's done. And Bork can reach me even if I'm on the shitter or if I'm emptying the piss bottle out in my piss bin outside in the backyard. Yeah, iPhone's easy. Android has become like crazy. Android has like multi-layer muting that you can do. It's got like system level muting, then it's got app level muting. Then I noticed also today that everything is set to my default ringtone, and my fucking default ringtone is off, or it's like nothing. So I had to go through like every layer of it and make sure it's on. So now Bork, if I'm like hiding myself in a closet and jerking off because I don't get laid or something, it'll just go ping. Here I am. This morning, I got some other fucked up shit to talk to you guys about. So yesterday on the close, I was trying to add more calls on Robinhood, like at like 4:14 or whatever, like near the close. So I fucking sold instead of buying, I sold calls. Then I panicked because I didn't know what I was doing. I thought I was buying calls on the bell, on like the after bell, the after hours, like extended hour, like 15-minute, whatever. And I fucking sold like half the calls that I bought. So then I had to go back and rebuy them before the market ended yesterday. And they're torched. They're at like 2 cents or something like that. So now I've got like 15 calls or something like that for SPOOs for today. I think they're 532s. So I did add, I sold by accident yesterday and then added, because I don't know, like Robinhood, I haven't used Robinhood in 2 or 3 years, something like that. And I'm like, yeah, I'm going to test out Robinhood today. And then at the end of the day, I even fucked it up. So I do have some calls dying on Robinhood today. Now, we have a bunch of stuff to talk about. I don't know if I can get to it right now. I did put most of it in a market brief last night. If you are getting those market briefs, I ask that you go through that market brief last night and review it, as there's some very important information in there as to where we are and where we could possibly go. Now, today, I don't know if we actually go up today. There's a high probability likelihood to being end of the month that they pin this shit, that we don't move at all. We just park right here and don't fucking move. They could move it today, they could move it tomorrow, or we might be close enough to like 520, or if it's 525, they bring it up to 525, and that's it. There'll be no move. There's a real high probability of no move. Not only that, any of you guys that are long-term traders know this. When you come into end of the month, typically if we trade up into end of the month or trade down into end of the month, either one, they will park it for oftentimes 5 sessions, and then you get your next move. So what'll happen is they'll park this for today and tomorrow, and then next week you'll see high volume come into the market for anywhere from 3 to 5 sessions, and we'll start moving again. So they will bounce us around in here like a rattle can for from here upwards of, from this point, 5 sessions. Now we should be squeezing too. I even checked in with a buddy of mine yesterday. I was talking to a friend of mine who I was asking about the no movement, and he's in agreement with me. We should be moving, and we're not. So I'm still scratching. I'm not scratching my head. My thought process here is goes back to the Sunday brief, this past or Monday night brief, where I think Friday and Monday in both of those briefs, it was highlighting to you that JPM and a couple other banks were on the vol trade. Like last Friday and then Monday brief, if you go back and read those, I highlighted that they were on that volatility trade. So you figure if we're coming back on Monday or on Tuesday, right? Come back on Tuesday, we've got an expected moves. Like under normal conditions, we should be moving this way and this way and this way, right? And the fact that we have low participation in the market this week means that a market participant can come into the market with enough size in buying or selling and manipulate the market and get the amplification of dealers helping them while in a no volume environment, regardless of where markets should go, and manipulate price on the market. And if you noticed last night, and also, let me see if I can bring this up. If you look closely last night, and I looked at this early this morning, just take a quick peek at this. If you notice last night, let me see if I got this here. See if I get this correct here. If you notice, let's see, today is Thursday. So we had a huge move down last night. Then we had another huge move down between the 28th and 29th, right? Big move, after hours move down. Big move, after hours move down again. That's abnormal. And so this is manipulation at its best. And to boot, I showed you earlier this week that NVDA carried the market as the market went down, or not the market went down, but as equities were sold for 7%, NVIDIA was bought for 7%. So there's high manipulation going on in the marketplace right now. If I had to guess, there's likely 2 or 3 banks right now that are manipulating the marketplace in a low volume environment and using dealers to their benefit at this moment. Now, a key point in this is those same firms that said they were going to do this on Friday, Monday, are also saying that once we come back into this high volume environment on Monday, this upcoming Monday, that they're going to look to do this once more again into the middle of June, right around the 9th, 10th, and 12th. And they don't think they can get this done until they have some events, until some events pass. I'm going to read them off to you right now. I'm going to post this inside the Discord for you right now. Hold on. I'm going to post this inside the Discord for you guys right now so you have it. This post from this, I think this was from yesterday. Yeah, so there's some people that Miguel got talked about this last Friday and on Sunday, Monday, I think. Now I'm gonna talk about Miguel got talked again today about this, but I think he's wrong on this one for sure. So your people are reading too much into this, I should say. So hold on a second here. So this was known on. I want you to know this. I posted this in a market brief on Friday and on Sunday or Monday night for this week. So this chatter has been going on for since late last week, where there was a concerted effort to drop the market this upcoming week and taking a vol trade this week while everyone was away on vacation. They were successful, of course, right? But there was another note that came out yesterday. Let's see if we can find it right now. I did post this one. So JP Morgan is, so JP Morgan was on this trade like a week ago. Miguel Gott was on the trade as well, but let me read this to you. So a quiet start to the week with NVDA, the clear standout, adding 7%, now up almost 19 since reporting earnings 3 sessions ago. It felt like the stock has single-handedly propped up markets, which I showed you that chart of that happening, right? I showed you that I showed you the chart with the equal weighted 7% decline in the S&P 500 versus the 7% increase in NVDA, right? So it felt as though the stock single-handedly propped up markets, begging the question, what happens if we see material profit-taking in the name or in the semis, Mag 7, more generally, right? Question mark from JPM. They were on this vol trade heading into the weekend. So should we witness that, then do we see another 5% pullback? So you have the pullback this week, right? And then the short answer to this question is yes, you will. You will see this 5% downturn. But things remain tricky. This is from JPM, okay? Things remain tricky. Highlight that. Boldface, right? And this is the key point here. Apple has WWDC kicking off on June 10th. NVDA's stock split comes into effect on June 7th. So you've got the split on the 7th. You've got the Apple event on the 10th, right? And you've got NFP ISM services on June 7th and CPI Fed on June 12th. So investors seem more likely to wait for that data to hit before making a big swing. What they're saying to you is that you have beginning of the month flows coming in. It's dangerous to be short for a downside move on those beginning of the month flows. And then you've got events that are risky to being short all the way into June 12th for that next short to the downside for a further correction. So when does that start? I don't know when that starts, but they're going to make that effort to send this market lower one more time by mid-June. So if you are short right now in this market, you are going to be looking for a bounce at 520, 523-ish, and another trade higher to like 532-ish, and then hit it again for the middle of June for that 5% drop. And I think that puts us at, I measured it last night, I think it puts us at 510 or 500. No, I think it's 500. I think it puts us down to like 5,000 at least, something like that. So just be conscious of it if you are short the market, that as we roll into Monday, Tuesday, Wednesday of next week, and then these events, you likely have too much participation. Sorry, I'm losing my voice already. We likely have too much participation for the move or for the amplification for the downside move in the indices or the or equities or whatever into next week. Though I did post last night in last night's market brief, I showed you. I'll bring this up real quick for you if you want to see it. Hold on a second here. And actually, I'm going to highlight something before I show this to you. Now, knowing all of that last Sunday, right? Last Friday, last Sunday, and then highlighting it throughout the week, two other things popped up. Diamond saying stagflation. I highlighted that for you last night, what that trade would look like, though I'm not believing in that trade. I'll get into that later. But then the second part was this morning, Nomura's Miguel Gott came out and said more. So they're pushing now a narrative of not the 5% drop, but of course, chatter is out there this week. Oh my God, we're going to crash. Where it's doom and gloom, right? But I think it's more that people don't realize that this trade is on right now than it is what the reality is. So Miguel Gott, though, is saying, big picture, the story is that U.S. equities index vol regime shift is continuing in real time. Remember earlier this week when I showed you that vol, the at-the-money vol curve for SPX, and it was really fucking low. It was low. It was low for the entire month, right? Remember I told you that Miguel Gott said there's a vol trade coming on to the market that participants are going to jump on And he's now saying from extreme flat skew to now, sharply steeper skew equals potential for larger drawdowns and crashier index moves to the downside after what's been 1.5 years of crash up only. And this skew shift with relative demand back into downside goes hand in hand with a shift back towards the more traditional negative spot versus vol correlation, either spot up, vol down, or spot down, vol up, which along with the call I vol getting mushed will see markets look more escalator up, escalator down as we move forward, i.e. grinding rallies, but larger magnitude sell-off potentials. That shit looks a lot like that stagflation trade. If you guys know anything about a stagflation trade, it is like you just grind. It is like grind. And the worst part about the stagflation trade is, if let's say you start here and you end here a decade later, you don't really ever leave this range. You're like in this range right here, right? And you will literally like grind. Just grind. This is like a year. I'm not kidding you. Then like grind for a year. And then like grind. And meanwhile, you're in between like 5,000 and 3,500. You don't fucking move. You're like right in this middle. No significant. No. So and I think the idea here too, the easier way for you to understand this would be if you're in like a 1.5 to 3.5 year bull run, and then you have a market crash. Those go out the window. It's just you're just like fucking sideways for like 10 years. Now, do I think that's real or it's going to happen? I don't know. I can't think that far out in time. The thesis right now for the market seems to be that we're in a bull market, right? We're in a bull run, and that something bad is coming in 2025, 2026, somewhere in there. I'm still on that trade. I'm going to tell you why. I'm going to tell you my reason here in a moment, but I'm still on that trade, and I am not on this stagflation trade or this grinding higher and then this straight grinding down trade that's being discussed and pushed around out there right now. And I'm going to tell you why. I'm going to make it really simple. I can simplify it for you. This is not the same market that the 1960s, 1970s were. It just is not. We have crypto, Bitcoin. We have way more retail participation. So like that stagflation trade, you might like the gold trade. But like you might like the bond trade. Like, yeah, I'm going to buy gold and I'm going to buy fucking bonds and all this other shit, tips and all this other stuff. Most people are not going to do that with you. Nobody wants to do that. That's like 1960s shit. That's like, I'm serious. Like your bond trader is dead. Dead. That guy from the 1960s and 70s is gone. You did not have the tech revolution in the 1960s and 70s. You did not have pumper bros and tech bros and Elon fucking Musk or any of these other fucking things. You didn't have retail traders with instant access to the fucking internet. I'm serious, like dead serious. And retail traders are like 20 to 25% of the market right now. Even though you'll hear a guy like Jamie Dimon out there fucking sucking himself off, telling himself that they got the fucking market by the balls, that is false. We saw that when Softura came in and pushed around, SoftBank came in and fucking pushed around the market like it was nobody's business. Retail can push this market around like it's nobody's business, whenever the fuck they want. Not whenever the fuck they want, but they can easily. And I want to tell you one other quick thing. The fucking banks are wrong all the fucking time. They fucking get it wrong so much it's not even fucking funny. So I don't think we're in that market anymore. I don't know that you would see like retail traders, like retail traders might have to go back into buying real estate and renting it out and shit like that. That's the stagflation trade. If you guys don't know what a stagflation trade is or how to historically trade stagflation, it's very boring. It's an absolutely boring fucking trade. It lasts like a decade. I just don't think it's there anymore. I don't think our markets are the same, and I think he's out of his fucking skull. To be quite frank and honest with you, to think that this is the same market. And to prove that point even more, we did not apply modern monetary theory in any way, shape, or form like we did back then. Nothing today is the same. Like, none of it. None of the growth in the marketplace. No one's going to accept that fucking trade for 10 years. They're just not. I'm sorry. They're not. It's just it's a fact of life. And I got like yesterday, I made some phone calls yesterday to people I trust, and I'm putting a call, all right, I should say I made a DM to a guy. I don't know if he's going to do this for me, but I'm going to try to get this guy on the show to talk to you about this, because this guy's been in the market since the 1960s, 70s stagflation trade, and he's a professional. And so if I can get him on the show, we're going to try to talk with this guy about this trade, this Jamie Dimon hype shit that they're going to do the stagflation trade. This guy, the last time they were taught, so like about a year ago, there was a whole fucking discussion about the fraud and the implosion of the Treasury Department, and fucking how the fraud is going to stop. Yellen when all these other fucking Fed and Treasury people were acting like they weren't gonna. They were like the days of monetary easing are over. Remember that? The slush trade is over, right? Bullshit, right? QE, never doing that again. They're doing it right now. They're lying to you again. And I'm not gonna tell you his name until he says yes or no. But that guy did an interview like about a year or two ago. I think it was the end of 2022, and he was like, they're fucking lying to you. He's like, they're fucking lying to you. The fraud is going to continue. So we'll look at that stagflation trade here in the next week or two. I'm going to try to get him on the show to find out if that's bullshit or not, because you hear that from these people. You hear like Jamie Dimon opining about this shit is horse shit, absolute fucking horse shit. Like these opining, like reminds me of Dalio. You know? Yeah, I get it, Dalio. I understand now the concept of a long and short-term debt cycle. He did a good job. That motherfucker's been calling for the end of a long-term debt cycle since 1980. I shit you not. I shit you not. Like the big one, like the depression one. I shit you not. If you go back and look, you can literally go back and read the articles from Dalio. You can watch the videos. Every 5 years, he fucking rolls this shit out. It's a great concept, but the timing of it is like, I don't know. It's like him having a car and driving towards a giant barn and missing the fucking barn 10 times. The clock will be right eventually, but they're not right most of the time. And this whole stagflation thing, I'm suspect of it. And we're at the end of a housing cycle. An 18-year housing cycle is coming to an end, and I know these fucks are greedy. They're the greediest. They will run shit up in this since 1978. Since 1978, they have been whoring this market out. They have lied since that time period. It is now 2024. 46 years of whoring the market out. These guys are still alive. They've been doing it this entire time. They have lied the entire time. It's like who's the other guy this other guy I make fun of with the PE ratio. Every time they come down, they buy the PE ratio, and he goes on CNBC and he tells people, we're not going to do this again. And they break out the cocaine, pour it on the table, and they start snorting it. So I'm not believing these guys. I'm not going to believe these guys. They do modern monetary theory. They devalue the dollar. They're going to continue to devalue the dollar. They're going to do it until it fucking breaks. You can't trust these bankers. You can't trust any of these participants. Once they got that cocaine going, I'm serious. When they got that cocaine going, when the tax code started to change, you started to create like serious wealth through the destruction of our tax system. They never stopped. They need more gas for the fucking helicopter. They need more fucking gas for the jets. They need more gas for the fucking hookers in Davos. They need more hooker. Instead of a 6-foot tall hooker, they need an 8-foot tall hooker. That's why it was a disaster in 2008. They will whore it out again and again and again and again. Dude, Jamie Dimon yesterday was complaining about private credit to businesses that don't qualify under traditional metrics, right? And then at the fucking tail end of that shit, you find out that Jamie Dimon is also giving those loans under that same paradigm. So, like they're bitching about somebody else doing it and they're fucking doing it themselves. So I think they have to say that shit in case it happens. But is it real? I find that hard to fucking believe. It goes back to Dalio, right? He's like, well, I'm going to go out there and tell him about we're at the end of a short or long-term debt cycle every 5 fucking years. So if it ever happens, I can claim that I called it. It's the same bullshit. So we'll talk about that. Now, anyways, Miguel Agot's not calling for a crash, but he's calling for crashy, like crashiest. Or what's the word he used? He uses crashier index moves. So maybe we wake up one morning, we're down 5%. So it feels crashier to you. Now, why are these guys saying that? Now, it doesn't mean it's going to happen. Why are these guys saying this is important? And this was in the market brief last night. I'm going to show it to you guys right now, and I want to show you what's unusual here. What's unusual in this specific instance. It is unusual. It's abnormal. And I want to show you this really quick if I can. Normally, when we're going through, not that one. Normally, when we're going through cyclical rotation, if we're rotating through sectors, right? When we're going through sectors, you have normal sector rotation, where we rotate into high risk stuff, right? Risk on type of sectors, and then we at the tail end cycle into risk off type sectors, right? So you'd see cycling into, let's say, tech. Just dumb it down, just tech, right? And then you cycle out of tech and into, let's say, utilities. Fairly common, right? Round and round we go. Another one would be about, a month ago, people were saying, oh, why are we cycling into utilities and financials, but not into tech? So let's take a quick look here on the bottom of my screen. And this is ES here. We can do SPY. Doesn't matter. SPX, SPY, doesn't really matter. What does matter, though, what is important about this is a market breadth indicator down below here. And no matter what doom they're slinging to you anywhere, truly, we will become oversold and catch a bounce. No, I don't want sound booster. But to highlight something here, number one, we're at 24.1%. That's important to note. Utilities are at 13.3, but tech is still at 53.8. That's unusual. Normally, you'd see tech be one of the first indexes to sell, and this has not sold. That's important. Real estate's at 9.7. Materials are at 25. Industrials are at 16. I think this is healthcare 23. Financials are at 12. That's unusual, right? See financials down, but tech not following. Energy at 18. And believe it or not, energy is actually quite bearish right now. It's actually on a sell signal right now. We have consumer staples down here at 13. CND, I don't know what that is, but it's not tech. But here's the other big one: communication and telephonic sectors. These two right here, still above 50, and that lends the question mark. If those two sectors make up most of our market today, and we liquidate those two sectors, that things could get spicy. Things could get spicy around here, right? So this is S&P 500 SPOOs, right? We got top to bottom right here. Let me show you this right here. So from peak to trough right here, boom to boom for this move is 1.79%, right? That's not the 5% that Jamie Dimon's talking about. So let's say we did have a recovery trade, right? You move up here, and then Dimon's 5%, where does that put us? I bet it puts us right here. I'm going to bet that this is a 5% move down right here. So let's take a look and see what percentage that is. See if we can figure out what Dimon's talking about. Come on now. Come on now. 4.5%. So that's 4.5% right there. And Dimon's talking about another 5% move down. And to that point, let's say we traded 53.20. Right there. There's your 5% right there. Almost perfect. Almost perfect. And where does that put us? That puts us at a failure of a new high up here. Gives us our 5% move down. And so if we get this, you figure into next week, we get a relief rally and some high volume. Right? We come into next week. Today's Thursday, right? They park this thing for end of month. We get some up and down movements in here. And then all of a sudden next week, middle of the month or something, bam, we wake up and we're down 5%. You actually hit the McElligott crashy terminology. We just wake up one day and we're down 5%. That would be kind of a shocker, right? No staircase, get the vol rolling. We're just like literally like one big straight red bar down, maybe two, right? 2% one day, 3% another day, 0.5% or something in the overnight hours, something like that. So be aware of this as we come into next week. They're planning this trade into middle of June down here. And that actually puts us where? That puts us at 5,000. So the 5,000 trade, this gap has a high probability professionals are saying that this 5% trade, they're going to get on this trade into the middle of June. Just be aware of it, that it's in front of us. Be aware that CTAs are backing off a little bit. Institutions are still buying, but just be aware that CTAs, vol control gang, all those guys are kind of out of the picture. This is very probable that we'll make that trade into the middle of June at some point. Whoop. If you don't know what I'm talking about here, if you're in the Discord or if you're in the stream, if you are a supporter, you have this information already. I gave it to you last night in last night's brief. If you're like, hey, Kappa, you wrote so much shit that I couldn't get to it or read it, make sure you get back to that brief at some point today or tonight. And yeah, if you're a supporter, you already know that we're maxed out on weekly Velo too, right? Did you guys see that? That weekly Velo, we're at plus 50 on weekly velocity right now. That's dangerous. Well, that is very dangerous for the market. It's showing that on a weekly basis, we're very weak, though our monthly and quarterly is fine. So I'm in no way on crash trade. No way I'm on crash trade. I mean, full on fucking zero, because we are not at the top on monthly and quarterly velocity. I want to see that monthly velocity maxed out before I'm on crash risk of any kind. I don't have any zero examples of us. Zero. Without quarterly or monthly expo or monthly velocity being at plus 50 or higher. Not a single example in history. So I'm not on that trade at all. Like crash, we're going down to zero, 3,500, any of that kind of nonsense. It can feel like we're crashing, but we're not going to crash. So if you're looking for that trade, I don't see it anywhere. Not right now. But on that weekly fucking basis, I do see that weekly getting weak. That weekly shit, that shit's going to take us to 4,800 at some point. Abso-fucking-lutely down the road. Not right away, but down the road it will. What else I got here for you guys? I think that's it. I got to get back to, I have to get back to a couple meetings. I think I hired somebody today for us, and I have to get back with them today. I did an interview this morning, and it went very well. So I think we have someone joining us as of today. I'm not positive that's today. I think I have to do some, like, spend some time with her and make sure that she's up to speed for everything that we need. So I have to get back to that, and I have to get back and have a meeting with Bork today. But I'm not expecting much right now. So we're trading sideways. We haven't fucking moved all morning long, right? Just been parked. Market is literally parked here. Another note here. I think that's it. So I think that's all I got for you. So that's it. What am I hiring for? So they're not hired yet. So I am, I don't have live streaming all day long, right, is a challenge because of the time intensiveness of it. It's very intensive streaming all day long. It's intensive on my voice, but it's really intensive on my time. No one out there that you know streams 8 hours a day. There ain't nobody. There ain't nobody. 5 days a week, right? So just that on its own is its own thing. And that alone is not freeing me up to do what I need to get done for you guys. So I need to bring someone on board that has a firm understanding of velocity, triggers, Elliott wave shit, gamma shit, a social media awareness, because I need my social media accounts, like on Twitter, to have consistency to them, posts on them, interaction on them. I need interaction in the Discord, and I need to be able to dispense information for someone else to get it to you. I need a second Jim James, and I'm looking for that person to help out, and it's been a challenge to find that person to have all of those things. It's not easy. It's brutal. So I'm looking for that person. You also have to be tech savvy. You have to understand WordPress sites. You have to have a firm grasp of all this stuff. So I basically need someone that pretends that they're me, that they're Jim James, and that I can meet with every day and say, hey, are we looking at this? Are we looking at that? Do you have a firm understanding of this? Do you understand what pair trades are on USD, Japan, Japanese yen? Do you have an understanding of that and this? And can you cover this? And then now stop covering that. Now start covering this. Can you copyright this stuff for me? You like copywriting? Can you condense this thesis that I have? Can you research this stuff and put this stuff out for me? How do you get the morning brief? They're nighttime briefings. You can go right to the website, tradethetrigger.com, and sign up for just the briefs. You can get just the briefs. We do a la carte. So if you're like, hey, I don't do Discord, I don't want to fucking get triggers, fuck your velocity, fuck your pivots, fuck you, I just want the brief, you can go right to the website and sign up just for those briefs and get those every night. Absolutely. We offer those briefs for, and I do that. Sometimes they're short, sweet, direct. Sometimes they're very intensive and thick and deep. And I write those if we need them every day. Sometimes I don't. I don't think I've had a night where I haven't done one recently. But if they're still good and there's nothing to say, I won't. But that's very rare. I normally write an essay, and that's another thing I do. Every night I write an essay. Every day I write an essay. That's on top of streaming. Then I have to do my own research. Then I got a lot of shit I got to do. So, I'm very busy. So, with you guys, I probably spend working for you guys 12 to 14, 16 hours a day. Somewhere in there. Now, let me see if I can find it right now. Yeah, let's take a look real quick. Hold on. I'll see if I can find it right now. TradeTheTrigger.com. Bam. Let's see if I can find it. So here, this is what you would do. You would sign up for, if you scroll down, right? If you scroll down and you sign up for Pro Updates. Pro Updates. Dude, I give you ready for this? For $20 a month, not only do you get the market brief, for $20 a month, you get a market brief, and then you get full market coverage with Elliott Wave stuff, gamma charts, and I'm talking full market. Currencies. I do metals, commodities, indexes, stocks, you name it. And a lot of it's seasonality too. So and I don't mean like whole market seasonality, like if we're coming into seasonality for, I don't fucking know, real estate, healthcare, any sector out there, silver, crypto, I cover crypto in there. I cover ETH, Bitcoin, and I post weekly updates, daily updates. And if you're like, hey, I want to get into this or get into that, we're turning up, we're turning down, that update package, $20 is a fucking steal. Fucking steal. Fucking steal. And then you get a market brief from myself every night. You get supplements from me, all that kind of stuff. I post once a week. You get gamma charts from me. Once a week, you get them from me. All right, cool. So yeah, just scroll down to the bottom. I'll show it to you right here. Yeah, so we've got free member, subscriber, and pro trader, and then down below we've got a la carte, basic Discord, premium private Discord, daily pivot indicator, and then pro updates. This is the one that you want right here. This actually gives you all the juice. All the juice. $20. What else? I think that's it. I gotta go. I gotta get this stuff done. I got people on 9 to 5 jobs that I have to meet with today. I can't get with these people at 8 p.m. and midnight and do the market brief for you and then call them on a Sunday and all that kind of stuff. So I gotta meet with these. If any of you guys are interested in that position, by the way, or want to join us in that capacity as like a copywriter, if you can Google search what a copywriter is. If any of you are looking into or want to do some work like that, it's remote work too. It's really cool, and I pay for that work, so that's paid position. So if you want to do that work, hit me on a DM on Twitter, Mr. Phibbs. I wanted to talk to him about the position. I didn't see a DM from him on Twitter, so maybe he's busy or he's got too much shit going on. I was gonna talk to him, but whatever. If you're out there, Mr. Phibbs, I love you. I wish you had more time on your plate, but you don't. It looks like, or maybe you forgot. Hopefully, if you're listening right now and you want to still give me a chat to talk, please do. Other than that, I will be back with you guys in a little bit. We'll be back in at least maybe next hour or so. I got to get with Bork really quick and make sure everything's running tip-top-turvy inside the Discord. And then I got some developer shit. Bork's like my consigliere with the developers. He speaks developer. I speak developer, but not that good. I suck at developer speak. So Bork's going to be the intermediary here for me today with these developers, because we got a bunch of cool shit coming out for you guys. Super cool stuff. Really, really cool. So I'll get back with you guys in a little bit. Nothing's really happening here. Coming up here to test the half-an-hour trigger on a 30-minute basis. Velocity, it's going to turn up, baby. We're going to get a nice squeeze here. We got a squeeze coming. I know that for sure. So we'll just keep watching this. This is a move to the upside coming right here. Right there. And we're just waiting for it. I'm still in those calls too, by the way. So if we do turn up and run up to the upside, we'll see if we can catch some money in the back end of this day. What else do I got for you? I think that's it. I'll be back here in a little bit. I'll put some CNBC back on, and I'll be back with you as we get closer to the end of the day. And by the way, I'm in the office, so if anything happens or anything like that, I'll be on the show. I'm here working. I'm just in the background.
Or download the app.
We're back. Our senior markets commentator, Mike Santoli, joins us now with his midday word. We said earlier, I mean, if you didn't know the story today, you tune in, you say, well, it's kind of a ugly day. Well, it's a Salesforce ugly day. But as we said, all sectors are green, but two in the S&P. Underneath the surface, things aren't as dismal as they might seem.
No, but that just means it's the opposite of what Tuesday was, which was a market that looked like it was flat and holding nicely, and it was a mess underneath, and the average stock was down 0.75%, but NVIDIA was up 7%, and so it looked like everything was fine. So this is the kind of market we have. Yields dictate if we're going to have broad strength or broad weakness, and then you have mega caps doing other things. So it feels to me like, you know, with the slightly softer than expected numbers inside the GDP report, market wanted to pull itself into a more neutral spot before we get the inflation print tomorrow.
The fuck is this guy talking about? Yields are following the market right now.
Settled themselves. I think
this guy's out of his fucking skull.
a little bit of a stealth pullback in the last couple of weeks. The majority of stocks kind of losing a lot of...
Yields are literally tracking the market. If yields are going up, the market's going up. When yields are going down, the market's going down. Yields are sideways, and the market is sideways right now.
Right now, where we closed the first.
This is how insane CNBC is.
To think that we'll get good news tomorrow in the PCE.
I think that was definitely giving some encouragement to traders, and it was almost explicitly going after his predecessor, Bill Dudley, who was out there on the tape saying, you know, policy's not restrictive right now, and maybe the neutral rate is 5%, or, you know, including inflation. So I do think that that was, people taking that to heart. You got some month end. Let's buy some of the bonds back that we sold and see what comes tomorrow.
All right, I'll see you on closing bell. Yep. Mike, thank you. That's Mike Santoli, our senior markets commentator. Coming up next, real estate with a side of fries. We're going to hit some more key committee moves coming up right after this break.
A higher percentage of Asian Americans aspire to reach management roles than any other racial.
Oil is getting extremely bearish here. If you're looking for a short olive oil.
Asian Americans represent just 3% of executives, a big drop compared to the group's 6% share of the U.S. population. For Asian American, Native Hawaiian, Pacific Islander Heritage Month, I'm Deirdre Bosa.
Another note here, too. Corporates are still buying all of these sessions. Be warned. Vol Control Gang's not in there. CTA's not in there, but HF's. They were doing a little bit of buying, but the corpos are still buying, just hand over fist right now.
Let's hit some more moves. We're busy today with committee moves. Brenda, week or so ago, 10 days ago, you bought Prologis. You trimmed waste management to fund that purchase. Can you tell us what stuck out about this name that you wanted to buy it?
Sure. So Prologis is a REIT, is one of the largest industrial REITs. REITs have been a terrible place to be over the last 4 years. They have not worked as interest rates have moved higher. But we think that this company is very well positioned. They really are a beneficiary of more and more companies wanting to utilize warehouse space, focus on same-day delivery for a lot of e-commerce sales. It may sound like that story has been going on for a long time, but it's still heating up. And we saw companies like Walmart really focusing on their e-commerce business and trying to compete more with Amazon. So we think the company is well positioned. Stock has really not done anything for 4 years. So we think this represents an opportunity. We trimmed waste management, still really like that company. Have incredible assets, landfill assets that just cannot be replaced by anybody else. The stock is it's not an exciting company per se, but the stock has been tremendous. So we use this as an opportunity just to trim a little bit and add a position in Prologis.
Okay. Kevin Simpson, you trimmed McDonald's.
Painfully. Yeah, we've owned this stock for a very long time, but the reality is the fast food isn't as cheap as it used to be. And I thought Josh was wrong a month ago when he sold it. I think you were in and out in like a day, but it was the right call. So we're trimming a position because the inflation that's affecting these prices is affecting the people in the part of society that can at least be affected by it. So if the lower end of the consumer is hurting, I mean, the president made a comment that the Big Mac was up 21% over the past few years. That's a lot. I think there was a report this morning that the prices on the average menu items were up 40% since 2019. We believe in the company long term, but we're going to underweight it at this point.
Yeah, McDonald's is getting away with murder. They have like 30% profit margins. Their franchisees have 12% profit margins. So when they decide to do something like, hey, let's roll out the $5 value meal, the franchisees are going to lose money in some cases. This is not
as they've said, right? As they said.
It's not a great environment for the name, unfortunately. I do like the stock. I did go through the drive-through with it. I was very, very, but that's on technicals, and you know, I would look at this thing again, just not right this second, I guess is the way I would put it.
Okay. We'll take a break. When we come back, we are going to talk about one of Josh's recent buys. It is a big winner today. We'll tell you why next.
investor.com and make it count.
Welcome back. Winners and losers.
A note here, Palantir is turning up right now, trading above 21.87, trading above its daily trigger.
The CEO, David Zaslav, says the company, quote, has a full buffet of sports. And that's as we're talking about NBA rights and their decision looming as to whether, to bid up for one of the packages that is maybe available.
So I was talking with Matt Bellany about this, who covers the stock as part of his podcast, The Town. The big open question is, how will the stock react when it's announced that NBC Sports grabbed the NBA rights, or if they're competing on the Amazon side? I don't fully know if they're going to lose it or will they lose it. The question is, what will the stock price do? Part of me feels like there'll be a relief rally in the stock, maybe not the knee-jerk, but it might not make sense for them to spend $2.5 billion on NBA rights right now, given that their priority has been debt reduction. I understand that makes TNT effectively useless in the eyes of cable carriers, but so what? When you have a single-digit stock price, job number one is stay in business. I like what they've been doing on the debt reduction side. I like the idea of them having some sports. It would be a shame if they lose the NBA, but I think that the market is starting to be okay with that. People seem to think it's a done deal already. So I guess we'll have to see what that reaction will look like.
Steph, when you see a huge loser like Kohl's today, even though you don't own the stock, but you may own TJX still, or you talk about that space a bunch, and this huge earnings miss and a massive decline like that, you say what?
It's a no touch. I wouldn't buy this. I wouldn't own Macy's. I wouldn't own Nordstrom. They're just not in the right spot within retail. I own Target. That stock is very cheap, and I think that they are poised to do better in terms of product assortment and pricing, that sort of thing. So tread carefully in the space.
We'll do finals next.
Feds Williams says that tomorrow's PCE is important, but it's just one piece of data.
I'll see you on Closing Bell with Jeff DeGraff, Bryn Talkington, Sebastian Page, and Dan Greenhouse. We're going to do some finals now. Brenda, nice to have you here today. What's your final trade?
Final trade is small cap stocks. Really undervalued, poised to do better when interest rates start coming down.
Kay Simpson.
JP Morgan, we covered it earlier. Best of breed, under $200. Put it away and hold it.
Bill Inkster.
Apple, see, right around the corner.
Yes, it is. Josh Brown.
Staying one corner.
So there's that WWDC trade we were talking about earlier.
The exchange is now.
Thank you, Scott, and welcome to The Exchange. I'm Kelly Evans. Here's what's ahead on a busy Thursday. Shares of Salesforce are sinking following the company's first revenue miss since 2006, almost 20 years ago. Are these just AI growing pains, or is AI killing software as a service? Our analyst remains bullish. He's here to make his case. Elsewhere, pending home sales dropping to a 4-year low. It's not all bad news, though. There's 2 names that could benefit from a housing shortage and affordability crisis. We'll tell you those trades ahead. And 3 more names on deck to report. It's been a busy week for earnings. Now we turn our attention to this one, our guest says could have gone the way of Polaroid. Instead, it's a phoenix rising from the ashes. And she's a buyer despite 122% upside this year. We'll tell you ahead in Earnings Exchange. Before all that, though, let's get right over to Dom Chu. Dom, how are the markets looking?
Well, the markets are moving, which is not what the quote said earlier on. A lot of observers might know that the S&P and the Dow for a good portion of the day did not seem to move at all through this. But take a look at the Dow Industrials right now, which are down about 2/3 of 1%, down 255 points, 38,186. The broader S&P 500 is at 52.56, down about 0.2 of 1%. At the highs of the session, we were down roughly 7 points, down about 25 points at the low. So again, tilting towards the upper end of that trading range. The NASDAQ Composite down 0.5 of 1% to 16,846. So that is currently the state of play for the major indices. Now, it's been a retail heavy day of earnings. Let's talk about some of the bigger moves. I don't have time to go through all of them, but bad news first. Shares of department store operator Kohl's, they're getting crushed. They're down about 23% right now. It delivered a surprise quarterly loss due to weaker consumer demand for apparel and footwear. Kohl's is also lowering its annual forecast. Meanwhile, on the upside, there's Foot Locker, which is up roughly about 18% or so after the company reported better than expected earnings because the sportswear and athletic apparel retailer also reaffirmed full-year guidance, citing progress on its turnaround plan and the upcoming summer and back-to-school shopping seasons. It's up big. Flipping back to the downside, Dollar General has been up and down now at the lows of the session, just down by around 5% or so. The retailer gave disappointing earnings guidance for the current quarter, though it follows a solid beat last quarter. The company also reaffirmed its full-year guidance. It's down 5%. And then we'll end on the good news, which is Best Buy, solidly higher today, up by about 12.5%. Earnings beat, upbeat guidance, that's outweighing a slight miss on revenues for the electronics retailer, which said that macro factors created a challenging sales environment. And by the way, if you're talking about Best Buy, you got to talk about the commentary and the CEO, Corey Berry. She's going to be on Mad Money later on tonight, so keep an eye on that. I'll send things back over to you, Kelly.
An impressive job they've done. You know, you go there to do podcasting. They have those Dyson hair dryer. I mean, they have everything.
Everything out there.
I was like, I'll take your word for it.
Yeah.
Dominic, thanks, Dominic Chu. Consumers are still spending, but selectively right now. That pullback reflected in new data today, showing the economy broadly grew just 1.3% in the first quarter. It was a slower pace than originally thought and the lowest level since the second quarter of 2022. Meanwhile, jobless claims, they ticked up a little to 219,000 last week. The 4-week average is at its highest level since September. So just how resilient is the economy? Let's ask David Zervos. He's chief market strategist at Jefferies, along with our very own CNBC senior economics reporter, Steve Leisman. It's great to have you both here. Kind of help us dig through some of these confusing data points today. And Steve, one of the most confusing has been this bifurcation between how consumers say they're feeling and what they're actually doing with their money.
Yeah, so we went back, Kelly, and we just did how do consumers spend during recessions versus how they spend during expansions? Because a lot of people think we're in a recession. The thing is, they're not spending like it. If you look at the data, the spending right now looks a lot more like a expansion than it does a contraction. You see how low it can go. Take a look also, for example, at credit and how people's use of credit, a lot more like an expansion than a contraction. Same thing when I look at CapEx, businesses, they're spending a lot more like an expansion than a contraction. So if we get there, there's revolving credit. We got another screen here, Kelly, that shows you what happens to CapEx or capital spending. And it's just people can say they think it's a recession, but they're not acting like it. And so one thing I think matters for politics, the other matters a lot more for economics. And I'm just not seeing those downbeat views really playing much of a role. You're right. People are changing how they navigate their way through these high prices, substituting for other products, perhaps trading down. But when it comes to the inflation-adjusted amount of spending out there, it's not a whole lot different from a regular expansion, a touch softer.
You know, Dave, yesterday we were talking to a technical analyst at B of A who noted that the unemployment rate looks like it's breaking out to the upside, and that the 10-year could roll over to the downside 3.25 if it retraced kind of this 5-year move, 38%. I'm just throwing out his numbers. If we had that kind of development in the back half, A, would that surprise you? B, how concerning would that be? I know it's way out of consensus right now, but it's kind of why I thought it'd be interesting to talk about it.
Yeah, I think it's certainly a scenario you could paint. I think the unemployment rate has been pretty steady, Kelly. We haven't seen much deterioration. All the claims data still looks solid. There's just nothing to get really concerned about in terms of an abrupt move in the labor market, and that would be something the Fed would be concerned about. But a small grind higher kind of seems like the Fed's forecast, seems like the street's forecast, probably pretty consistent with a maybe small rally in the 10-year, sort of maybe back to 4.25. But to get us to something like 3.25, you're talking, I think, catastrophe of some sort. You're talking, 100 basis points plus from here, 125. I mean, you'd have to have minus 200s, minus 300s, a kind of major shock to the system, which, is always possible. You could have any supply shock you like, but it certainly doesn't look like it's coming from the demand side.
Steve?
Yeah, I was going to say, David raises an interesting point, which is slower growth is what we had wanted for the soft landing. So you don't want to get to the place you were trying to get to and then complain that you're there, if you know what I'm saying. It's like we were looking for these softer growth numbers, looking for some payroll, some decline in payroll growth. One of the big, I think, threats out there is, does the Fed recognize when it achieves the goal it was after? And that's my biggest concern, is that we get to where the Fed wanted to get to, the soft landing, the Fed doesn't recognize it, and it becomes a harder landing.
So, not to totally pivot and do the other what if, but this is the other what if that I'm trying to think about. So, Dave, we go back to the other flip side of the coin and say, okay, or you worry about inflation. You look at the easing in financial markets, which Andres Garcia-Mayer yesterday was saying it's almost like we've had a rate cut, the way that markets are acting. Does the Fed lean hawkishly into that just at the moment when we're thinking, well, things are looking kind of mixed out there? Are they going to do what Kashkari and others have kind of been hinting they should do and start leaving more of an option on the table towards hiking rates if that needs to be the next move instead of cutting them?
I think they've told you, Kelly, what they want to do, which is, for them, staying higher for longer is the equivalent of a fight. The reasons to hike just are really hard to come by. It sounds exciting. I know Michelle Bowman's talked about it, and I know Neil Kashkari's talked about it. So it's fun to think about it. It would be a modest tweak. We've had 525 basis points of rate hikes. I mean, it's a lot. Adding another 25 is kind of, splitting hairs. We have, in their mind, restrictive policy. You know my opinion, Kelly. I think we have less restrictive policy because the balance sheet is still so big. But we'll figure out through time, over quarters and years, whether that view is correct. I think there's plenty of reason to believe that there's some slowing in demand. This kind of baseline scenario that you pointed out of maybe, the unemployment rate creeping up a little bit. The Fed gets to cut 1 or 2 times this year. That's what's baked in. That's kind of the story. And the question is, how do you get a big deviation from that? A big deviation from that would either be the scenario you talked about, which is a massive collapse in the unemployment picture, or some major shock on the inflation side.
Well, I guess
I think those are, and neither of them seem very plausible.
The third one, and I love checking in with you because Dave says, guys, go to the beach, stop worrying. The Fed's got everything's going to be fine. And I don't know if it's my upbringing. I can't think like that. So I'm going to give you the third one that does worry me a little bit. We look at the auction results this week in the deficit situation and you say, okay, how does this all factor into the developing, picture? Are we going to look back, just to your point of, hey, maybe conditions are too easy right now, we're going to realize it 5 years from now. Hey, 5 years from now, are we going to be in a situation where, we have a bad economy, worse debt picture, and high interest rates, which would kind of be the worst of all outcomes?
I'm not going to get excited yet about some fiscal catastrophe. It's been on everybody's radar for decades. We talk about it all the time. The interest expense has gone up. The interest expense will continue to go up. If the sort of story kind of evolves the way we've highlighted as the baseline scenario, rates are a little lower, the Fed's interest expense comes down. And remember, they're stopping QT. They just tapered it. The market rallied and took us to new highs 9 days in a row after that Wednesday meeting. The market went up after they decided to taper QT. Hint, hint, it might have mattered. And they still could taper a little bit more. They've got, another 40 or 50 billion they could take off the table, which I think they will. And that's money that's going to go directly into auctions, Kelly. That's money that the Fed is going to reinvest into this treasury market every month. Every month there's maturities, they reinvest and keep the balance sheet the same. So they've already started that. That should ease some of that concern. But again, it sells. It's a great story. It's a lot of doom and gloom. The dollar's going to get crushed. Rates are going to go higher. Yada yada. But it's just a broken record of people that want to hate on the U.S. situation when actually things are good.
I know. And doom and gloom would have had you'd have gotten nowhere, I guess, unless you own gold for 20 years. But Steve, kind of bring this together for us, because even as Dave is saying, don't worry, I'm hearing him say
Spoon squeezing, trying to retest that hourly trigger. Hourly velocity looks beautiful right now.
We kind of need to make sure we don't have rates break out too much to the upside. So
trying to trade 532.
What's the last word?
I think that the change to QT was a little bit curious. It was certainly more than had been expected. It was not really consonant with a Fed that wanted to very seriously bring down its balance sheet. So I think that was taken correctly by the market as something of a dovish signal, even while Powell insisted it was not. I am interested this morning, though, in John Williams, who gave a speech. I guess it broke afternoon, so it's this afternoon. He took a rather dovish take on the inflation of the past 3 months, where he said it did not represent an end to the downward progress we had made. He attributed a lot to the second half of last year, showing unusually quick declines in inflation. Maybe this was something of a snapback. And in any event, while people are talking a lot about Neil Kashkari, which I don't quite get because I don't think he was that hawkish to begin with, but I think there's room to think about what Fed officials and how they've talked about the last 3 months of inflation and their willingness to let that go and accept some of the newer data that may be coming in that could be more on the dovish side, which is to say, put on your seatbelt, Kelly. Tomorrow morning is going to be interesting with the PCE. Next week, we have the ECB might be cutting interest rates, and then the jobs report. So it's going to be a great ride.
All right, gentlemen, thank you very much. Appreciate your time today. Our Steve Leisman and David Zervos. The summer is typically quiet for the markets, although Steve just said buckle up. My next guest also expects some choppiness ahead, but with the pullbacks comes opportunity, and he's here with where he's finding it. David Harden is CEO and CIO at Summit Global Investments. David, I don't know if you just heard that conversation, kind of want to talk to us about how, so what do you do investment-wise? You just put it all in the S&P and don't worry about it? Just hope for the best? The Fed's got our back?
Oh, no, you can do a lot better than that, Kelly. For sure. There's a lot of opportunity out there, and I think you have to realize that the Fed is out there. They're looking at it. John Williams said this morning about the inflation being too high. It is a concern, but I think they're going to let it ride for a little bit. So I think being a stock picker in this market right now is really, really key. And managing your risk is going to be essential because there's going to be some choppiness. Like you talked about the PCE and the inflation numbers coming out here in the next day and week. We're going to have some opportunity where the market's going to provide. And when you're ready, it's time to pounce on some of those names.
You're a little more in the Kelly nervous camp. You note that the economic surprises have turned lower. At the same time, inflation surprises are reaccelerating. So where does that leave? So what kind of stocks do you pick in that environment?
Well, I think you have to be really cognizant of high earnings and high quality. I think you have to look for some good opportunity in a variety of different industries. I think you need to be diversified there and just make sure that in some respects your risk and return targets are well. So, for example, Qualcomm has high quality earnings. I call it the risk managed momentum. If you look at their trend, you look at their volatility, this risk managed momentum is doing very, very well for Qualcomm. And its revisions are up 5% since March 31st. So I think this is a really good stock, and especially if there's any pullback to get into here. And it's a play there a little bit in AI as well. So that's a really good one, I think. There's some other positions out there I would look at if you're looking for global income, for example. ING, I think, provides that. They have excess capital positions. They had a very, very strong results. They have a lot of income growth that was more than expected. And let's talk about this. A 9% dividend yield.
Wow.
That's a pretty good play while you wait for a choppy market. And if you're a small cap player, I'll give you a small cap one too, ASC. This is a shipping company. They have very, very strong financials, very low debt, high ratings. I think their valuation is still very cheap here. And for a small cap company, it carries a 5% yield. So I think there's some really good opportunities out there that I would look to.
You're brave. Going for a shipping name right now. You've got ING with the 9%. You're not worried about that 9% dividend? That's usually, here comes Nervous Nelly again. I don't know. Is that sustainable?
Well, it is, but I would say this. You need something to be able to look for the choppiness ahead. And this is a really good, well-run company. And they have excess capital position.
Yeah.
So I think for right now, you're going to wait out this choppy summer, maybe sell in May and go away type of thing. Maybe there's a few names you want to hold, and these are some names you want to hold. There would be some other ones that carry a lot more risk that I'd look to avoid.
I want to circle back to that in a second, but tell me top level why you track the Mag 7 versus the Economic Surprise Index. What are you looking at there? What does that tell you? And how does that inform your kind of stock selection process or tell you about the market?
Well, I think there's a couple different things that we look at, but one is concentration. We know that concentration either is going to go one or the other way, and it's either going to spread to the other 493, right? Or they're going to peter out, and we're going to have a more sustained down market. So we're cautiously, I would use these words, Kelly, we're cautiously optimistic that it will spread. But it's going to take a little bit of time. And boy, we've been waiting for 18 months now, and it really hasn't done very well. So I think we look at these economic surprises to say, is it spreading? Can we trust the rest of the index? And the reality is right now, not as much as we'd like. So really if you're in the Magnificent Seven, stay there.
Okay. All right. I appreciate that. That's a little bit of a different take. Then finally, just two names you want to avoid, and one of them is kind of a deep tease to next hour, so I want to mention it. Lululemon. Athleisure for the ladies is over. Denim is in. We'll have more about that, like I said, in Power Lunch. Target is also a name you're avoiding. I don't know if you want to mention anything. Are there retail stocks you'd buy here or no?
Well, I mean, let's face it, the retail numbers this morning, you look at Kohl's, it's really had a terrible morning, and that's too unfortunate for those shareholders. But the reality is that the whole space isn't doing as well as we'd like. So there are some names that I would avoid. Lululemon has terrible risk management momentum. The departure of the chief product officer, I think, hurts the company. It has negative industry trends, like I just mentioned. And I think they've had some market saturation. You're going to talk about that in the next hour. I think that's a perfect lead in. They have fewer new stores, their expansion slowed down. So I would look maybe elsewhere, and Target seems to be struggling with their identity and with their focus, and they're trying to get back on track. And even their individual transaction amounts have declined. So those who are shopping are spending less. So until those issues are addressed, I'd look other ways. Maybe a name that I would throw out there is like Nike, for example. I know this is a company that's a little bit widespread, still susceptible to some of these things, but I think it's a stronger play there for individuals if they're looking to ride out the summer.
Which name was it? Did you say Nike?
I said Nike.
Wow. All right. David, thank you. I was Abercrombie, but it's had such a run up. Again, stay tuned. David Harden, appreciate your time. Thank you for joining us today with Summit Global Investments, a stock picker in this kind of environment. Shares of Bank of America are on the move. Leslie Picker has the market flash. Hi, Leslie.
Hey, Kel. Yeah, this comes from some comments made by Brian Moynihan, the CEO of Bank of America. Speaking at a conference today, you could see a very visible tick down in the stock price as he was giving those comments around 11:30. And KBW sums up the culprit of that.
According to the information, the U.S. probed South Korean chip equipment makers
at this Bernstein conference, where he talked about net interest income. That's the profitability metric for loan making. That's going to be about 1% less than consensus, a 2-cent miss to consensus in the second quarter. Markets revenue, Moynihan said, is expected to be up low single digits year over year, which KBW attributes to a 1-cent miss to consensus. And banking revenue is expected to be up 10 to 15% year over year, which is another 1 cent miss to consensus. So overall, if you pull this together, according to KBW, that indicates that guidance is about a 4 cent miss to consensus in 2Q 2024. And that's why the stock took a bit of a dip at 11:30. It's recovered a little bit since then, but still down about 1% in today's trading. Cal?
That's interesting. Leslie, thank you for bringing that to us. We appreciate it. Again, B of A lower by 1%. Leslie Picker with the news. Coming up, the disaster du jour, Salesforce, now down 20% after their first revenue miss in 18 years. We'll tell you
Moody
what went
says the
wrong,
G20 momentum persists in 2024 with disinflation and cooler growth ahead.
50% from here, despite having its worst day in 2 decades. And is it sending a message about broader tech and software? We'll talk about that. Plus, today's pending home sales numbers suggest the housing affordability crisis isn't gone yet. But Morgan Stanley has a couple under-the-radar names that could outperform anyway. We will reveal them ahead on The Exchange. Don't go anywhere.
And Moody says we expect the Federal Reserve to begin rate cuts in the second half of 2024, assuming softer month-on-month inflation momentum continues.
Hourly velocity is starting to turn up slightly.
Welcome back to The Exchange. Shares of Salesforce are down almost 21% now after the company cut its outlook for subscription and support revenue. The business software provider also gave a downbeat forecast for the current quarter. Last night on Mad Money, Salesforce CEO Mark Benioff remained optimistic, especially about the company's AI products.
The most important thing remains the customer success, which is why how are we going to make these customers totally transform themselves, more profitable, better customer success using our incredible new AI technology. And that's what I'm really excited.
My next guest, he's also excited. See some challenges with this AI adoption and turnaround, but remains bullish. Patrick Walravens is Director of Technology Research at Citizens JMP. He's maintaining his buy rating on Salesforce, has a $342 price target. Patrick, why is this just a bump in the road?
Well, Kelly, first of all, thank you for having me on.
Look, it's obviously hugely disappointing, and it's the first time that Salesforce has missed revenue in 19 years. So everyone expects this company to execute in a steady manner, and they didn't do that in Q1, and they're being punished for it.
It just reminds me of other stock blowups where you have one big quarter that tells you we're at an inflection point, and it often gets worse before it gets better. Why am I wrong about that? Why aren't they like other examples we could cite?
Yeah, well, first I will say it's not going to get fixed tomorrow. You got to wait at least until August when they report Q2 to show that they can turn it around. But fundamentally with Salesforce, I think there's three things. First of all, their AI pilots, their Gen AI products, which are their co-pilots, are just coming to market now. So the first two of them for sales and for service only became available to customers in April at the very end of the quarter. And they have 3 more coming this year. So I think you want to let those products come to market and see what they do. Secondly, they have a massive amount of customer data. I mean, it's crazy. They have 20 years of customer data. It's 250 petabytes. Petabyte is 20 million filing cabinets. And data is, yeah, I know. Data is what fuels AI. That's what makes it work, right? And then thirdly, I just don't think we should count this company out. When I first started covering it, they were doing $1 billion in revenue. Now they're almost 40. They've weathered a lot of these storms. I wouldn't bet against Mark Benioff in terms of figuring this out.
No, I mean, and look, when they were under pressure because of expenses a few years ago, he went and slashed expenses. I mean, he certainly knows how to take a market reaction and pivot, and he talked about that with Jim last night and their AI plans. But it just feels to me like we are at the dawn of a new... Look, Salesforce was one of the best stocks to own for the entire SaaS period, literally the last 20 years. It feels like the most perfect, the most emblematic name of this entire transformation and kind of how we do business. Now we know we're at the dawn of another period. And it just feels like investors are saying, it's time to be elsewhere. This stock, maybe they can pivot, maybe they can keep up, but it's time to be elsewhere.
So for sure, people are feeling that way today. And by the way, in terms of where the elsewhere is, look at, I mean, it's just ironic. Look at C3 AI today, right, which was founded by Tom Siebel, right, which was the first CRM company, which, was on-premise and then got bought by Oracle. And that business is entirely enterprise AI. And so, their leads are going through the roof. And I last time I checked, I think the stock was up 15 or 16%. And, and another thing that you could look at today, right, would be Snowflake, right, where they had a bad quarter and then they bounced back and they have a new CEO who knows AI absolutely cold from his time at Google. And they're having their user conference here in San Francisco next week. So Salesforce, I think we'll figure it out. It is relative valuation right now, it's like 16 times free cash flow. That's the cheapest it's ever been. But yeah, it's going to take a couple months at least.
But even what you said hints at, Mark Benioff, this is his company, obviously. Does it need someone else to lead it through the AI transformation period? I mean, for someone like me who doesn't use Salesforce every day, explain to me why the product experience might be changing for a user today with the rise of Gen AI. What is it that I can now do on a different piece of software that makes me maybe engage or need or rely on Salesforce maybe a little bit less than I previously would have?
Well, so you're a salesperson, and the sales co-pilot will write your email for you to your prospect. You are a customer support person, and usually you have to go through all your different policy manuals to find the answer to the question. Instead, the co-pilot will write a quick, 3-sentence response to what your customer's question is. And even better, when you get off the phone at the end of the conversation, it summarizes the conversation for you and it says, is this okay? You edit it if you need to, otherwise you just click okay, instead of having to fill it out. So there's huge benefits for Salesforce's customers that can come from these Gen AI solutions, but they got to get those solutions into their customers' hands.
So in other words, we should view Salesforce's main competitors now as companies like Microsoft with Copilot, OpenAI with their product, I guess Google to some extent as they start to roll that out. I mean, those are pretty tough competitors.
Yeah, so the way to look at it is at the very bottom, you've got NVIDIA, you got the silicon. Above that, you've got the foundation layer, so you've got the snowflakes. Right? Above that, you've got the models, so OpenAI, and then sitting on top are the applications. And the applications are where the customers really get the benefit. And yeah, they're competing against Microsoft's applications, they're competing against Workday's applications, they're competing against all the leading applications companies.
Yeah, and so they're going to need the best talent, and they're going to need the best products, and they're going to need really deep pockets in order to win that race. Again, which you say is something that they can do as they look to turn this around. Patrick, thanks for joining us to explain the quarter today. We really appreciate it.
Thanks for having me.
Patrick Walravens with Citizens JMP. Coming up, American Airlines drifting lower again after posting its worst day since the pandemic. Still ahead, we'll look at the state of travel, the names best positioned, and one age cohort that's arguably propping up the entire industry. The Exchange will be right back.
Angie.com.
I'm long the market here.
Welcome back to the Exchange, everybody. I'm Tyler Matheson with your news update at this hour. A courtroom win for former President Trump today. A New York appeals court ruled he can sue his niece, Mary Trump, for giving information to the New York Times for its 2018 probe into his finances. The court ruled there was substantial legal basis for Trump to claim she violated confidentiality provisions of a 2001 settlement over the estate of Trump's father, Fred. Mary Trump has yet to comment. Once a bit of rival, now a fundraiser. Advisors to Florida Governor Ron DeSantis say he hopes to raise at least $10 million in a multi-state fundraising drive for the Trump campaign. The DeSantis team says the money will be used to buy media in key swing states. And the new Women's Basketball League, Unrivaled, has secured some big investors. The lengthy list includes former ESPN president John Skipper, NBA All-Star Carmelo Anthony, and a venture capital firm led by U.S. women's national soccer team captain Alex Morgan. The league, which plans to launch in January, will give athletes equity and promises to feature the highest average salaries in professional women's sports. Interesting story developing there. Back to you.
A competitor, would it cannibalize the WNBA or be complementary?
I would assume it would, in the same way Live Golf has sort of poached players from the PGA Tour. I'm guessing, don't know.
Interesting. We'll have to follow up on that, Tyler. Thanks. I'll see you soon. Get your
bet.
denim ready. Coming up, housing affordability is at multi-decade lows, but home builder stocks are a mixed bag this year. Up next, we'll speak with Morgan Stanley's head of real estate investing about the two names she says will outperform in the current environment. We're back after this.
Now.
Welcome back to the Exchange. The latest read on housing shows buyers are staying on the sidelines amid these high rates. Let's get to Diana Olick with the numbers. Diana?
Well, Kelly, it was a huge miss on pending home sales in April. They dropped 7.7% from March. The street was looking for basically flat. Sales down 7.4% from April of last year. Now, this count is based on contracts signed during the month. So at that month's mortgage rates, and that would be your culprit. The average rate on the 30-year fixed ended March at around 6.9% and then just took off, hitting 7.5% by the end of April. So with prices still climbing and supply very low, leading to increased competition, that jump in rates was a huge factor. Sales were down in every region of the country, but they fell hardest in the Midwest and West, which is interesting because the Midwest has some of the most affordable markets and the West some of the most expensive markets. Now, mortgage rates eased up a little bit in May, but they're rising again now. Another report out from Redfin this morning said the share of sellers doing price cuts hit 6.4%, and that is the highest level since 2022. The median asking price also dropped for the first time in 6 months. Kelly?
So a little bit of a glimmer of hope there, maybe.
Maybe.
All right, Diana, thank you very much. Diana Olick. Owning a home has turned from an American dream to a pipe dream for many, as housing affordability has hit multi-decade lows. According to government data, the median home sales price was $20,000 last month, with a 30-year fixed mortgage rate around 7%. And that means a monthly mortgage payment for a median home is $1,000 more than it was 3 years ago. But my next guest says there are some stocks that can actually benefit from these housing challenges. Here with the names and where else she's seeing opportunity. Laurel Durkee is head of global listed real assets at Morgan Stanley Investment. All global listed real assets? Yes. So what would they all be? Real estate and
listed real estate and listed infrastructure.
Infrastructure. Because this is the place people want to be right now is real assets. They were worried about the dollar and so forth. Is
Absolutely.
that the idea?
Yeah.
What is the broad argument for owning real assets, housing included, or infrastructure? It just holds its purchasing power, really?
When you think about the sort of strategic rationale to include real assets in a portfolio, it would be the diversification, it would be the correlation, strong history of total returns, and the inflation protection that it has historically provided.
All right, so housing has been a bit of an odd one, obviously, because the market, broadly speaking, has been frozen, but as a result, the home builder stocks have been super hot. I think that has gone on longer and stronger than many expected. Where in that universe are you thinking there's the most opportunity right now?
So I primarily focus on the listed real estate universe, including REITs. And when you think about REITs, that's primarily rental housing. When you think about the affordability crisis really playing out in the U.S. today, it is benefiting the rental market. So you had said that it was, moving from the American dream to a pipe dream. That does provide opportunity for the rental landlords to be able to fill this affordability gap that so many people are experiencing.
What are the publicly traded rental plays?
So really, from a sector perspective, you can invest in traditional multifamily, you can invest in single-family rentals, or you can invest in manufactured housing.
Do you like all of them, or where do you think is the most attractive right now?
I think the most attractive right now, taking everything into consideration, is going to be the single-family rental market and then some pockets of the traditional multifamily universe.
And single-family names that we should know about would be, I think, of American Homes for Rent and those kinds of stocks over the years.
Exactly. So a name like AMH, they really do have a differentiated operating platform. They run about 60,000 homes. They're also a developer of single-family homes. So they were one of really the first institutional players out there to develop single-family homes exclusively for rent. And that is providing them with a multi-year runway of future growth that they're going to be able to benefit from, and also really kind of helping this affordability crisis. When you think about renting an AMH home, it's actually 25% more expensive to own a home in the AMH markets.
So the only, obviously, problem here would be if we start to see rent slow, which is what everyone's cheering for from an inflation point of view, because it's been one of the biggest, contributors there. Are you seeing signs of rents coming down, maybe starting to crack a little bit?
We're not in the SFR space. You have seen that more so play out in the traditional multifamily space, especially in some of the Sunbelt markets where you are seeing elevated levels of new supply coming into those markets.
Right, we've heard that in Florida, anecdotally, places like that. And you do have a multifamily name, Avalon Bay, that would be more of a traditional play that you still do like?
Yeah, so Avalon Bay is the traditional multifamily owner, operator, developer. They are a large cap owner, traditionally more in the coastal urban cities and suburbs. So when you think about the Avalon Bay markets, you had mentioned earlier, average home price in the U.S. today, $420,000. In Avalon Bay markets, the average home price is over $800,000.
Wow.
So the affordability of those markets is significantly lower than what you would see nationwide. If you think about renting an Avalon Bay home, it's about 95% more expensive to own a home in their markets than it is to rent in Avalon.
So almost twice as expensive, really. So it's a no-brainer in terms of affordability. Finally, then, just making time, we have where else, just broadly speaking, in real estate? I've noticed Welltower's been a stock people have heard about on this program for a very long time. It's a senior living play. You mentioned some of the data centers. I mean, these are kind of, it's that thing where it's sort of, yes, these are the places that have been working. And so it sounds like you're saying kind of just stick with that for now.
I think you need to. So when I'm looking at the alternatives within the market today, I'm really looking for those secular drivers of demand that I believe are going to really be able to provide upside to investors over a long-term period of time. So you look at a name like Welltower, they absolutely have demographic support with the aging population, and the growth profile of their cash flows is going to continue to increase over time. Both Equinix and Digital within the data center space also are significantly benefiting from the increased AI and cloud computing and just data.
Yeah.
You were talking about Salesforce earlier and how it really runs on data. The Equinix and digital is essentially benefiting from a lot of those same trends that we're seeing. The proliferation of data that's really underpinning artificial intelligence is all housed in data centers. And so that growth is going to have a multi-year trajectory.
What did analysts say? 250 petabytes of data. He said each petabyte's 20 million filing cabinets. I don't know how many computers it is. Regardless, it's similar to the broader markets. The secular growth stories are still kind of the places to look, even in real assets. Laurel, thank you so much. We appreciate it. Coming in today. Laurel Durkee with Morgan Stanley. Coming up, there's one cohort holding up the travel economy. We kind of just heard about them. We'll tell you who they are exactly and which companies are benefiting the most. You're looking at one of them up 17% in a month. We'll reveal it next.
I couldn't give up.
Welcome back to the exchange. We haven't seen the slowdown in travel that many expected, and there's one
Fed
demographic in
Scoresby
particular
says the strongest part of the economy right now is the job market.
Seema Modi is here with more. Seema, do tell.
Kelly, it's the wealthiest demographic, and even if you look at the numbers, Americans have roughly $156 trillion in assets, according to Visual Capitalist, but half of that wealth, $78 trillion, belongs to baby boomers. And new data from Deloitte shows that this demographic is spending much more on travel. 1 in 5 are planning to take their longest trip post-Labor Day. Hotel executives chalk that up to the pandemic, a greater appreciation for newer experiences. Analysts say timeshare companies are doing more to market to this customer, with Marriott Vacations CEO John Geller revealing that the average owner of its properties is 60 years old.
About 80% of our owners are married and have children under the age of 17. You can break down your ownership so you can get a getaway weekend with just the husband and wife if you want, or get multiple units and go for a longer multi-generational trip.
Now, multi-generational travel, it's leading to higher group cruise bookings. Royal Silver Seas, Norwegian's Regent Seven Seas, and Viking Cruises are targeting this demographic. Viking specifically has seen its shares outperform its competitors in the past 1 month, with a number of analysts, including UBS, initiating a buy rating, calling the older consumer a key part of this company's growth story.
You know, it's interesting. We heard a little bit in the upfronts this season, the TV upfronts. That's also a place where there's a lot of baby boomers watching. And I remember reading the stories where they said executives are no longer trying to hide that. They kind of boast about it. You know, this is where the spending power is. If you want to reach this cohort, this is the place to do it.
Yeah, for at least the companies in the travel world, it is a shift in mindset, Kelly, because for the longest time, these were the companies that were fixated on Gen Z, millennials, really trying to get that younger customer on board or in the air. But now the focus really is on this generation that not only has wealth, but has so much invested in the stock market. So they're less immune to the volatility that we're seeing either in the economy or in the equity market.
No, it's fascinating. Seema, appreciate you bringing that to us. Parents, stay tuned. Seema Modi. Coming up, here's one more look at our mystery chart. It's one of the names on deck to report. Near-term options imply an 11% move in either direction. Our next guest is a buyer, especially on any weakness. That name and two more are coming up in Earnings Exchange.
Made affordable.
Welcome back. It's time for today's Earnings Exchange. Retail and tech are driving the narrative today in the market, so let's get a read on three more names in those sectors reporting after the bell. We've got Costco, Dell, and MongoDB. Joining us for the trades is Nancy Tangler. She's CEO and CIO for Laffer Tangler Investments. Nancy, great to have you back. Welcome.
Thanks, Kelly.
Fed Scoresby says productivity
Costco,
is a noisy
it's like a broken
series.
record
We've got to
saying
keep
it's
an
hitting
eye on
all-time
it.
high, but it is again today as it's set to report third quarter earnings after the bell. Analysts over at D.A. Davidson will be watching food inflation, how that's affecting prices, whether they're increasing their investments into e-commerce, always a growth opportunity. What's your take? You still an owner here?
Yeah, we do own it. And, we've trimmed it back on strength, and it is expensive. I mean, the stock's trading at 45 times next 12-month earnings. I've often said if I had bought more Costco stock instead of, the major runs we made when the kids were your kids' age, I'd be super wealthy. But I think what you want to be paying attention to is they are taking share in consumables. So, sorry, Target. And the company is growing.
I don't think I've ever seen. So I'm watching.
Fast as Walmart.
Mute this right here real quick.
Some guidance there.
I don't think I've ever seen a market. Not ever, but. I'd say the last month, maybe the last month and a half.
Housing
I have not seen 5-minute back checks
pre-COVID levels, and it will be hard to get to 2%
like that right there.
Changes.
I don't think I've ever seen 5-minute checkbacks for driving up ever. First time. Maybe I'd have to look back and check, but I haven't seen this in a long time. Last month and a half on the regular. See it on the regular now.
The bleeding edge of news for non-farm payroll.
Very unusual, very weird.
And get a special offer of Financial Juice Pro.
Seems like market's changing, but I don't know if it is or not.
Of 1 month.
Very, very rare do you see that. We're like driving any direction. You never see that 1 minute breaking. And coming back to this 5-minute. Also, usually what you'll see on trend is us trading the 1 minute trigger, and then every hour or two you'll do a back check on the 5. But it's just it started way back down here. Checked it here, all the way down. Checked it there, all the way down, all the way down. This looks like AI driven stuff. I'm not sure what it is yet, but I think that it is. If I had to guess, there's a program being run somewhere in the background. I was talking with Scott, if you guys know VolWiz, he made a post or a Substack yesterday saying that he believes that the algorithms are being used so much at this point from everybody. Like everybody's on an algorithm right now. Everybody's on AI. So if you were a dealer, you would use algorithms to torch option chains. And I'm looking at option chains right now. They're just getting murdered. Action like this destroys options. Up or down, doesn't matter. Woof, woof, woof. Slam, slam. And I've only been seeing it past couple months. Maybe 2 months. 1-2 months. Something like that. Very unusual. Highly unusual price action. Or at least the type of price action that it is. Very unusual. Even if you're going to reject, I don't ever see this. It's been only recently where you're actually trading a 5-minute trigger and not a 1-minute trigger. I just find it fascinating. And everybody's using this stuff right now. And I don't mean us. I mean like banks and then dealers, market makers across the board. Very, very unusual. The behavior of the market. And Scott made a comment about it. Not a comment, he made a Substack about it. That he felt like AI buy-sell programs were trading with each other specifically on NVDA. So his idea was that if you watch the price action on NVIDIA the last 5-6 sessions, that it's AI pro, or guys are using AI to trade the market, AI bots, that it's bots trading back and forth against each other in these programs, high frequency trading bots. We used to have high frequency trading firms, but not on the scale that we do right now. So they're thinking that his thoughts are in line with trading like this. You're trading that, you're trading that, you're trading this, you're trading that, back and forth, in and out, back and forth, in and out, the entire way up.
For the exchange, up next on Power Lunch, Tyler Matheson and I will show you balloon denim.
Yeah, it's being noticed. It's being noticed by people. We could probably start going back only a few months ago, 3 to 6 months ago, and start looking at some of the behaviors of the market. Market behavior itself is actively changing the past month or two. It started a couple summers ago. Well, the HFT thing's been going on for a while, for years. Another thing that we noticed was before the rise of blaming retail for zero-date buying, it was really weird. They started blaming zero-date call buying, but the real rampant zero-date buying was the original roll in January of 2022. January 2022. So that you would amplify intraday moves with large block call or put buying, and it's not any of us. Not the amount of money that was being moved and the speed and efficiency of it. It was definitely larger players, but it was really wild to watch. It was really fascinating to see them blame retail zero-day traders, and it wasn't. And it didn't start with call buying either, like pump and dump or any of that kind of stuff. The first time I saw it in scale was, I don't know if it was January. I think it might have been March or April when it was really glaring, when it really stood out. And this stuff here is all new. All this price action here is all new price action. This is very abnormal price action right here.
Good afternoon, everyone, and welcome to Power.
You can actually see it before, too. You can actually see it here.
On this, what is it?
Very abnormal price action. That's all abnormal price action.
Now down close to 2,000 points in the 2 weeks since closing above 40,000 for the first time. But today's losses are all about Salesforce. That stock down.
I'm assuming at some point. There's going to be. Something's gonna break. It's gonna be like 1987. There's no fucking doubt about it.
Including CrowdStrike.
There is no doubt about it that there will at some point be very similar to what's assigned to 1987, where we introduced computing into the stock market. Part of the crash in 1987 was blamed on switching over to computers. I'm going to assume at some point there will be an issue. There at some point. The crazy part too is some of the other things you can tell.
Foot Locker's turnaround.
How you can tell this is going on too is when algorithms. They'll say like when algorithms pick up on news and they'll begin to self-fulfill on news. Like, do they pick up on this? Is it being posted? How much traction is news getting? Its impact on the marketplace.
And expectations on guidance for the.
We've seen it. There was a report last summer, if you remember, of an explosion at the Pentagon, and the market like fucking crashed.
So what's going on here?
Like immediately.
A variety of factors like weak over
But
demand.
my point here is more so towards.
And then there's the lingering.
I don't know if you guys noticed this at all. There are articles about this. AIs will begin to like eat their own tail like a snake eating itself.
So much from companies like OpenAI, Google, and Anthropic. They are already commodities, and really
it'll begin to eat itself, and instead of finding like the best answer, it becomes like gobbledygook.
Oodles of that kind of data.
I'm fascinated if that would happen in our stock market at some point.
With this,
you could like trigger mass selling across the stock market.
Information that's stored in Salesforce.
They say they're like we got
to create another level of capability.
We got fail safes on that. I'm like, you fucking liar. You got fail safes in that shit like Equifax has fucking security on your fucking social security number. Bullshit, or Ticketmaster, or any of these other fucking things. I was reading an article yesterday. Let me see if I can find this article. It was hilarious. It was like a tech bro wrote it. That these AI companies are going to self-police themselves, so they don't fuck up the world. And I'm like, this is a disaster. This should be the federal government doing this, not you. Let me see if I can find that article. It was such a fucking clown article. Let me see if I can find it. The guy that wrote it, hold on a second here. It was kind of hilarious to read.
To be about, but no one's
going to find it here.
a lot of the analysts and the reactions today after yesterday.
Like it was a self-policing article on artificial intelligence and how the market was going to do it themselves.
Right now, they're dealing with a tough macro environment.
I was like, get the fuck out of here. Hold on a second. Let me see if I find this stupid shit. It was like written
About Dell, which has become
by like a tech pro.
it's doubled this year, 255% higher in 12 months, like NVIDIA, really.
I was going to find this stuff. It was really pathetic.
Dell and AI player, or, well, I don't know if we'd call them a poser, but Christina Partsinevelos is taking a look ahead of their results this afternoon. Christina?
You can choose, nicer words.
Or you know what else would be funny is if you just came in one day, like came into the market one day, and you just saw like a SPOOs or something, or all the major stocks just bounce back and forth, like boom, 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 like 5 pennies until someone kicks the fucking box.
Because of AI optimism and the potential to capture it through Dell.
You just fucking you just see SPY for like 4 hours just bouncing around.
AI server shipments were only 3.5% of total revenues. That's key. Less than 5%. So is Dell a much less levered story to AI, as Bernstein says, or an AI faker? There's that word, Kelly, as one Mizuho analyst called Dell. I want to start with just the recent stock drivers. So you can call it the Midas touch of NVIDIA. The stock jumped after NVIDIA's CEO lauded the strength in their server relationship on stage last week. NVIDIA chips need to plug into something like servers, and that's where Dell plays a role. And then secondly, Microsoft's AI PC announcement with Qualcomm last Monday helped fuel this PC refresh cycle that's going to be driven by AI PCs. But Dell's core business, about 60%, remains heavily reliant on PCs and monitors, which means that AI boom may not be as beneficial as thought. And if we talk about NVIDIA, yeah, they're getting their GPUs. NVIDIA's hitting 78% in gross margins. That means if NVIDIA is making that much money on their chips, it's going to cost Dell a lot and could be more dilutive to Dell's actual gross margin. So there's definitely caution going into earnings tonight, hence why you're seeing the stock down, 4% today. But look specifically for AI server bookings. I'm seeing a boogie number of about $4 billion. And then any commentary about the PC recovery, which some are saying is underway.
Well, it would be a big boon if this whole, now that Microsoft's out with its AI PC, do we expect Dell to enter that space as well?
Well, HP Inc. is a great example with their earnings report, right? So they're an original equipment manufacturer. Their earnings report said that about 10% of their PC shipments in the second half of this year will be specifically AI PCs. Dell plays into this space as well, but that 10% number is still small, with HP Inc. saying that most of it's going to be in fiscal 2025, 2026. So that is maybe some thought for Dell that we're not going to see this immediate rise in PC sales, and especially AI PC sales, despite the narrative that's trending. And just for our investors that are listening right now, the stock tends to move quite a bit. Options market is pricing in at least 9%. Last quarter, the stock jumped about 32% post-earnings.
Yeah, here's the article. It was kind of hilarious.
Especially with the sell-off going into earnings.
Let me see if I can find it here. There's one here from CNBC.
Regular PC doesn't already.
Tech giants pledge AI safety commitments, including a kill switch if they can't mitigate risks.
And what the key thing, Tyler, is that it can do all of your AI.
Major tech companies, blah, 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 came together in a landmark international agreement
It does not necessarily need to connect
at the Seoul AI Safety Summit on Tuesday.
Right now that you can do everything remotely. It's going to save battery life. It's going to work on the.
They make it sound like they've got this. It's like they don't have this.
It can write it out.
They really don't.
Real time, not connected to the cloud. So this are just some of the examples. But is this going to be a?
Yeah, they say they're like we got this. We got this under control. I'm like, no, you fucking don't.
Christina Partsinevelos. All right, let's move on to another corner of the market.
The worst part of it too is that
rising nearly
our representatives are bought and paid for by these companies.
In nearly 7.
It reminds me of what's the old? Reminds me of
this year and down 40.
Oh, hold on a second here.
Over the past 10 years, Gabrielle Fonrouge joins us now with the Foot Locker story. Gabrielle.
That's exactly right, Tyler. It's a big day for Foot Locker. A lot of what's driving this stock move is some of the good numbers that we saw in the report today.
Yeah, it reminds me of the book The Jungle.
They were down 1.8%.
It reminds me of the book that did you guys read The Jungle when you're in high school or college?
And they also had guidance that was better than expected. You got to keep in mind that last
from Upton Sinclair.
Over and over again.
When someone tells you it's okay, don't worry about it. Everything is fine.
For Foot Locker. They're expecting sales to be down 1% to up 1%.
From the turn of the century.
The decline down 6%.
You know what I'm talking about?
So you got to keep in mind this is coming about 2 years into CEO Mary Dillon's turnaround plan.
You know, you can't believe these people. There's just, you can't.
You got to,
You can't believe or trust these people.
If its sales are still done in stores, it's a lot.
We got the kill switch.
So it's
How about you give us the kill switch?
Have great new stores. What you're looking at right now is the new store of the future concept. So this kind of takes the tired old Foot Locker concept, the walls of shoes, and turns it on its head. It's becoming brand hubs. There's individual locations you've got on there. You've
The
got
AI Safety Summit in Seoul.
And that's incredibly important for the brand partners. Foot Locker doesn't have a reason to exist if brands are not willing to sell into Foot Locker. So that was another thing that CEO Mary Dillon had to say. Let's hear what she had to say about Nike.
Nike is our largest brand partner. We're thrilled about our relationship. I'd say it's reinvigorated in a lot of ways. I was just in Paris at their Innovation Summit. I think they've got some exciting things today and coming in the future as we get into the Olympics and into next year.
Yeah, so Nike is one of Foot Locker's biggest brand partners. They've had a little bit of a rocky relationship over the last couple of years. Nike is now starting to realize how important wholesalers are. So a lot more work to be done. Tyler?
It looks like what Foot Locker's trying to do is turn their stores to have the kind of cool factor that an Apple store would have. Do we have any idea how much these makeovers cost them in the aggregate or store by store?
So they spent about $250 million in capital expenditures last year on store refreshes. They're planning to spend a lot more again this year. So that's something Foot Locker is going to have to work on throughout the year. You know, their cash position is not the best. They've got debt on the books. Their sales are consistently falling. So Dillon has to balance. She's got a tightrope that she has to walk. She's got to spend the money to refresh the stores, but she also has to keep the business afloat.
Indeed, she does. Gabby, thanks. We'll see you soon. We appreciate it. Let's get to some news now on the merger talks between Paramount and Skydance. Julia Borston, what's the latest?
Well, Skydance has sweetened its merger offer for Paramount.
A little bit of a
according to sources. Now, this was first reported by the Wall Street Journal.
A little bit of a bear plane forming over here, looking for a new low to the downside of 523.
Additional cash and some sort of reallocation of the cash part of the buyout, so it is more equitable for the Class B shareholders. And we see the stock is now up about 2.5% on this.
Just wearing out supply on the upside at the hourly trigger. Looks like some of that stuff's gone away at this point.
Reviewing this new offer.
Your eyes focused to the downside.
To take this offer, then it will go to Sherry Redstone to consider. We've reached out to Paramount for comment. We have not heard back yet, and Skydance told us no comment. Kelly, back over to you.
Where is the other party in this merger dance right now, Julia?
So the other party is Apollo and Sony. Together, they are right now doing their due diligence. That started a couple weeks ago. It is still ongoing. So now we are seeing sort of parallel paths being taken here. Skydance had an exclusive negotiating window. That exclusivity has expired, which is why Apollo and Sony are now in their process of evaluating and having conversations about this. But so it could go in either direction. But of course, the value for Sherry Redstone, who's very much interested in keeping her company together, is that the Skydance deal would not break up the company. And the presumption is that an Apollo-Sony deal would result in a breakup of the company that Sherry Redstone's father built over so many years.
Great point. Julia, thank you very much. Paramount shares up about 2.5%. As we head to break, let's get a quick power check on the retail sector. Today, some huge movers. On the negative side, Kohl's down 24% nearly on a massive earnings miss. They cut full year guidance as well. But on the plus side, Burlington stores, take a look. Along with Foot Locker and Best Buy, we're seeing some resilience in this space today. Burlington up 18%, delivering a strong beat. Further ahead, we'll dive even deeper into some of the big moves and the changing trends within the retail group. Power Lunch will be right back.
One more back check, then we should run to the downside here. Waiting for this 1 and 5 minute trigger to close.
A trial. All right, welcome back to Power Lunch, everybody. Stocks under pressure today.
Draining it right now. You see that?
Week on Wall Street continuing to roll on. S&P 500 and NASDAQ both on track to snap a 5-week win streak, and the Dow on pace for its second straight week in the red. Our next guest expects a 15 to 20% full pullback from these levels, and also says he sees a rate hike, before a cut this year. Let's bring in Greg Branch, CNBC contributor and founder and managing partner with Branch Global Capital Advisors. Greg, welcome. Good to have you with us. Why so dour on the markets, Greg?
So, Tyler, as you know, this has been my consistent view for some time now, even back to January, when the market was focused on 7 rate cuts this year. And so now that the consensus is coming closer to my stated view at the beginning of the year, that we'll have 0 rate cuts this year, I'm surprised that the market hasn't pulled back already more than it has. Remember that this rally, which kicked off in October, was driven by 2 things. It was driven by the euphoria that the battle with inflation was over and that we would be in a much lower interest rate environment in 2024, and the general AI euphoria as well. Well, only one of those remained, Tyler. And recent data suggests that we haven't seen disinflation in quite some time. In fact, what we saw is a spike in inflation over the first quarter. And what we saw is a spike in the things that lead to inflation over the first quarter, with wage growth going from 90 bips in the fourth quarter to 120 bips in the first quarter. And so overall, Tyler, we just don't have any evidence that we're seeing continued disinflation. 3.9% unemployment doesn't get us there. 30 to 40 basis points growth in core every month doesn't get us there. And wage growth that we're seeing right now in still historical low jobless claims simply doesn't get us there.
But you still have companies performing pretty well. You still have an economy that seems to be based partly on wage growth and unemployment and GDP growth. It seems to be doing pretty well. Can those 2 things overcome those negative factors that you just and correctly cite?
Tyler, those are actually part of the problem. I, like you and everyone else, root for great GDP growth, root for wage growth, root for earnings. But what a 6% earnings growth quarter shows us, and what 3 consecutive earnings growth quarters show us in a row, is that the Fed simply had not put in place an environment that was restrictive enough. The GDP environment shows us that even though we had a revision down, most of that downward revision was driven by a 4% contraction in durable goods. The services spending was up 4%. And as long as that remains the case, there's no attainable path towards 2% inflation. What the Fed has done simply is not restrictive enough. That is why I've maintained a likelihood, even to this day, that I think that the next move is actually a hike, that it's more likely we see a hike than a cut.
I think some people are coming around to that view, although the market's probably not quite there yet. It's sort of one of those things. Meanwhile, in the markets, whether you think there's a cut or a hike, you seem to agree with many others about some of these areas of opportunity, cloud and AI being one of them. You're also looking to Oracle as a name there. Cybersecurity, Greg, has been a huge area of strength. For the most part, a little bit more choppy, more headlines today, obviously, about big hacks. Are those stocks you'd stick with no matter what the Fed does?
Right, Kelly. And so, as you astutely point out, I am only poo-pooing one of the areas of euphoria that we've witnessed that drove the rally. The other, those that are tethered to secular and cyclical tailwinds, generational secular tailwinds like AI and cloud, as you rightly point out, I've always been an advocate for. I'm not ready to give up on cybersecurity yet. I think Palo Alto hasn't come nearly close to its highs that we saw back in February. And I think that the cybersecurity element of the AI ecosystem, of the cloud ecosystem, still isn't appreciated as much as it should be. And so I still think that there's relative outperformance in these names, particularly when we start to see a more restrictive environment take earnings growth for everything else down to low single digits. These names will still put up 20% plus earnings growth. So I think that's still an opportune area. Turning to the major beneficiaries of those secular tailwinds, AI and cloud, while the NVIDIAs and the Googles and the Microsofts, the obvious beneficiaries, have performed well, there's some laggards like Oracle, for example, that has a unique and singular focus on the large enterprise, but is only up 12% in the last year. So I think we can start to spread our exposure, remaining focused on these themes outward to some other names. But I still like cybersecurity as well.
All right, Greg, good to check in with you. Thanks for your time today. We appreciate it.
Pleasure to be here.
Greg Branch. Further ahead, are $1,000 a month loans on new vehicles becoming the new normal? Some new data pointing to a shocking trend. We'll be right back on Power Lunch.
United States.
NBC.
Welcome back to Power Lunch. We told you about Salesforce's soft quarter. Its shares are dragging the market lower, but might it just be the wrong software business model for the coming age of AI? Deirdre Bosa is looking at potential trouble in the cloud for today's Tech Check. Deirdre?
And so keep in mind, in
Kelly,
5 minutes' time at the bottom of the hour, expect comments from ECB's McLuth as speaks at the Irish Association of Investment Managers annual dinner.
That could be poised to recover and will benefit more from Gen AI than the traditional SaaS model that the likes of Salesforce has. That would be consumption-based models. Business models like Snowflake, Datadog, Confluence, MongoDB, which reports tonight, will be another piece of this enterprise software picture. Here's the case for it. If Gen AI applications are compute heavy, they require more usage of cloud computing resources or API calls. then consumption-based models naturally scale with the customer needs versus a Salesforce and others, which primarily sells on a subscription basis, often structured around a per-seat model that is charging based on the number of users that have access to the software. That is great when workforces are growing, but not so great if generative AI is making workforces more
Fed's Williams
efficient
say
and
the markets
smaller.
understand the
So
Fed's
you
outlook
essentially
shifts
have
with
less seats,
incoming
even though
data.
Gen AI workloads are increasing. I spoke exclusively to Boxio, Aaron Levy, on that's where many companies are today. They all know that they need to have AI strategies and probably will eventually, but they're trying to figure out what exactly that looks like, how much they build internally versus how much they're spending on outside platforms. And Kelly, that's why investors are trying to figure out as well. Enterprise software has been such a rough place to be invested this year, over the last year, really. But there's some divergences occurring, and that consumption-based model is an interesting one in the age of Gen AI.
It's an interesting sort of lesson in, I guess, second level or derivative thinking when you said, okay, so here comes AI, and it's a threat to some of these SaaS companies, software as a service companies, where they're basically collecting money on a per capita basis. Well, there may be fewer capitas.
Exactly. Exactly. Less seats, right? And you see that like an example like Klarna, right, which said that it was able to get rid of 700 employees, but then it put those workloads of those 700 employees into generative AI. So if your company selling your software to Klarna by seats and subscription, there's a lot less seats to sell to, even though their usage of Gen AI, which requires compute power, goes up. You understood it perfectly, Tyler.
Yeah, well, it's interesting. It's derivative thinking. It may or may not be the case, right? I mean, we don't know. We will find out as we find out on.
But there's a lot of unintended effects, right, of Gen AI. Like at the beginning, we thought that it was going to hurt blue collar jobs. Turns out it's white collar jobs. So while enterprises, while their customers are trying to figure this out, so are investors and so are the workforces.
Deirdre, good to see you. Thank you, Deirdre Bosa. Let's get to Julia Boorstin now for a CNBC News update. Julia.
Tyler, a third U.S. farm worker who deals with dairy cows has been infected with the bird flu. The CDC reported the update today. This is the second person this week in the state to be diagnosed with this illness. And this latest case is different because the CDC says the worker experienced a new symptom, a cough that accompanied eye symptoms. Federal health officials say the risk of bird flu to the general public remains low. IRS-free tax filing is here to stay. The agency announced today will make its experimental direct file option for simplified returns permanent. The pilot program
Shortly
rolled
expecting
out on a
possible
limited
comments
basis
from
this year.
ECB's
The
McClough.
IRS says some 140,000 taxpayers took advantage of it, claiming more than $90 million in refunds. In basketball, great Larry Bird helped celebrate the grand opening today of a brand new museum cataloging his career. It opened in Terre Haute, Indiana, a couple of hours north from where Bird grew up. The Celtics legend and NBA Hall of Famer spoke ahead of the ribbon cutting, saying he hopes the museum will inspire the next generation of athletes. Back over to you.
All right. Thanks very much, Julia Boorstin. Well, rewriting retail's gene code, why adjusting to changing fashion trends could be a make-or-break decision for several companies. That story when we return.
NYMEX WTI crude July futures settle at $77.91 a barrel, which is down $1.32 or 1.67%. Natural gas July futures settle at $2.57. Also seeing gasoline June futures, they're settling at $2.40. Diesel June futures at $2.37.
How many stops do you think they ripped there right there? They swept. They must have swept all kinds of stops down in here.
Filter.com.
Welcome back to Power Lunch. We are right in the middle of retail earnings season. We've heard from a lot of the big apparel names with more still to come. Gap, for instance, reporting after the bell today. Shares up 3% into that print. But if there's one big theme emerging so far, it is denim. According to Morgan Stanley, demand for denim is jumping. Search levels are hitting peaks in a 20-year data set. Abercrombie has been hitting it big with the denim trends. The stock up 20% in a week as it reported and up 460%. Oh, yes, in just 12 months. Here's what CEO Fran Horowitz said about the changing styles. She said, denim silhouettes are shifting. What we're seeing today is that they are truly getting significantly baggier and wider. Aren't they ever? For more on how important it is for retailers to catch these trends, let's bring in CNBC.com retail power duo Melissa Repko, who covers department stores like Macy's and Kohl's, and Gabrielle Fonrouge, who covers the apparel names like Gap, Abercrombie, and American Eagle.
Wearing denim, by the way.
Yes.
We're all wearing denim. We came on style.
You know, if they zoom out enough, can everyone see for a second these balloon these ladies went to the store. I said, ladies, you know, I'm last on a trend here, but even I know the ladies at my town, they're not wearing the athleisure anymore. They're wearing this, Tyler.
Yeah.
They're wearing, this is what people are wearing. And this is my first foray into.
You get a good gust of wind, you could be like
to balloon down.
Nun, you know?
They're not quite long enough.
You get an air. I wore my jeans today too, by the way. Not quite
and this
the
is
wide
what
ones.
everyone's wearing.
What's with this wide silhouette that everybody's so hot for?
So it is the low-rise baggy. This is what all of the teens are going for. I bought these today at Hollister. You know, like we just heard from Fran Horowitz, she said that these are the most popular jeans. This is what's in, and this is what's out.
And that
the jegging, the skinny jean.
Oh, the skinny jean.
And so we had a really interesting experience today at the American Dream Mall. So Fran Horowitz said that low-rise baggy is what's in. American Eagle's president also told me the exact same thing. But when I went to American Eagle, they didn't have low-rise baggy. They only had it online. And they told me as well that jeggings were no longer resonating with their customer. They're getting rid of them from the stores, yet they had a whole wall of these.
I have an entire closet of these, or I used to be able to fit into these like skinny jeans. And this is out. The athleisure feels like it's not. This is not where. Look at Lululemon struggles amid all of this. It's very interesting.
So my wife just bought from one of the aforementioned companies online jeans ripped to hell and wide like that. What is the attraction here? Because the wide,
this is the mom
the
jean
wide
with the
look,
cut to it.
Huh?
This is the mom jean, and people used to make fun of this style, but this is the style
no,
that's
they're wider
in.
pants. They're wider at the flared out more. What is
flared,
it?
yeah.
Because they're not. Let's just say they don't do a ton for the silhouette.
Well, here's the thing that's important, Tyler, is that it's not just about the bottom, it's about the whole outfit. And so I spoke to Macy's CEO about this, and Tony Spring was saying, you know, people are dressing not only in head-to-toe denim, but when people are dressing in a different kind of pant, it affects their whole outfit. So they're picking out different tops. They're picking out different shoes. And so it's an opportunity like for a department store or a brand to try to get people to buy outfits, which we know is under pressure right now as people are a little more careful with discretionary
I thought
spending.
denim was going to be dead. What does this mean, this ability to surf a trend? What does it mean for the stocks of these companies?
Well, it's incredibly important to be able to be on trend and to be able to get your supply chain in a place where you can respond rapidly. With social media, trends change in an instant, and you have fast fashion players, like I talk a lot on your show, Shein. They can get an idea from design. They're spotting these things online, getting them online within a week. Under Armour said 2 weeks ago that it takes them 18 months to get something from idea to a showroom floor. And as you can see, Under Armour's down, and they had a bad earnings that day.
Lululemon
and
as
Kohl's as well.
Kohl's is another example. Today it's down. It was down as much as 25% earlier. And one of the problems is that it's struggling to keep up with trends. And I spoke to its CEO, Tom Kingsbury, and he said one of the things they're trying to do is shorten the amount of time it takes, especially for the juniors department, which caters to a lot of teen girls. They're the fastest to these trends. And if you don't respond quickly, you miss the moment. And we're seeing the response to that today with very weak sales. He said they're trying to kind of get ready for the next couple quarters of the year and get their denim section ready as well.
So the ones that get these right, whether it's American Eagle or Gap or Abercrombie or you name it, their stocks are likely to respond very positively.
Those stocks are going to do well because it means they're executing well. Right now, the consumer is like spending.
I'm going to come over here and look at what you got on the rack here. Just keep going. I mean, I just don't mind me. I'm just going to browse a little bit.
So retailers need to make sure that they have the
Tyler,
hottest
you'll like the
trends on the
jumpsuit
shelf.
back there.
Where's the jumpsuit?
There it is.
Oh,
that one would be good.
This little jumper.
I think this one for Joe.
Perfect for the summertime.
Yeah, that's kind of cute, right?
We're seeing denim in all parts. It's not just jeans anymore. You got jean bags, jean shoes.
Exactly. And it's important to remember it's about having the right stuff at the right moment.
Well, it's the right
we
stuff.
are seeing consumers pull back in some areas, but then you look at an Abercrombie that is seeing a lot of strength in sales. So it's not that consumers are pulling back everywhere. They want to buy certain items, and with those items, they are willing to pay full price or closer to it.
No, the trends are shifting. We even heard from the Brooks Brothers CEO, because I was asking him the same thing, saying, is this trend back towards workwear? He said, it's not that athleisure is over, but people want those technical fabrics in these more sophisticated silhouettes. And I do wonder where, so Lululemon's chief product officer just
What a fucking yawner, huh?
3-4 months ago, looking to buy something. And
yawn. This is we're like straight where we were at 4 a.m. right now.
This is the
zero movement in the market. Absolutely zero movement. We're actually at the 4 a.m. price point in the stock market right now at 2:38 in the afternoon.
They're trying to focus.
Market parking S&P 500 right now. No movement.
The leggings you referred to are actually
no movement. Just a whole. This is 4 a.m. right here, right? Just straight sideways.
Not in the same way anymore.
Look at that. Straight sideways. 4 a.m.
But part of the reason
2:30 in the afternoon.
North America is because they didn't have enough colors. Consumers came in looking for different types of colors, and they didn't have. So just like you
Paying all those spreads, baby.
walked out empty-handed.
Pay those spreads.
Poor execution.
Yeah, still doing maybe well on the men's side.
I always call it parking the bus.
To fully jump on the denim bandwagon.
You will not be seeing me in the white.
Got the big old wide bus. They're backing it in. They're backing it up. They're like, we're gonna pay off all of these spreads here today.
Baggies. I mean, they would you give dad.
Just wait till 20.
Today and tomorrow, Thursday, Friday, baby. Back that bus up. Welcome to summertime.
My wife wanted me to wear my denim shirt.
Should have maybe.
I swear to God, at some point I'm gonna get. I was like, I think last summer we were selling some, or I don't know if we were selling or buying. Last 2 summers have been really busy. This summer, I'm like, oh man, we're going right back to the fucking. We're gonna go right back to putting out the hammock with a fucking rum and coke. Place a trade on Monday, come back on Friday. Like they're not even in the bus. It's always days like today where I'm like, yeah, this is when you know the market is bullshit and fake.
Brent crude futures settle at $81.86 a barrel. That's down $1.74 or 2.08%.
God, fucking development sucks. I'm in development hell again.
Back at Power Lunch yesterday, Phil Dad Jeans LeBeau told us about car leasing.
Dev hell.
And maybe today we have a reason why. Buying a car is more and more expensive, if you hadn't noticed. According to new data, 16% of new car buyers who finance are paying $1,000 or more per month. Phil joins us now with more on the story. Hey, Phil.
Dad jeans? Oh, we'll discuss this sometime. We will discuss this. Let me throw some numbers at you, Tyler. These won't surprise you, Tyler, because I know you're above $1,000 a month for your car payment. The average right now, in terms of somebody taking out a new car auto loan, and this is according to Experian, in the first quarter, your average monthly payment was $735. The average amount borrowed, just over $40,000. The term, how long it would take you to pay it off, 67 months. That's the average right now. Okay, so there's a couple of things to keep in mind. Is there any indication that auto loan payments are coming down? Yes, but don't get excited. They only dropped $3 per month in terms of the average. And as you take a look at auto sales, the demand is there. They're going to be the highest since 2019. And that's why this statistic takes on greater relevance. 16%, as you mentioned, Tyler, of the people who took out an auto loan in the first quarter are paying more than $1,000 a month. That's before insurance. So add that in, you can only imagine what people are paying. And here's the breakdown in terms of what people are paying between $400 or under $400 all the way up to $1,000. The bulk of these are between $400 and $800. That's where you see most of the auto loan payments falling right now. Bottom line is this. We continue to see people who say, I am willing to pay more than $800, more than $1,000 a month when it comes to financing a new vehicle purchase. Yeah. Tyler, back to you.
The Dad Jeans reference was to a previous segment, which you may not have seen, but it just felt...
Oh, I watched.
Oh, you did? Okay, good.
I watched.
Good, all right, man.
You want me to comment on the full shot of you in the studio?
Sure.
We'll do that
go
some
ahead.
other time.
All right, save it for next time.
No?
This is why, one of the reasons why leasing, as you pointed out yesterday, has made a big comeback.
Exactly. Leasing is generally about $140 less per month in terms of a payment. So if you went out and looked at the exact same vehicle and you wanted to finance to buy it versus lease it over 3 years, generally speaking, you're paying about $140 less per month to lease.
Phil was kind not to comment on my balloon jeans, by the way. He knows better than to go there.
Phil's a good man.
Let's move along, Phil, to Boeing. We did get some news from the FAA. What is that news?
Well, leadership of Boeing, including CEO Dave Calhoun, met with the FAA in Washington for 3 hours this morning, laid out their game plan after 90 days in terms of what they are going to do to ensure quality control, safety, all of the things that need to be done to assure the FAA that 737 MAXs are built to specifications. At the end of it, the head of the FAA came out and said, this is great, but this is just a blueprint. Now we have to see if they can meet the metrics on a regular basis, outline the fact that they're going to have weekly meetings, quarterly meetings between the head of the FAA and the head of Boeing. And now it's up to Boeing to show that it can meet these metrics. One last point. Boeing still cannot raise production beyond 38 per month when it comes to the 737 MAX. Mike Whitaker, head of the FAA, said it's probably going to stay, that cap is probably going to stay in place for several months.
All right. There's Boeing shares up fractionally while the Dow is still lower for the day. Phil, thank you very much. See you soon in your jeans, Phil LeBeau. The Dow is down
Come on.
1,000 points in the past 2 weeks. So which names should you buy? Which should you avoid? Our three-stock lunch trader will give us his sell-off playbook next. And as we head to break, we're celebrating Asian American, Native Hawaiian, and Pacific Islander Heritage Month. Here is Zoom founder and CEO Ritu Narayan.
As an Asian, I have a firm roots in family and traditions and culture that has been developed over thousands of years. My values are in education, hard work, and being a change maker and bring the change in this world. When that's combined with the freedom, independence, innovation, and fairness of what's available in America, it creates a very unique conditions for somebody like me to be a change maker.
A fucking nosebleeder.
Five.
Welcome back. It's time for today's three-stock lunch. Jerry Castellini has our trades today. He's President and Chief Investment Officer with Castle Ark Management. Jerry, welcome. Dow is down nearly 2,000 points in the last couple of weeks, so we've asked him to give us two names he'd buy and one to avoid at this juncture. So let's start with the big name of the day, which is Salesforce, down more than 20% after missing revenue expectations and that weak outlook. Jerry, is this one you think investors should pick up? Is it for sale or the beginning of a bigger downtrend?
We don't know, and that for that reason, we should avoid it. This one is being caught up in a big shift in cap spending in broad-based software and hardware at the enterprise level. And to see the beginning of a trend like this and to think this would be the turning point after just one quarter, I think that would be premature. Is this a great company? Absolutely. Truly one of the generational businesses that you've seen. But the company was built to grow. And for them to have to go through an experience now where their growth will slow or they might not have growth for some period of time, I just don't want to be around. I'll let this one play out and let others buy it.
So there's your avoid. Up next, though, we've got Applied Materials, the name you say to buy today. The stock slightly down today, but up about 10% over the past month. Why do you like Applied Materials, AMAT?
Yeah, so the opposite, really, of Salesforce is the visibility a company like Applied has. We clearly now are seeing a backlog of their swell with the rush to build and to meet the demand, not just in the next couple of years, but over the next 4 to 5, to build out the foundries to create this explosion in demand for compute power. And it includes not only that, but even at the data center level, the need for more memory is there. And when you combine those things with a business that's traditionally kind of constrained by the amount of machines they can build, this is going to give them a tailwind for profitability and visibility. And the key to this market right now is to having that. Again, the opposite of Salesforce is you can see even more clearly every day Applied's opportunity set, and it just keeps swelling now as people are more and more interested in this long-term view.
All right, let's move on to Intuitive Surgical, which is another name you say to buy, Jerry. The shares are up 20% this year. Why does this one jump out to you?
Yeah, this one hits their trifecta. There's 12,000 men pass through the age of 65 every day. 65 is that magical number that you have to start paying attention to the risk of prostate cancer. Prostate cancer solution is run through the Da Vinci machine that Intuitive Surgical has invented and has really closed out the market on. What's interesting about them right now is this is the first major upgrade in that product cycle, and it brings with it a whole turnover of all the hardware that's in the hospitals today. And the hospitals and docs just love this. And this is a very, very important upgrade for everyone that now has this risk factor. And you can expect to see their 30% margins probably going well into the 40% level. Again, a long tail to this upcycle. And in this kind of market where we're not sure about the economy, we're not sure about some of the disruption from the AI side, best to find names like this where you know you hope you're going to have a good visibility pattern.
All right, Jerry, thank you very much. Interesting. And that last one, very, very interesting indeed. We appreciate it.
Still ahead. Yeah. Orange juice prices are going bananas. Don't look now, but supply constraints and climate woes have got makers considering alternative options for OJ. We'll explain next. And don't forget, you can always hear us on our podcast. Listen and follow on any platform. Just look for Power Lunch. Be right back.
Wait a minute, I haven't sent this. Let's see if yeah, Jay Shady saying break out the whiskey. I was thinking the same thing. I didn't even want to come to market. So this morning I was like, this morning we dropped down. I was like, we're gonna fucking flounder here for like 2 straight days. I was like, I should just place like a call spread and fucking look at it next week, for like next Friday or something. And the other cool part is that like look at it, the HYG ripped higher. This is 9 a.m. today, right? Look at that move on HYG. No move up in SPOOs, right? Trading the same price as Friday. So market manipulation in full force right now. There's no real reason to be trading this. Just kind of garbage. You really can't rely upon anything at this point. Dixie rolling down as well. No move up in the marketplace, right? So market's being pinned. So there's nothing really to do at this point. Just sit here and watch and wait.
Off the lows, but still down. That's the story of the Dow. 440 at the low, now about 300 points lower as the Dow continues to stumble after hitting 40,000 a couple of weeks ago. We've only got a couple of minutes left in the program, but we got several more stories we'd love to tell you about. Number one, General Motors just announced its new electric Cadillac Optiq. That's with a Q. It will start at $54,000, making it the brand's cheapest EV option. GM says it hopes the model will help the company reach its goal of selling 2 million electric vehicles worldwide between now and 2026, while taking on the likes of Tesla, BMW, and others. So bucking a little bit against the trend, which seems to be moving a little bit more softly in the direction of hybrids, not EVs.
Exactly. Let's get to new data from Vanguard showing hiring for workers in lower paying jobs has remained resilient, even as demand for higher income workers drops. Firm says that's partly a reflection of lower paying service industries still trying to recover from COVID. But Burlington Stores in its earnings said the same thing. Their low-end customer is doing quite well still.
Well, good news there. All right, orange juice prices have climbed to fresh all-time highs amid persistent supply constraints, pushing the industry into crisis mode, forcing some makers to consider alternative fruits. The benchmark frozen concentrated orange juice futures closed at $4.77 a pound yesterday. That's nearly double the price from a year ago. Orange juice has gotten really, really costly.
I mean, I always love that really pure fresh squeeze one you get at some fancy coffee shops, but it's really expensive, even more so now. And if you get the stuff in a bottle, check, because they're going to blend it with other juices to try to,
extend
keep margins.
it.
Sony is in talks to buy Queen's music catalog in a potential billion-dollar deal, according to reports. From a Citigroup note this morning, it could have big implications for Universal Music Group, which represents the band's catalog globally outside North America and produces and distributes its audiovisual releases. Sony Group shares are up about 3%.
That would be a big deal there, buying Queen, because they're
worth
sort of
it?
timeless. I do, sort of. Well, I have no way of knowing, but I mean, they're one of the timeless groups. You hear their songs still practically every day. Thanks for watching Power Lunch, everybody.
Closing bell starts right now.
All right, guys, thanks so much. Welcome to Closing Bell. I'm Scott Wapner, live at Post 9 here at the New York Stock Exchange. This make-or-break hour begins with Inflation Eve. Tomorrow's PCE report looming especially large now. The market's on edge ahead of it. We're going to ask our experts what's riding on that read and what it means for the rally no matter what. In the meantime, take a look at the scorecard. With 60 minutes to go in regulation, we are red today across the board. It is the Dow that is the biggest loser, and it's a Salesforce problem. Suffering its worst day in years after its earnings. Take a look at that. Down more than 20%, and other cloud software names like ServiceNow, they're a mess too. Look at that.
You guys are talking about Pappy. I've drank every bottle of Pappy made.
Are actually green today, all but 2.
What is it? The 9-year? What's the first year? 9 or 12? That's whatever the cheapest one is. That's my favorite Pappy.
Which has gotten more narrow.
I feel like there are better single malt scotches.
That is just taking another.
Than the I think there's like a 9. Is there a 9, a 12, an 18, and a 24 maybe? I haven't had it in a while.
Thank you, sir. What's the story?
If you let me see what years they have for Pappy. It's been a while since I've drank. I stopped drinking it. I used to drink it a lot.
Down today, but they've been backing up.
Yep.
Been a little.
Listen, we've had a really good run, really all year. The stat everyone seems to be tossing around, the S&P's up, call it 23.
10-year. So the 10-year is like.
Rarely is it.
Yeah, the 10-year-old rip. That's all you need. The rest of it is like.
That was comparable.
Well, there's 2 things to this. Like, number one,
you could find throughout history.
The 10-year is just right. Everything else is absurd. It's over the top.
The rate story, we've talked about that. But listen, there is something.
Still apply along.
Being driven
from the weekend. Every other bottle of Pappy's is like too much. It's just too much.
Index is up, call it 3%.
And for me at least, for what I like, the 10 is plenty.
It's average.
And there are better single malts that kind of are similar to Rip,
et cetera,
enough that have had better tasting bourbon, or it's not bourbon, it's usually Scotch at that point, but.
NVIDIA's out.
And then not only that, but there are some killer Japanese whiskeys.
1 week period, for example,
that are like straight rip-offs of Rip Van Winkle, like straight rip-offs. There are American bourbons that are pretty good, but if you want like a straight rip-off where you would not, if I poured it for you,
State Industrials, and then
if I poured you some of the Japanese clones, you would never ever be able to tell the difference. They're like the exact copy.
And why aren't we seeing?
Yeah, there's some Japanese whiskeys, and they're cheap. They're like $30, $50.
That we just
dirt cheap Japanese. Dirt cheap.
Seeing the effect.
Dirt cheap.
The equal weights up, call it 2.
Dirt cheap.
3% for the year, perfectly average. If you
dirt cheap clones in Japan.
Rates call it 380 on the 10-year up to wherever we are now.
Dude, I lived in South Carolina. I've lived down there. But I don't drink Pappy anymore because there's so much bullshit with it now.
But we'll go with it.
There's a ton of fake shit out there. Tons of fake Pappy. About like I want to say by like 2000, 2005, 2010. I don't even trust that it's real anymore, personally. And I'm in the. Let me tell you something. Like,
it's the sword.
I work for like
offense protection.
Like fucking top 5 James Beard restaurants, top 5 Michelin restaurants in this country. So like I know these guys. Like I know the distributors. I know these guys personally. So you know, like
et cetera.
I'm fucking not, dude. I worked for fucking Halls down in Charleston. Like those guys are like in.
They're moving today.
That was the #1 restaurant in the United States of fucking America for like 5 years or something.
But if you've been and
I worked for the Halls for a while. So like even questioning Rip Van Winkle, don't even ask me.
Like they did.
Been there, done it.
Result right there.
Yeah, I mean,
been there and done it.
Side of the environment we're in, where there's no tolerance for disappointment, and but listen, I mean,
there's like I guess at least for me though, like I question the reason I say that about the questioning the if it's real or not.
Yeah, but the market votes more.
Is because so much of so what I've been told, what I was told was recently that shit's falling off the back of fucking trucks. #1.
Listen, you have seen,
you know that happens with Rip these days, and then I've heard through the grapevine that a bunch of it is fucking bullshit. That's like straight bullshit. Like the truckers are fucking replacing it with scam shit, like fake Rip Van Winkle, like for real. That's the word on the. That's the word inside of the.
Every other mega cap is negative except for Apple.
Inside some of the people that are actually in the know. So I don't drink it anymore. Personally, I don't drink it. I don't touch it anymore. Every once in a while.
To borrow Tony's phrase again.
Every once in a while, and then like what you need, the volume of the other whiskeys that you need to push to get an allotment of Pappy is insane. So even some people that claim they have it, I'm like, I don't know, man. I want to talk to your fucking rep. Like, I want to speak to the fucking rep and make sure that you're getting your allotment every year because you sold X number of bottles of this other shit that they sell.
Bryn, how do you see it, right? We said this is inflation eve because we get PCE in the morning, and given what rates have done lately, this is even more critical.
Yeah, I've tried some of the aged rums. My thing these days, the only stuff that I really drink these days is I don't drink a ton anymore. I still drink. I still like really, really hard to find. Like Austrian whites. I like some Spanish reds, and then I drink. Still fucking love. Like I love all the Austrian stuff. I like some of the German wines, and then I drink bubbles still. And some real hard to find red wines from Spain, some Spanish reds, but
actually, if I look across the sectors,
I don't do a lot of drinking anymore like I used to. I fucking drank everything under the sun.
are actually mass.
Plus, I'm getting older, so I don't want to get fucked up or hungover. I'll tell you something crazy. Of all the bourbons out there, there's a cheap ass bourbon out there called Evan Williams, and I went to their fucking distillery. Actually know those guys personally.
Yeah, Joe.
And I'm impressed with it being such a piece of shit. Some people are like, Dickel and stuff like that. I think even like blind. I don't think it's like high class bourbon, but
by those stocks we mentioned,
I've had good success with that. Some of you guys are mentioning Weller Wheat. I like Weller Wheat too. That's pretty good sipping whiskey. If you offered it to me, I'd drink it. Or bourbon, I should say. But
a lot of those software.
Weller's pretty good, but I mean for the price for what you're drinking,
the direction of
I don't know. It's like some of that Japanese shit. I'm shocked at how closely it matches like
global yields, not only
multi-$1,000 bottles of bourbon.
Further evidence in a lot of the eco data that comes out
Shocked.
that we are at the ceiling. If you're at the ceiling, then you could go back and revisit the broadening out of the rally.
Like the Russell
Proceeds to fucking stream 10 hours straight.
outperforming everything else?
Correct. Now,
Sorry, I'm talking to developers back here. Fucking dude, I'm telling. I get some of this. I get the idea that
rates impact,
like developers want to learn things as they go along, and they likely have to. But I'm like looking for the unicorn right now, and I'm not finding them.
about it,
I might have found one. I think I might have found a unicorn.
the propensity for active management to benefit
I think I might have found a unicorn here. I got 2 unicorns, and I'm actively talking to them right now.
market at that point.
I'm like, please, 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 please tell me you're real.
Passive investing, and where's it going? It's going to the Super 6. The Super 6, which coming into today are now 30% of the S&P 500.
Yeah.
Scott, yesterday with that number, that's the highest in history. We've never been significant awaiting for the Super 6.
You want to pick up where he said? He obviously wants something from you. That's why he was very complimentary of you at the outset, but we can deal with that later.
He wants to take us to the Rangers game tonight. It's obvious.
So I can see the Panthers win.
We'll talk about that later. But listen, I mean, everything he said about me is correct, and so I'll take it. But listen, I think this breeds a conversation about the dominance of the Super 6, if you will, about NVIDIA and how it can't go on, and
data APIs,
and how similar this is to Cisco in 2000. I would have made the case, why isn't this similar to Cisco in 1999 or 1998 or 1997 when top line growth was 40 or 50% and bottom line growth was 40 or 50%? In fact, I went and looked, not today, but recently. NVIDIA is not forecast to have Cisco's growth rates for another 2 or 3 years. What NVIDIA is doing today, you didn't see those companies doing in the late 1990s, 99 and 2000. So I still think from a allocation standpoint, from a capex standpoint, this is much closer to the 95 Netscape IPO than it is to the Intel 01 profit
So it's
warning.
closer than Bryn to the beginning rather than the end. I think people are trying to make that argument that we're in the very early innings of this AI boom, nowhere near the later stages of it when we think that, then all bets are off. Who knows?
Yeah, I mean, I think if you go back, Bespoke had a good piece the day before yesterday showing like from the lows of 1996 to 2000, the NASDAQ was up 700%. If you do the same adjusted look at COVID to today, the NASDAQ's only up 200%. So I think that the statistic that Joe shares about these 6 names being 30%, I think it's something we are mindful of. But if you look at NVIDIA's up tenfold over the past few years from a price, but also earnings and free cash flow. So I think that's what we haven't seen before, especially.
Yeah, PCE. I think PCE comes out just like our data this morning. It's just like the unemployment thing, right? Tick up, tick down, tick up, tick down, tick up, tick down. And the data that came out yesterday too, it's a mixed bag. It's like neutral. If you had if 10 was great, 1 was bad, it's like a 6.
You had
on PCE, I'm expecting the same results tomorrow as well.
And everybody at the time. It wasn't until the middle to later part of 2000 that you started to get year-over-year declines and profit warnings. You had a warning.
JDS, Uniphase.
We're going to go down with the globe. We're going to go down memory. But the point is, you had warnings.
The core for tomorrow is the forecast is 0.2%. So maybe I'm a little bit more bullish on tomorrow's. So forecast for tomorrow is 0.2%. The consensus is that 0.3 will come out tomorrow for PCE, or at least for core.
Valuation of tech.
You're going to see inflation come down. More than likely, you can see inflation already coming down right now. So I do expect inflation coming down.
Of the tech sector.
I do expect inflation to come down tomorrow. I do expect a positive report. All of this talk that you're hearing out there about
29.
A lot of the talk out there is geared toward there's two voices.
I think we're in a unique
that's out there right now, and you got to listen to both of them, because one voice is for hey, we're trading this today or next week or whatever, right? I'm in a trade short right now, right? I'm short right now.
Good possibility that
well, let me mute this real quick. I want you to know something I want to be clear about something right now. I keep trying to explain this to people, but There's two trades right now. And you can believe me or not believe me. I really don't care. I've been in this market too fucking long to know this. There's two trades. Your first trade right now is I'm a high net worth individual. Okay. I push around $100 million. And my buddy over here, he's a high net worth individual. Okay. He pushes around $500 million. I've got a fucking black box and I got his DM. Okay. In that black box, I've got a Bloomberg terminal. Right. And I talk to my buddy over there and I go, hey, man, we got suppressed volatility. Do you guys want to fucking trade it? Right. So me, this other guy, and another guy, we go on to the internet and we tell you, whatever the fuck we want. Stagflation's coming. Market's going to crash. Whatever the fuck it takes for the algorithms to pick up on it, for you to regurgitate it for that trade, right? Meanwhile, what am I using for the verbiage for that? I don't fucking know. We need to raise rates some more. Stagflation's coming. The consumer is doomed. Whatever the fuck it is you need to hear for you to jump on that trade with me, right? I already know we're in a low volume environment. I already know that if I can get a push going, I can get the dealers on my side and I can get paid. That's one trade, right? So there's that trade going on right now, right? Then there's a second trade. The second trade is portfolio managers at big banks that want to be prepared for real cuts or real rate hikes. Does that make sense? And those guys are a completely different fucking trade. Two different trades. And so when this economic data comes out, for me at least personally, outside of like a far out of expectation result, right? Where the data comes out, it doesn't match anything. Like we're expecting 0.3 and it comes out 0.7, or it comes out negative 0.5 or something like that. Only then does it really matter. Otherwise, good news is good news, bad news is good news. That shit doesn't matter. I'll be honest with you. It really, truly doesn't matter what the results are. I'm going to be honest with you. Most of the time, it doesn't matter. They usually know what the trade's going to be before it happens. So PCE tomorrow, and inflation in particular, the Fed's favorite gauge or whatever. For right now, inflation is coming down. Wages are on the up and up. Wages are increasing. The labor force is strong. You've got McDonald's out there telling you they're going to give you 4 McNuggets and a fucking cheeseburger and a small fry and a Coke for $5. Now, it's not improving a ton, so I'm going to expect inflation to come down a little bit. You know, we talk about inflation. We don't want to see inflation and unemployment's velocity. We don't want to see inflation like ripping down and bouncing off 2%. We don't want to see unemployment ripping up to 5 or 6%. Any of those things are really bad for the market. Outside of that stuff, right? I'm not expecting much. They're going to manipulate this fucking thing until we get past the election. And so when you're hearing them talk about it, when they're like, blah, 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 it means nothing. It really, truly doesn't mean shit. It has more to do with their current positioning, right? Hey, we're going to long the market now. We're going to talk about how the market's going to rip when they cut rates. Whatever story they're going to tell you to get the market to go in the direction they want it to go in at that moment. Sorry to say that, but it's real. It really is. It's real. It's kind of like, you know what else? I'm always fascinated by like Mike Burry when he's like, there's two things that he does, right? First he tells you a bullshit story. Tells you the market's going to crash, and then you find out that he had already placed the trade 2 months before, and he was closing it, right? He didn't stay in that position. He's in and he's out. He made his money, and he's gone. And he's going to tell you where the fuck you want to hear, whatever the fuck it is that you want to hear for to get that position printed. We all do it, even on a smaller, no, we don't all do it, but we all do it to some extent, even as a small retail trader, right? You own, let's say you end up owning Palantir. You own like 10,000 shares of Palantir. You're going to go out there and push your position, right? Hey, you like that Palantir, right? If you're upside down in particular, you might even go on the internet and keep pushing it aggressively, right? So that you can get paid for that position. So that shit is all the way up to large scale traders. That shit's real. That shit is fucking real as day. Real as day. It kind of sucks, right? Because you're like,
on this, and she said this, if you're a CTO, you're focused on cybersecurity, you're focused.
Let's look at Salesforce really quick. I wanted to check this one out.
And cybersecurity names.
I didn't get a chance to look at it today. I saw it get murdered.
I would tell you if
make
there's
it 9.
Okay, make it 9. If there's further deterioration in CrowdStrike, I'm long the name, and that's the name I think you want to buy.
Listen, Netflix is a perfect example. A company.
Yeah, it's kind of like we watched. It's kind of like we watched them sell financials on their ERs. They already knew they were selling them, right? I think one of them they just sold before they even got to ER this year. They already knew. Like they already knew what they were gonna do.
Live sports. They announced the.
You tell me the price, I'll tell you the story, right? That shit's all real.
And this is a perfect example of the type of company.
Damn, that's not expected right there.
Oof. Not one of the
Salesforce that's a real one right there in Salesforce.
There was a concern of that.
That was a real bad report, wasn't it?
And there was
kind of. The weekly was bad on it.
And I work with people who bought it instantaneously, and they've been.
The weekly velocity on CRM was shitty.
This is a perfect example of the type of company that should be getting much more attention. As much.
You can actually see it trades on its weekly velo right here.
There's plenty of places to make money that isn't NVIDIA.
All right,
we're gonna actually see that it trades its weekly velo. It was already on the downside of its weekly velo, but this here was good at least. The daily velo was good, so there was likely some unexpected news. I did hear the news on what they had to say. It was still kind of bearish.
We're pushing back on higher prices.
Yeah, it was already beginning to roll. But that's an amplified move, man. Woof.
Did though maintain its
trading 220.
Shares down 9%.
This shit's gonna trade.
Spending habits.
It's gonna trade $130 when it's done. Likely trade $130 when it's done. Maybe not 130. It'll trade $132.
Accelerating growth, profitability was much better than guided.
Definitely 167.
That demand for
definitely $167 bucks. Salesforce coming down.
Almost 22%.
Definitely coming down.
Earnings beat was a bright spot when compared to other software names. I know you just talked about it, but Salesforce.
Dropping spoos once again. Not moving spoos.
All right, good stuff. Back to you shortly. Christina Partsinevelos.
Dealers have no reason to buy or sell right now. No reason to buy or sell.
PCE inflation.
If we start to see equities getting dumped, they will amplify moves to the downside and the upside.
The markets and your money. He joins us after the break. We're live at the New York
Short gamma regime, baby.
On CNBC.
Dog shit. Yuck. Parking the bus. Yeah, Salesforce will trade. Salesforce will definitely trade. Probably. If I had to guess, this whole move will get erased. Targets on Salesforce right now are 183.50. 183.50 on a quarterly low. Yeah, 183.50 by the end of this month. Expect 185. 183 to 185 on Salesforce at minimum. Woo! Woof. And you're making a shit ton of bag holders. Shit ton of bag holders. From October of 2023, all bag holders now. Salesforce. Damn. Whole new class of bag holders on Salesforce. That shit ain't coming back for a long time. Long time. Yeah, you have to maintain on, just a heads up here, on NVDA, you have to hold it. You have to hold it. If you don't hold it, we're going to get a bloodbath, guys. If you read that brief last night, that 5% is coming. That 5% is coming. 2 nights ago, I showed you the, how the market equal weighted S&P 500 sold 7%. And NVDA went up 7%. So basically, NVDA is holding the entire fucking market up right now. Entire market up right now. NVDA, baby. Woo! Woo-wee! That's right. Paktan Havadyad. I know that saying. I know that saying from Boston. I know how those Bostonians talk. I tried to drop that accent too. It sounds so trashy. Bostonians are like they're as bad as Long Islanders. You get out of Long Island, you're like, what the fuck are these guys saying? You got a what? You got a PhD? Don't mind this right here. This isn't any kind of resistance. Don't be paying attention to that. That ain't nothing. Oh, there goes the blood, baby. Trading 522.88 right now. Blood.
We're in the red across the board today. Amid a tough holiday shortened trading week, the S&P 500
tough holiday short trading week
to snap their 5-week win streaks. Investors
trading 522.89. Daily trigger right now sits at 521.14.
Sebastian Page, T-Rowe.
521.14, baby.
Good to see you, Scott.
Ben, this market's been resilient. I know we had a little bit of a speed bump this week.
Pull the plug at NVDA.
Look, I think today is interesting because my 2 themes for the trading today are rates, and you were just talking about this with your other guests, and rotation. You are
Am I there? Yeah.
broadening.
Didn't I just send you?
For PCE.
Oh, there I am. I'm here.
3% month over month.
Hello. Yes. Yep, I'm here. Yes, I'm here.
Tell me, do not look at.
Yes, I am here.
Unfortunately, the market is now very sensitive to 1-month data because the Fed has said.
All right, I'm gonna go back in this meeting right now. I'll be right back with you guys.
If I'm like a runner, I look at my watch and I see how fast I'm running. 0.3% month over month is over 3.5%.
Lexi.
Expect sticky inflation from here, Scott.
Are you more positive on the market than you've been in a long time? Because in my notes it says you expect the market to broaden over the next 12 months because we're gently cooling and earnings growth should broaden. That's.
All right, I gotta get back to
You're not as cautious. I'll use that word. I don't want to say negative. Is that fair?
Yeah, look, my view is that investors should be close to their risk tolerance, their normal sort of long-term risk tolerance. So call it neutral. You've been talking about concentration. The bears on my asset allocation committee are worried about concentration. It is an economic slowdown. And Scott, from here, the sentiment, sort of shorter term indicator, is running pretty hot. Yeah, today, software is not doing well and tech is selling off. But sentiment, if you look at retail surveys, or even the VIX touched 11 last week. It's 13 this week. So this sort of positioning and these high expectations. Scott's a wise person once told me that the secret to happiness in life is to have low expectations. The expectations.
Black Skull modeling tied to.
All that being said, Scott.
Financial data APIs.
Rates over time are coming down. I don't expect a recession. I think stocks will do okay. I think credit will do okay. And I'm pretty comfortable for the next 12 months.
But that's a change. I mean, let's be honest, right? That definitely sounds like you have changed more.
Exactly. I have a master's degree in a vocabulary of Tony Soprano.
Those are your views. Don't expect a recession. A hike is unlikely. Market's going to broaden. Earnings are good, right? I mean, you're building the case that maybe you
can't unhear it now
in this market than you were before, or at least more overweight U.S. equities than you were willing to be prior.
Yeah, look,
let's check out SPX really quick.
We've been talking for a while, Scott. closed their underweight stocks back in October.
Oh, yeah, we're free falling now, boys and girls. 5,200 on tap right now.
You called me a
We have a new low after rejection on 52.50, so we're likely going to blast down to 5,200, almost direct here in just a few moments. We're gonna go ripping right straight down here, boys and girls.
And so
one quick second here. I want to check one more level here.
Closed it pretty fast. We bought $3 billion worth of stocks, and we've been neutral since then. We've actually
right there. We're gonna tag that one right there, and we have another one.
Look, I think it just comes down
right there. 520, right on the kisser.
AI is like
we'll likely trade 520 here.
Right now, is
either today or tomorrow, somewhere in there.
Her conversation with you at lunch, but right now it's sort of building AI, semiconductors, cloud computing.
Yeah, right down in there. 520 is on its way right now.
Prices, utility.
We're pretty close to stabbing at
I
it.
believe this is real. It's going to be a wave that's going to
pretty close to stabbing at it.
Traditional companies to create productivity, and all I'm saying
we're free floating right now underneath
wave are extremely high.
On SPX, we are below a gamma level at this point.
So, you know,
and we're going to get a quick drop, hopefully, down here to 520.
How much risk do you want to take? And Scott, if you allow me to talk about
329, half an hour left.
Allocation.
And if we don't drop it today, we'll drop it on the overnight to the downside. We'll get down there, trade 520 by tomorrow. Then they'll park 520, and we will sit there all day long and watch the market just do nothing.
70-80% stocks, right? So what I'm talking about is understand your risk tolerance, and this is the kind of...
I don't even know if those calls are probably negative right now. I bought calls yesterday in the close.
Understood.
I bet you they're like negative 1,000.
Long cash. What does that say? And why?
What do we got? What are you asking here? Hold on here.
Upside risk.
Open in another tab.
From here, so within fixed income, we have this interesting barbell where you get a
Yep, I need all those.
cash because the curve's inverted, but we're also long a diversified credit portfolio. They can call it the magic barbell.
Those are the calculators that I need.
Really well when rates back up, but you don't have a recession, so that credit gets in trouble. And we like that positioning more than sort of traditional longer duration bond portfolios. So we're going to position
using market data
to expectations. That's what it means, Scott. But I'm a multi-asset investor, so I like having that fixed income positioning together with an equity positioning where we're tilted towards
1, 2, 3, 4, 5, 6, 7, 8, 9.
Theme I'm looking for. Scott,
10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23.
The expectations are that year-over-year earnings for the value style or sector are actually going to grow
36. I thought that was about 36.
Earnings.
36.
Earnings. In great part because value stocks have really easy comparables. But there is a passing of the baton here in the equity market that should be healthy, reasonably healthy for the stock market. And,
please tell me, Lesky.
That broadening or rotation, if you will.
Appreciate your time, as always. Sebastian, thank you.
Thank
We'll
you,
see you
Scott.
soon. All right, up next, top technician Jeff DeGraff is back and breaking down the charts for us. He is forecasting a pullback in one of the market's top sectors. He'll make his case to you and tell you how it might impact the broader rally just after the break.
Read the trigger. Oh, nope, don't need that. Yeah, I was hoping we could go up today. I was hoping that we could squeeze it today, but that's being manipulated. It's being pinned. Knuckin' fucks. We're not gonna move, man. They're gonna hold this shit right down, pin it right into the fucking close tomorrow, man. We're gonna pin this fucker right in. If I was you and not streaming like me, I'd probably just fucking take a long weekend, come back on Monday, find a low on Friday or something, put on a call spread for next Friday, and come back and check on it. OPEX, baby. Monthly and month end for the month of May right now.
Now. We are back with the NASDAQ again retreating from records set earlier in the week. Our next guest says one of the most loved corners of the tech space could be at risk of a bigger pullback. Joining me now, Jeff.
No, they want to do that right now, huh? I figured they'd be waiting for this NVIDIA stuff, but they're going to drop NVIDIA right now. NVIDIA is bleeding. NVIDIA below its hourly trigger right now, and if you get a nice new low, watch this real quick on NVDA.
Momentum, and we're momentum players, so
we need to break below the prior high. Get rid of that.
Momentum is going to continue.
Just show you this real quick.
History that becomes a problem for us, and so we're seeing that in semiconductors.
This might be a really good fucking short here. Don't take it just yet, but.
And
if you can get below 1,109.25 at any point, 10.
Fresh money. So I think the expectations are pretty filled up here. And we just want to be careful, and we're advising our clients.
You can get below a new low down here.
Sentiment.
1109.15. Look for a big fat fucking short.
It's kind of been rolled.
But you need to get that low, and then right there, and we're gonna blast down. We'll race. We're gonna trade 1,000, by the way.
Early summer months.
We will trade 1,000.
Look at just technicals.
Near 1,000. We'll take that whole trade back. That entire trade will go bye-bye.
We wouldn't be looking at a software picture that looks like
1,000. But you need the new low right now.
Story than a technical one.
Boy, I don't think so, Scott. I mean, there's been several. In fact, we did a report earlier this week that focused on the weakness that we're seeing in software. So. For us, it was a little bit more telling that we were seeing it across the board. That wasn't in Microsoft, but we were certainly seeing it in some other facets of it. And we made that distinction on Tuesday and just said, look, tech is not all tech is equal here. Tech generally is okay. Semis are getting extended, but there's still an uptrend, and software actually has some vulnerability here. And our take is that the hardware and peripherals and those names, the NetApps of the world, et cetera, look pretty interesting here. So we think there's a lot of rotation going on in tech.
But you think that the semis as a group can pull back by as much as 20%? Is that correct?
Yeah, I mean, that doesn't, keep in mind, I mean, NVIDIA came very close to that. If it didn't do it, got down to like 750 intraday. So, that's not that unusual given the volatility of that space. So again, putting fresh money to work here just says that you're opening yourself up to the risks of a drawdown. I'm not saying a bear market in the case of NVIDIA, but you're certainly opening yourself up to a drawdown that you'll probably regret, and weak hands tend to be sellers of those oversold conditions, and we'd actually rather be a buyer of that oversold condition.
It's just crazy. I mean, we could have said some of these similar things about NVIDIA, for example, wouldn't put fresh money in at 950. Wouldn't put fresh money in at 9.
Cross my fingers here. I'm in a meeting right now. I'm waiting for an answer from these guys, from these devs, and see if they say yes.
At 1150.
This is going to make my whole entire fucking day right now if they say yes to this.
Today, but this market can get away from people quickly when they're hesitant to put money in.
Well, keep in mind that each one of those that you mentioned, when we had the options that were, again, priced where they are today.
Market bleeding right now into the close, 339. I'm going to have an expectation here for tomorrow that we will trade 520. We will pin and hold 520 for tomorrow. That is the expectation into tomorrow's close. We will trade this 525 and 520 to the downside into the bell by tomorrow.
Look at
4 p.m. 5,236 cents.
Opportunity to buy.
Or no, 520.36. Something like that.
We talk about China and Hong Kong, and
that 3:59 p.m.
They're not quite oversold yet, but if we look at that from a, call it, 3-year perspective, they're very, very.
Come on, answer this question for me. Just say yes to this question. Don't say no.
And then tactically, they've actually consolidated here. I think those are pretty interesting, in terms of a longer-term thematic idea, called for the next year plus, or called the remainder of this year plus. I think those are pretty. That's a pretty good opportunity right there.
That's why it's your answer is telling in and of itself, right? It's hard to find many things that are oversold in the U.S. market because the rally's been so strong since the April low. We'll talk to you soon. Jeff, thank you. I appreciate it very much. That's
Thanks,
Jeff
Scott.
DeGraff joining us once again. Up.
VIX 9-day trying to break above resistance here. VIX 9-day trading 1360, trying to trade 1713 for the volatility trade.
Sneakerheads of those names.
SPX in free fall right now. Bleeding. It should blast down. And overnight, it'll blast straight down to 5,200. So keep that 5,200 and SPX in your gun sights down here for a big move down. Possible that it even happens into the bell today. Possible it even happens in the bell. CVS catching a bid right now. Whoop. CVS trading 55.92. I can't leave this meeting. It's kind of sucks. I got to sit inside of this meeting. Look at that hourly velocity. Let me put it on a 30-minute. They're taking it downtown right now. Look at that hourly velocity here. Woof. This would be the we got more. We got a little bit more. We're pretty extreme right now. This is as extreme as it gets. This is like the extreme as it gets usually down here. Pretty extreme right now. I'm checking previous history. Here's an example right here. Yeah, this could turn it. Just check this really quick here. You might get that 5% like right now. It's possible we could get that 5% like today. See this? Not today specific. Yeah, we could get that 5% tomorrow. It's possible. Last time I had a reading like this was September 14th. And we finished on October 3rd. We might get that 5% into next week. It's possible. It is possible. We are getting to extremes on bearishness not seen since last year. Fairly extreme right now. It's possible we get the 5% right now. Not guaranteed, but we're getting the readings for it right now on hourly velocity. That would be fucking wild. If we traded like 4,800 like by next week, I would be shocked. shocked. They need to create some panic, though. You need to have the put buying to amplify the move. Let me take a look here. You need to get more put gamma development. Right now, the wall is at 5040, so 510 is the bottom basically right now. But if you get people panicking and they start buying puts, 480 could be done by next week. I doubt it, but I'm doubting it for sure. But if they can do it, I'd buy it. Actually, if they did that, I'd probably spend about $100,000. I'll be honest with you. I'd probably spend about $100,000. I'll do that shit live with it if you want. It'd be trade of the year. If there was a trade of the year, that would be the fucking trade. Hands down. I could probably stop trading for the whole entire year if that was it. If we did a 5% down fucking move, that would be the shit. That would be the fucking trade of the year, hands down. Hands fucking down, dude. I'll be a millionaire this year if that happens. I'll be a fucking millionaire. Yeah, true. Exactly, right? You do like a 5% move by like next Friday? It'd be fucking dope as fuck. I would literally mortgage off my kids and wife and house. I probably would. I actually probably would. I'd probably go to my bank and take a fucking loan. That sounds fucking crazy, but I'm serious. Not joking. I'm still salty about last November, last Q3, Q4 of last year. I'm still salty about that shit. I was supposed to make like $500,000 last year, and I didn't. And then had I stayed in, I would have been a millionaire. I would have made $1 million, more than $1 million last year. So if you give me 5%, if you give me a 5% drawdown, I promise you, that shit'll be bought hand over fist. Hand over fist. Trading 522 and 29 right now. Hanging out there in thin air. We're looking for. I'll give you an exact target if you want. Hold on, I'll give you guys an exact target. 52.49. Hold on a second here. Whoop. Let's just call it 52.50. 52289. Yeah, I think I got it. It's right here. It's right about here. I'll even put the things up for you. Like S3 is 516. 520.73. Let's put on SPX here. We're going to go straight down here. We're not done. We're going to go straight down. $2.9. So like 519 or something like that, at least. I think 519, right down there. SPOO's bleeding into the close right now. It is 3:48. 12 minutes left, coming all the way down into the daily trigger. Should catch a bounce down here on the DT. You can see the red line on the top side of Bookmap. and we're likely not done going down into the overnight. We're likely going to blast through this at some point into the open tomorrow. Now trading 521.39, baby. 521.40. Watch out for a bounce here. Watch out for a bounce on that daily trigger. Target hit, basically, right about there. Bam. We got 520.73 as S2. And then S3 is 516.73. Woo! Woo! Down below, I want you to take a peek at this here. This is 5,200 right here, where it says negative gamma. There is nothing here. Nothing here. Nothing stopping the price from continuing to the downside for S&P 500. Woo-wee! Spoos bleeding out, trading 521.62. NVDA giving it up with a new low at this point. No more highs for NVIDIA. Expectation even on a pullback. Expectation on NVDA. Price target $1,000 on NVDA. Price target $1,000 on NVDA. They will give up $100 without even blinking at this point. You have a confirmation trade looking for a pullback and a rejection to trade. You ready for this? Possible we could trade 950. Possible. Possible we can trade 950. Definitely possible. Let's take a look at NVDA really quick. Here's NVDA. You have two things happening here. You have the prior low of known support. That was at 1109.15 right there. You have a new low right there. No matter what this drop is, if you catch the rejection trade in the cross of the hourly and half-an-hour trigger, we are going down, baby. Expect at least 1,000 possible. Trade to 950. You should see panic set in on NVDA at some point. Should see panic set in on NVDA. Woo-wee. And you will erase this entire move right here. Bye-bye, NVDA. Good night. 919 down there. Woo! 919 on a low for an extension. Upside target 950, 949.54 on NVDA. So I guess you have like PT1 would be 1,000, PT2 949.54, PT3 919.812 on NVDA. They have not confirmed the cross yet. You will see that cross though. You will see a trade to it. I want you to see it right there. The half-an-hour trigger is crossing right now. The half-an-hour trigger. So look for an upside move. If they can close that right, that right there, baby. Wham! Right around 11:30. Right around 11:30, and then bam, we're going downtown on NVDA. Blood in tech right now. Blood in NVDA. Woo! Blood, baby. Look at Spoos over here. SPX just bleeding. Dealers being used to impact the price of the market right now. Dealers amplifying downside moves in the stock market. If you don't understand what I'm talking to you about, dealers are in what's called a short gamma regime. Short gamma regime, if you don't understand what that means. Positive gamma was fundamentally eroding yesterday. Dealers being now short gamma, this means that they have sold their options and they have positions that are negative gamma. Gamma measures the rate of change of delta, and being short gamma implies that their delta changes negatively with movements in SPX's price. To manage their short gamma, dealers will need to constantly adjust their positions by selling SPX when the market is dropping and buying the underlying asset when the market is rising. So you will see wild-ass swings in the market. This hedging activity is an attempt to become neutral by adding vega. Basically, they will amplify moves. For example, if the market is experiencing a sharp drop, dealers must sell even more, which can exasperate the downside movement in the market. This results in a feedback loop, even on the upside. So when you see moves like this over here, you see these big-ass moves that they start selling equities, and dealers will chase it all the way down, right? Market starts to whipsaw back up, and guess what happens? We whipsaw back up to the upside. This results in what's called a feedback loop, even on the upside. This can lead to more put buying by other market participants, developing even more negative gamma. Putting dealers short even more puts. This often leads to higher implied volatility, which, as we noted earlier this week, was extremely low for the month overall. This increases the value of puts and forces dealers to sell in more of their position. In a nutshell, we are likely entering a period of significant market swings until we return to positive gamma, which as of yesterday was 52.80. We also know that CTAs are expected to slow down their trend following to the upside, and Vault Control Gang is likely done trying to control volatility in the marketplace. So what does that mean for you? It means you're going to see shit like this happen. All the way down, all the way up. Craziness. Now, what's the other problem here? Do you know? I'm going to show it to you right now. This is the gamma regime, right? You've got a gamma wall here at 5,200. You've got another gamma wall down here at 5,150, and you've got another one down here at 5,100. There's one more down here at 5,050, but the danger for a bull is what? When you get selling like this that becomes amplified, people panic. They start to buy puts. When they buy puts, we'll come back tomorrow, and you will see poof, a line down here, and you'll see poof, a line down here, poof, and you'll see a line down here, and then your put wall comes down farther, and that allows price to move faster to the downside. So I'm going to assume at this point into this close that you're going to see panic put buying. Panic put buying. Panic at the disco. Where's Carrere Low? Is he here right now? Carrere Low's like, don't panic yet, Cap. That was 2 days ago, I think. He's like, don't get crazy yet. We're not going down yet, Cap. He's like, not yet. I'm like, oh, yeah, it's coming. It is coming, baby. There you go. Panic at the disco. Almost down in that daily trigger with a low of 52.1.34, baby. Woo! Bears making money. Bears didn't get to enjoy their Memorial Day weekend, and so they are making bank coming back from vacation. You want to see it? You want to see it? You can take, hold on a second here. You can take equal weight. You can go to TradingView, take the equal weighted indicator for the S&P 500. And you could actually see the decline in equal weighted SPX versus NVDA. It is the market right now. It is literally the entire market right now. All money's in the market. We're flooding into NVDA. Seriously, not joking. I posted that in a market brief 2 or 3 days ago. Woohoo! Party time. That's now yellow. That bad boy turns yellow now. Whoop. Party time at the disco. Oh, I've done that, Chase. I've done that, Chase. I've called fucking moves, man, and I've lost money. Exact. I draw this fucking shit out, and I've been like literally wrong strikes, wrong dates, all that shit. Dicking around here in a fucking live stream with you guys. Been there, Chase. Okay, there's the close. I'm going to expect more fuckery to the downside overnight into tomorrow. More fuckery to the downside. They're going to push it down on you. Let it close up and swing up into 5,200 on the close tomorrow. I will see all of you. Oh, shit. I'm missing this fucking meeting right now. I'll have a market brief for you tomorrow. Expect more downside. More downside. And then they'll try to pause it and bring us into 5,200 for the close tomorrow, baby. I will see you all at 9:30. Hey, by the way, last night, I was doing your market brief last night at around 8 o'clock, and I got yanked away. I had a small family emergency that couldn't get out of it. I had a woman in my life that was like, I need you right at this moment to hold my hand. Tonight, I will get your market brief out before 9 p.m., like 8, 9. I'll have it out for you. This is where we're supposed to tag today. If you looked at last night's market brief, this is where we're supposed to tag today. I don't know what to say to you guys. 532. It's unlikely, man. I don't know if that's going to happen. There's a lot of manipulation and parking going on right now into Friday. I don't know if that trade is dead going up there right now. Maybe next week we get that pullback up to 532. I don't think that's going to happen right now. There is a lot of market manipulation going on right now in this low volume environment. There are forces at play. Don't fuck with them. Park in the bus, baby. I'll see you all tomorrow, 9:30 in